what's been going on internationally, and what are some of the immediate policy challenges as we face what looks like might be a second wave just around the corner. Let me turn to a few Zoom ground rules of this seminar and this conference, just to make sure everybody's aware of it. So we have the various panelists. We also have participants who are our normal academic participants. And then finally, this is a world viewable live webcast. It will be recorded, and the recording will be posted on the Brookings website in due course. The structure of each session is that we will have the papers and then the discussants, and then we'll open it up to the participants for questions. So the best way to do that is to use the raise your hands feature in Zoom. We will call on you and unmute you, and then you can ask your question. You can put it in chat and you can put it in Q&A, and we'll try to monitor that, but we prefer to actually hear your voice. And we'll call on as many of you as possible. Finally, we're going to be pushing Zoom to its limits, and we're going to have some lunch breakout sessions, so sort of simulating standing around eating sandwiches. I'm not quite sure what it'll be like eating your own sandwich on Zoom as we talk about the papers, but we'll have 3 sessions over lunch, and the links of those have been sent around to the participants. So thanks very much and welcome. And we're going to start off with John Grigsby talking about the US labor market during the beginning of the pandemic recession.
All right, so hopefully my share screen is working and you all can see. Thank you very much, Jim and Jan and Brookings, for putting this on and putting us at the top of it. This looks like a great, really exciting agenda. I'm going to learn a lot today. So this is joint work with Thomas Chiner, Leland Crane, Ryan Decker, Adrian Hammonds-Portelis, and Chris Kurz from the Fed board, as well as Eric Hurst and Ahu Yildirimaz. And as usual, these are our opinions, not necessarily opinions of the Federal Reserve Board. So what we're going to be doing in this paper is going to be using paycheck data from ADP, which is one of the world's largest payroll processing and human resources management companies, to chart the labor market's behavior at the beginning of this pandemic recession. And so we're going to be able to look at a variety of different variables, in particular employment, wages, and business shutdown, reentry, and employee recall. So we're going to have a relatively complete picture of what's happening in the US labor market over the last couple of months. Now, these data are very attractive for doing this for a variety of reasons. First of all, it's a very large sample. It's an employer-employee matched panel for about 1/6 to 1/5 of the US workforce. So ADP processes payroll for over 20 million workers every month. It's very high frequency and timely. It comes into us at a weekly frequency, and it's broadly representative by firm size and by industry. So as you can see, historically, it's also tracked the US labor market official statistics very, very well. So here the red line is an ADP employment index based on some of the work that our Fed colleagues have done. The dashed blue line is the current employment statistics. You can see they pick up the same signal, same fluctuations in employment over the long run. So we should trust these data on a variety of levels. It's administrative data, high quality, matches a large part of the US workforce. And so now let's just dive into the results in the interest of time, starting with employment. So what this is showing, you're going to see a lot of pictures like this over the next 15 minutes, is the employment levels in the US economy as a whole relative to the level that we observe in the data in the second week of February. You can see that there are 2 lines plotted here. The solid line shows you the number of paid employees, so people who are getting a paycheck in the ADP system. The dashed line shows the number of active employees. That is, people who are not receiving a paycheck necessarily, but are active in the HR software as sort of the universe of people who might be getting a paycheck. And what you can see is that both of these lines decline quite precipitously in the end of March, mid part of March. But focusing on the paid employment line, you can see that as of the end of April, about 21% of employment in the US had lost their job. That has since recovered a little bit, so that now we're still about 15 percentage points below where we were in February, but certainly we're far below capacity overall. You can see there's a big gap between the paid employment and the active employment as well, suggesting that perhaps some workers are not being paid, but are being kept around in the payroll system with the possibility of them being rehired or recalled later. We're going to see some results on that a little bit later in the talk. We can do this by a variety of firm and worker characteristics as well. First of all, let me show you what's happening by firm size. There's been a lot of attention towards preserving small businesses during this downturn. So panel A is showing you what's happening in paid employment. Panel B is what's happening in active employment. And in both panels, you can see that that small firms are having a larger decline than our large firms in the downturn. So fully 27% of over 1 in 4 workers who are employed in firms with less than 50 employees have lost their jobs relative to their level in February. But they've also rebounded quicker. So we're seeing these small firm employment rebounding much more than mid and large firms, to the point where pretty much all firm size classes are at about 15% below where they were in February. So much of the employment gains over the last couple of weeks have come from these small firms in both paid and active employment. Turning to some worker characteristics, we can plot some patterns by sex and subsequently show you by a point in the wage distribution. So this is showing you by sex. The black line is for men and the dashed red line is for women. You can see that both men and women declined a lot, but men declined by about 4 percentage points less than did women. What's more, they've both recovered a little bit, but women have been recovering somewhat slower. That gap has been widening over time. So now men are about 5 percentage points more employed. I guess women have had a 5 percentage point larger decline relative to men as of the end of mid to end of May. You might think this is partially to do with industry or firm size mix or these kinds of things that might vary systematically across men and women. Indeed, historically, men tend to be much more cyclical than women, in part because of their industry mixes. They tend to be more in manufacturing, these other kinds of cyclical industries. It turns out if you look within relatively detailed industries and you control for firm size and age distribution, all these things, this pattern persists and pretty much doesn't get any smaller. So it might be a whole bunch of other things. I don't want to speculate too much, but we know that it's not entirely driven by industry, at least. That's not the smoking gun. Now, the other thing we can look at is by initial wage quintile. So we can rank people according to their position in the wage distribution as of the distribution in the first 2 weeks of February. So in the first 2 weeks of February, the 20th percentile worker earned about $13 an hour. The top percent or the 80th percentile worker earned about $33, $34 an hour. And so we can look at the behavior of the employment levels of people who fall into each of the quintiles of that wage distribution. So the employment behavior of people who earn less than $13 an hour versus say more than $34 an hour. What you can see from this picture is that it's really the people at the bottom of the distribution who have been especially hammered at the beginning of this pandemic recession. So that's that black line, and you can see that fully 37% of low wage workers have lost their job or lost their job by the middle and end of April. So that's over 1 in 3 of these bottom quintile workers lost their job. They've also recovered a little bit, but we're still about 31% below where they were in February. If you compare that to the top line, that's the top quintile, the dashed red line with circles, you can see that top quintile workers had much more muted declines, about 9% at the trough, and are now only about 5 percentage points below where they were in February. And so sort of monotonically throughout the wage distribution, you can see that lower wage workers were hit more heavily. That's going to have a big implication for how we think about aggregate wages in this period. So this black line is just plotting the average wage, a simple average of everyone who's employed in the ADP data relative to the average wage in the middle of February. And you can see despite the fact that employment was declining a lot, the average wage actually went up by about 6% through the beginning of May. That's now declined a little bit as employment has come back. So now we're about 5 percentage points above where we were in February. You can see this a little bit in some of the government statistics, but not with such a high quality as this administrative payroll data. But this is entirely because of that last picture I showed you, because of the shifting composition of the workforce. Bottom quintile workers now account for a much smaller share of the workforce than do top quintile workers. If we were to remove this composition effect by just focusing on a set of workers who are continually employed from February all the way through to the end of May, and look at the average wages of those people who are continuously employed, That's what this dashed dot line is below. And you can see that that's pretty much flat as a pancake. You're not seeing wage changes amongst the people who are continuously employed. We can actually go further and use the panel nature of our data to look at who's getting a wage change, who's getting a wage cut, and how frequently are they happening. The trouble with doing that is that wages tend to be quite sticky. People don't get wage changes every month. In general, people get a wage change about once per year. But what we can do is we can exploit something we found in some previous work with Eric and Ahu that shows that firms tend to adjust all of their workers' wages, and the majority of their workers' wages, in 1 month out of the year. And those months might differ across firms. Some firms might adjust all of their workers' wages in January, some in April, some in July. But when they adjust, they tend to adjust everyone at once. These are consistent year to year. So we can just look at the subset of firms that traditionally change their wages between March and May, who are due to have a wage change during this time period, and plot the probability that these firms, workers in these firms, will get a wage freeze in panel A, and in panel B, the probability of getting a base wage cut. The dark blue bar shows in 2019, you can see that in 2019, among these firms, about 25% of workers got a base wage freeze. That spiked 46% of workers in these exact same firms having a wage freeze in 2020. Now, this is very large. So you can compare this to, say, the Great Recession. In the Great Recession, about 40% of workers had a base wage freeze. It's even more striking if you look at wage cuts. So in normal times, wage cuts are very, very rare. In 2019, only about 0.3% of workers got a base wage cut. But in 2020, fully 11.4%, over 1 in 10 workers, got a base wage cut conditional on staying on the job. This is enormous. So compare it to the Great Recession, 6% of workers got a base wage cut. And in the entire period from 2008 to 2016, about 2% of workers get a base wage cut. So this is twice as many people getting wage cuts as during the Great Recession. We can do this further by looking at different segments of the wage distribution and showing where the freezes and cuts are happening. So that's what these different bars are: first, second, third, fourth, fifth wage quintile. You can see that wage freezes are much more common at the bottom of the distribution, both in 2019, but especially in 2020. But if you look at the probability of getting a wage cut, it's really concentrated at the top of the distribution. So the top quintile workers, fully almost 15.5% of workers got a base wage cut, but only 34% got a freeze, compared with 67% in the bottom quintile. The remaining time I have, which I know is not very much, I want to tell you a little bit about business closure, reentry, and employee recall. So this is going to show you, what this picture is showing you is the share of February employment that has been lost because their firm has shut down. What's a shutdown? You stop paying any of your workers. You can see at its peak in the mid to late part of April, about 6% of February employment was in a firm that had shut down. That has since come down a little bit, and that's come down because some of these shut down firms have started to re-enter a little bit. That's what that dashed line is showing, the share of employment that has returned from a shutdown firm. So about 3% of February's employment is currently employed again in a firm that had previously shut down. This is even more pronounced if you were to look at small firms. That's in the paper. The thing is, though, when firms re-enter, they don't re-enter with all of their employees. This is showing the distribution of re-entering firms' employment relative to their employment in the beginning of February. And you can see that about 95% of firms are entering smaller. The median firm is entering with about 25% of its February levels of employment, and the mean firm about 40%. So there's still a long way to go. Even though some of these firms are coming back, there's a long way for them to go to get back to where they were in February. The complement of this is to look at employment in continuing firms. So this is just plotting the distribution of continuing firms' employment relative to what it was in February. You can see that for the vast majority, about 65% of firms are smaller than they were in the beginning of February. About 10% are the same size, leaving still about 20% or larger. But for most firms, there's still a lot of capacity to grow to get back to employment. Just very quickly, some other results are in the paper, particularly focusing on recall, which I think is very interesting because there's a lot of discussion saying we have to maintain the links between firms and workers. Once they severed, they're very hard to reconstruct. We're finding that of those re-entering firms, about 70% of them are hiring almost exclusively through recall. Employment continuing firms is rebounding as well, and of those continuing firms rebounds, about 85% of the continuing firms that are growing through hiring previously workers that were hired with that firm previously. They're recalling previous workers. I don't really have time to go through a lot of other results we have in the paper, but we do a little bit of work showing that early opening states tend to have a faster rebound but similar decline in particular sectors than did late opening states. Largest declines are the youngest and oldest workers. Business closures disproportionately affecting these low wage workers, and the job creation rate actually did not substantially decline even as the job destruction rate spiked. And we're going to see that in some of the later papers in the program as well. So to conclude, we've seen some unprecedented paid employment declines at the start of the pandemic recession. It's been concentrated amongst low-wage workers, which led to a huge composition effect on the average wage, seeing average wages increasing, even though more base wages and cuts than even in the Great Recession in this period. Firm shutdown's been important. We're seeing some re-entering, but at much smaller capacity than before, and most of the re-entry is coming through recalling employees. So thanks a lot.
Thanks very much, John. I meant to mention at the beginning that speakers get 15 minutes and discussants get 12, and John has done an admirable job in being exactly on schedule. So with that, Arlene, you're up. The next paper is Initial Impacts of the Pandemic on Consumer Behavior, Evidence from Linked Income, Spending, and Savings Data. Arlene Wong will present.
Okay, so hopefully you can all see the screen. Okay, perfect.
You're good.
So thanks so much for the organizers for having us on the program. This paper is joint research with academics and researchers from Princeton University, Chicago, and JP Morgan Chase Institute. So as we've already seen in the previous paper, and as we know from discussion, the pandemic has had a really big impact on the economy. So in the previous paper, we saw that it's had really big effects on job losses, on income, and on the entry of firms. When we look at spending and savings, we also see very large impacts. So what you're seeing here is total spending and the personal savings rate from the BEA. And we've seen dramatic drops in spending from the onset of the pandemic, mirrored with a rise in aggregate savings. So I think a really key question for researchers and policymakers is to understand what are the factors that are driving these enormous aggregate trends. And we've seen lots of things happening. There's been shutdowns, there's been health risks, which all could be contributing towards this. There's been job losses, income, which could be feeding into demand. At the same time, we also know that there's been really large government income support and transfers both to households and to businesses. So we kind of want to understand how important are each of these factors for these trends that we see. What we're going to do in this paper is to explore these linkages between spending, income, and savings at the individual household level to hopefully shed light on some of these stories. So what we're going to do is to look at which factors drive these joint movements in spending and savings. We're going to do this by looking at bank account data at the individual household level. And we think the results that I'm going to show you are really useful for understanding, for example, the causes and dynamics of recessions more generally. And we're also going to touch briefly on what might be some policy implications, especially if we're thinking about fiscal stimulus. So firstly, just to give you a bit of background on the data. The data we're using comes from JP Morgan Chase Institute. This is day-by-day bank account data at the household level for over 8 million customers. This means we have really detailed information on credit and their debit card spending, their transactions. We also have information on their liquid asset balances, their checking accounts. And then from the checking accounts, we can then see the direct deposit inflow. So we can see information on people's labor income, as well as the employer information. Right now, we're still actually processing the data for the current pandemic period. So we're going to focus on splitting some of these spending and savings by pre-pandemic income levels in the industry of employment. But going forward, that's the direct income changes is something we're going to look at in more detail, linking to spending and savings. So some of the key advantages, I think, of the data is that it is going to provide this direct link for each household between their spending, income, and their savings. And so there's been quite a bit of work already using a bit more aggregated data to look at these types of trends. We're going to find some consistent evidence, but we'll be able to do a bit more in the sense that because it is so rich at the household level, we have a range of individual covariates that we can also split the data by and control for confounding effects. The other advantage of the data is it's extremely large in sample size. It has a really big coverage, so it's going to span all 50 states. It also actually has a fairly wide income spectrum of people in the data. So we'll be able to say something about both low income and high income households. Whereas I think a lot of existing data will focus on one end of the distribution, so we'll be able to span the whole spectrum. So using this data, we want to use it to think about how the distribution of spending and savings has evolved. In the previous paper, we just looked at how has job losses evolved during the pandemic. Here, we're going to look at spending and savings. So the first result we have is to look into spending itself. So what you're seeing here is the year-on-year change in spending split by income quartile. So the light blue line is the lowest income quartile, and the dark blue line is the highest income quartile. And this is from the start of the year until end of May. So what we're seeing here is two things. Firstly, in the initial onset of the pandemic, there are extremely large and pervasive initial declines. In our data, it's between 30 to 40% drop in spending. This is across the income distribution. The second thing I want you to take away from this is that from about end of March to mid-April, we see a partial rebound in spending. And what's really interesting is that the recovery has been fastest for the low income households. And so that's our first key result that we see in our data. And this might seem surprising, especially given in the previous paper, we just saw that the job losses were in fact concentrated amongst the low income households. And yet we see their spending being the ones that recover fastest. So I'm going to have a bit more to say about this, about what might be driving some of these heterogeneous patterns. But it is something that we see, we've seen both at zip code level analysis, and here we're seeing it at the household level as well. If we split this by the industry of employment as well, we see similar results. Given this is one of the key things that we see in the spending data, one question that we might have is this really income levels, or is it proxying for the location where people live? For example, we know that high income households generally live in cities. Cities we know have had greater disease burden, more restrictive shutdowns. The short answer to this is no, we don't think it actually is proxying for location. And one of the benefits of our data is that we have a lot of information such as the zip code where people do a lot of their spending. So if we ran some of those plot and those regressions that you saw with and without zip codes, we actually see very similar coefficients. So this is telling us the income, the plots you saw earlier, is not just proxying for location of where they live alone. So that's the first part of the paper. In the second part of the paper, we then looked at the flip side of this, which is savings. And what we see in the data, mirroring the aggregate picture you saw earlier, is that there's been a really dramatic rise in liquid balances, mirroring what we see in the aggregate savings. So this is liquid balances per household in our data. Now this is the average. If we then again look at the heterogeneity, where we split the liquid balance growth rates by income quartile, there are a few things to take away. The first thing to note from here is that there's been a lot stronger growth for low income households. This light blue line has a dramatic rise to almost 25%, which is much bigger than what we see in the growth rate imbalances for high income households. So what is this saying? This is saying that the stronger growth for low income households in their liquid asset balances implies that there's been a reduced liquid wealth inequality that's occurred in a matter of weeks during the pandemic. So these are very striking facts that we see in the data. So we have two key results that you've seen. The first is that there's been a really large and pervasive initial spending decline. It's occurred across the income distribution. The magnitudes are too large, we think, to be explained by job losses alone. If we take the employment numbers and we multiply them by how much spending typically reduces by, it's quite orders of magnitudes larger than what we might expect, which suggests that the initial period, at least the pandemic and the health and shutdown factors, may be quite important. The second thing that we then notice, our key result, is that from about mid-April onwards, when we have a slight recovery in spending, there starts to be very stark divergent patterns by income. Their divergence along two dimensions. Firstly, we've seen spending recover faster for low-income households. At the same time, their liquid asset savings has also grown faster. Now, this may be somewhat surprising, given that we also know these are the groups that had the biggest biggest rises in unemployment. So this leads us naturally to ask the question, what explains these joint patterns in spending and savings, both in the aggregate, but also the cross-section? Now, there are a lot of stories that we can tell related to this. One could be the composition of spending, that these households have, essentials versus non-essentials. We've had a little bit of a look into this, but the numbers are relatively small to explain the magnitudes. Another explanation that we also looked into or thought a bit about is the potential for government income support to be supporting spending, particularly at the low income household. Now, the most direct way to test for this is to trace out the dynamics at a household level of their income losses transfers to their spending. We're still working on processing the chase data on the income changes that occurred during the pandemic, but we do find some suggestive evidence on this front by combining the chase data with publicly available data on income, where we estimate what people's income might be with and without transfers. So what we've done is use CPS data and we estimate what labour income changes would have been with and without transfers. So what you're seeing here is what we estimate to be the income change, excluding transfers. And what we see here is consistent with the previous paper and what's been done in other work. And that is, in the lowest income group, we do indeed see that they had the biggest income drops relative to the top quartile over here. This is also consistent with other work such as Chetty and co-authors that use zip code level data, and there they find that low income workers faced increased unemployment. In part, and their story is in part because higher income households have cut back on spending more in sectors where those workers are employed. And we think that seems like a very reasonable explanation for explaining the incidence of labour market losses, and especially at the beginning, why lower income households had higher unemployment. But we think that, especially moving on into the recovery period, where we start to see divergence in joint spending and savings patterns, it's harder for that explanation to explain all of those patterns. So in particular, what we saw was that we saw this orange line, which is that spending recovered more quickly for the lower income groups. And we also saw that their savings rose more quickly relative to the high income quartiles. And yet, when we look at the raw income data, they're the ones with the lowest income decline. So what's going on? Well, if we re-estimate total income, including transfers to the best of our ability, this is what we see as this dark blue line. And it's now showing a very different picture. Once we add on income support and transfers, we actually now see a positive correlation between spending and total income. So while obviously this is just some correlations, we view this as strong evidence that income support may be supporting spending, particularly at the lower end of the distribution. And so in some of our ongoing work, we're planning to exploit the microdata directly to make more causal statements and try to quantify exactly how important are these transfers for driving the recovery in spending, particularly at the low end of the distribution. So what are some implications? What we've seen is that aggregate spending has partially rebounded, but overall it still remains below pre-pandemic levels. We find some evidence that suggests income support may at least be partially driving some of that spending recovery and savings growth. Given that the income support, a part of that is actually temporary. One of the potential implications of this is that if we phase out the stimulus too quickly, there may be some potential downsides if it leads to declines in income and demand. If we phase out too quickly, there may be the risk that it can transform a supply side recession into potentially a broader one if we have large declines in income and demand. So just some final notes. So one of the things we want to do is going forward is exploit some of the microdata to quantify the role of fiscal transfers and to look at, for example, the role of direct versus indirect spillovers for understanding business cycle dynamics more broadly. So this concludes the presentation. Thanks so much for listening.
Thanks, Arlene. That was very clear, very interesting. Jonathan Parker is our discussant, and while we're making a transition, a question that came up in Q&A has to do about the availability of the papers, and all of the papers are on the conference website. Jonathan?
Good. Okay. So first of all, thank you very much for giving me the opportunity to discuss two great papers, and not thank you so much for giving me 12 minutes to discuss the work of 15 authors, which is less than 45 seconds an author after making this comment. So all I'm going to be able to do, because these papers are full of interesting facts, I'm going to just zero in on sort of the one central thing that jumps out at me here, and then talk about some of the implications more broadly. If I have a little time, which I probably won't, I'll touch base on a few of the more interesting facts, but the authors did a great job of sort of going through each of them, and I can't do in what they did 40 minutes to do in 12. So let me just start with this aggregate graph. So we know a bunch of stuff already from both the media aggregating informally and non-quantitatively, and also from the statistical agencies. These are two great lines: disposable personal income and personal consumption expenditures, seasonally adjusted in annual rates. And their movement between March and April is consistent with the unprecedented use of the word unprecedented throughout this crisis. So the disposable personal income jumps up by about 13%. Personal consumption expenditures falls by a little more than that. The total increase was the personal savings rate jumped more than about 25% to 30% in 1 month. So that's unprecedented. So the green line is about the consumption paper, Natalie Cox et al., and what Arlene talked about. The blue line doesn't look like what John Grigsby just presented. So what's up with that? Well, actually what happened was the government stepped into a labor market catastrophe and sent out $3 trillion, seasonally adjusted at an annual rate, in relief payments. And so if I look instead, if I just subtract off the increase that came from that, which is the increase in personal current transfer receipts from disposable personal income, we get a decline of about 7%. And so what I want to talk about a little bit here is the relationship between the red drop, which is the fundamental decline in income, the green drop, and the government transfer difference, which is the blue line versus the red line. And I think these papers highlight that while we often think about an economic shock coming first through income, leading to a drop in consumption demand, and then potentially there being a government response to raise income, raise consumption, and potentially have a government multiplier, In this recession, it is unprecedented. It's a very different deal. And what has seen so far is almost entirely from the collapse in personal consumption expenditures into the collapse in disposable personal income and employment, which was the first paper, and that there has been some insurance provided by the government transfers, the difference between the red and the blue line. The decline that you see in the red line is not quite consistent with what John Grigsby just presented, or it looks a little smaller. And why is that? Well, because we're actually looking at two different populations here, and that's worth keeping in mind. The consumption data come from, include retirees, public sector workers, those who aren't employed, lots of different population, whereas the employment data covers just those who are employed. But again, that's mostly what lies behind disposable personal income. So the two papers give this picture of aggregate employment spending. The left graph is what John Grigsby went through, and I've drawn in the lines from Arlene's presentation, which are when the national emergency was declared in March, and then when the economic relief payments started being distributed in April. And so what you see is consistent with, I think, what the media figured out. Spending spikes before the national emergency. So we have slight increases in purchases as people stock up. And that precedes the employment decline. And then the employment decline and the consumption decline. Sorry, let me emphasize. So what's the contribution here relative to the media and what the aggregate statistics tell us? Higher frequency, and we can get closer to the present. So they can run this data to really much ahead of where government statistics are. Okay, so what you see then is the employment and consumption really declining together. And then sort of mid-March to mid-April, and then just around the time that the relief payments go out in April, a rebound more in debit card spending than credit card spending, and that I'll touch on a little bit, but that is an interesting question. And so that makes it look like pandemic relief payments are helping to raise consumption some, but certainly not in the credit card spending. So the other key contribution of these papers is the ability to relate the changes to individual level characteristics, to the microdata analysis. And so the thing that jumped out at me in reading both of these papers is that there is very little correlation between the decline in income and the decline in consumptions that we observe. So on the left is the paper by wage quintile in employment. And so what you see there is that the low wage workers, quintile 1, had massive declines in employment relative to the high wage workers. And it's monotone across wage groups. And there's really a huge difference. One of them is down 5%, one of them dropped by nearly 40%. On the right side, this is the credit card data. There's not much difference in spending declines. And in fact, the high income folks, which is the red line at the bottom, saw the larger declines. And this is true also, the larger declines in the debit card data. There's more of a rebound and less of an overall decline, but the ranking is the same. So it's exactly backwards from what we would have expected. The ones usually you think the people with the biggest income declines have the biggest consumption declines. In fact, it's the reverse. And so that's a key piece of evidence telling me that all of this is happening from the consumption side to the demand side. My story is the consumption decline that they work through and document is coming from people cutting back on the things that will infect or cause problems. And so the high wealth people are consuming more hotels, fancy restaurants, travel, and they have larger budget shares of the things that we stopped consuming or shut down and stopped producing. And so their consumption fell by more. Then that was less true for the lower income folks. They're consuming more necessities and essential goods. And so you see their consumption falling by more. And then on the flip side, the workforce is distributed differently. The workers who are in contact with people who are doing labor and touching and can't work on Zoom have a large decline in employment, and those who can have a small decline. And so that's sort of going in. And then there's interesting stuff about the recovery. So let me come back to that. But let me also just highlight that we see the same patterns by industry. We can now think about the industries and categorize them by what we think are likely to be pandemic affected and what aren't. And the huge employment declines happen where there's large demands in decline. On the right is not the consumption of those goods, it's the industry that the person worked in and their consumption. So we see the declines in credit card spending really uniform across wherever people work in whatever industry. In debit card spending, this time I've dropped them both in there, there's a little more difference. And there's actually some industries, grocery, drugstore, and discount store, who are working like crazy, spending more money. Potentially some of that is work-related expenses, gas for driving and delivering groceries, for example, if that's what you're picking up and doing, going to work more, etc. So what you see is no relationship between the cross-industry pattern of declines in income and the cross-industry patterns decline in consumption. They're coming from something else. So what you see is that the insurance provided by the government and other, meaning, and I don't have much time to say about other, but people who have been able to stabilize their consumption, because why? Because it's all dropped due to a choice not to consume a set of different goods. That lower need for consumption has made it possible for everyone to drop similarly, despite some of them having big income declines. Those income declines haven't yet fed into big consumption declines. And that's a concern going forward, but at the moment, the government assistance has been massive, emphasized by my first slide, and that's maintaining everybody's consumption. Let me poke a few concerns at the papers, because that's part of a discussant's job. And Jim, I forgot to set my timer. If you just wave at me when I'm like 1 minute out, that would be useful. So first of all, there's an issue in each paper with the populations we're looking at and what we're observing. So in the consumption paper, we're a little bit concerned about what's going on with cash and checks versus credit card and debit card swipes. And that shows up in the difference between credit and debit cards. It could easily be that low-wage workers are having bigger declines in consumption, but they're doing less spending of cash and more spending on debit cards. And that compositional shift is part of what's making it look like their consumption didn't fall as much. That's a little bit of a concern. And this is just a picture for some industry research, which got out there early with what was going on the card data. And it shows that basically what we kind of think that the amount of purchases done in cards on online shopping has gone way up and in-person way down. And so if in-person was sometimes cash, you'd think that there's a bunch of transfers now, that consumption we observed that we didn't observe before. On the worker and employment paper, you might be a little concerned about movement in and out of ADP, this data processor, the payroll processor. So if, for example, I'm taking my business offline for a little while and it's a small business, I might stop paying ADP to process payroll. And I might think, okay, I'll deal with this later. And when I come online, I might not be sure how long it's going to take. I might not set that up again. I don't know if that's a big deal or a small deal. It could be that the workforce more generally is moving out of ADP covered businesses. I expect that's not a big deal, but it's probably something worth I'm discussing. I'm supposed to raise some concerns. There's also just a question of the representativeness when you're looking at these large proprietary data sets. I think that makes the analysis of averages a little less interesting, but the averages of all the individual level effects, which I think is the really great advantage of both of these papers, is it's less of a concern for, because there you're worried just about heterogeneity in the relationship between individual levels, variables, and slopes. And there, if there isn't much heterogeneity in the relationship across people you do observe, you can argue it's probably not such a big deal that you're missing some people. It's not certain. I want to raise one little concern about all that BPEA is doing in these papers, which is that one of the contributions, usually academics is known to being slow, reliable, and getting it right. And sometimes we do rush in and do things initially. And initially, for example, in the financial crisis, we did that. And we bought into the analysis of the media that the subprime crisis somehow caused the financial crisis and the Great Recession. And it took a lot of time and effort to back that out and get it right. And we are now instead stepping into the world of the media and bank research departments and chief economists, and we're bringing a lot of skills and hopefully making that work faster, better, and stronger. But we're also trading in a little bit on our reputation for being slow, steady, and right. And we're laying down narratives with partial information and quickly. And so I do worry a little bit that we should be cautious, that we should cite as existing literature things like newspaper articles that have less representative samples, but are laying down the stories that we're using to define and interpret the data. And that we should be very cautious in drawing strong conclusions. That said, there's some really neat facts in these papers. So let me go ahead and draw some conclusions. Okay, so let me draw some conclusions. So consumption decline appears largely by choice. And we believe that some consumption and employment declines are indeed socially optimal. Therefore, I think there is not need for stimulus now. And we see that in the data in these papers, in that the economic impact payments have raised balances a lot on average across people, and consumption has declined nonetheless. We don't want stimulus. We don't want extra supermarket and Netflix spending. Supermarkets and Netflix are operating at capacity. But we need insurance. The economic relief payments have been critical and they've been sufficient. And the data show that for most people, again, there may be holes, this has been really good. And so they're gone. Liquidity will be run out for these low-income households. And I'm wondering, is UI now sufficiently stepping into that role? Is the coverage wide enough? And like, there's a set of questions there that we'll need to think about, and this data will both be very useful for thinking about that. And then the third is we will need stimulus once we want to open. Once the supply shock that we've had so far, movie theaters aren't producing anymore and they're not productive, becomes a demand shock. And at that point, we will need stimulus. And then a fourth bullet, which is something I didn't get to talk about. One of the neat things in the employment paper that John Grigsby went through is that there's an enormous number of wage changes, cuts, and some raises. And given the enormity of the shock, the word unprecedented again comes to mind, maybe wages and prices are more flexible now. Maybe the macro dynamics actually are going to be a little bit different. And there's some evidence of that already in the Grigsby paper on the recalls and the hiring size. And the final point is just the small business concern. So we see clearly on the employment paper that small businesses are getting hit much harder than large businesses. If they disappear, there's no evidence in the paper that PPP is giving much help. And if a lot of small businesses are knocked out, then that's another hindrance to our economic recovery because we're likely to have more concentrated industries, more big firm dominance, and lost output due to higher markups for a long time. Thank you, Jim.
Thank you, Jonathan. I'm going to open it up to floor discussions. So let me see if I can do this. I have Adriana Kugler, and I think I've unmuted you.
Hi, this is Adriana Kugler from Georgetown University. So I really enjoyed these two papers. I guess Jonathan covered some of the questions I had, but I wanted to dive a little deeper into some of those questions. I think I really enjoyed what Erlene did with the relief payments and trying to simulate government transfers. I thought the paper by John Grigsby and co-authors could definitely also do something similar, especially with the PPP. So the payroll protection program would help to explain a little bit of what happened with the decline and the recovery by firm size. And it would also help to explain the rapid increase with recalls as opposed to new hires. So I think that would be definitely very interesting to dive into, in particular, kind of, taking advantage of the timing of the CARES Act, but also the implementation throughout states and access to credit for small businesses to different banks around the country. And then the one thing I guess I was a little concerned about when you explain your differences between women and men is that typically women have been in these recession-proof sectors, health and education. But if you dive a lot deeper into health and education, a lot of those losses, for example, in health, obviously have not been in hospital care, but instead they have been in nursing homes, they have been in dental and medical offices and doctor offices. The same in education, it has not been in the K-12 system necessarily, but it has been in pre-K and in childcare. So I was wondering if you look deeper into a 3-digit industry as opposed to 2-digit or 1-digit, I'm not sure what you were doing, if you would be able to explain that a little bit more, the same in terms of occupations. And in terms of Arlene's work, I also was wondering if you, I'm not sure you went through this fairly quickly because you have limited time, but I was wondering if you can exploit a bit more the pandemic unemployment assistance and the relief transfers by state again, because different states have had very different speeds of implementation of the PUA. And also do it by types of workers, because there were some workers who all of a sudden in some states qualified for unemployment assistance, whereas in other states they did not qualify. So you could exploit a lot more of that variation, which I'm not sure you were doing right now. The same in terms of the timing, because the timing varied very much. Some states had a lot better infrastructure and workforces to work in terms of kind of spreading out the unemployment insurance assistance. So those are my main two questions. I think it is very important to emphasize the role of the CARES Act and the role of policy generally in the two papers. So thank you very much.
Hey, thanks. Olivia Blanchard.
Good. Just a short question. And the most striking fact, which I think none of us anticipated, is the increase in saving of a top quintile, the rich, right? And the question is, looking forward, what is your best guess? I mean, this is a question to the authors and to the discussion. What is your best guess as to what's going to happen to the consumption behavior of the rich?
Claudia Sam. Claudia, are you there? Claudia, we can't hear you. If you put your question in chat, then I'll be able to convey it. Okay, I'm going to have to move on. Hillary Hoynes.
Hi, thank you. Some of this went in the Q&A chat, but just to raise it for the discussion, the results are very compelling in terms of bringing in differences across groups, and I commend both papers for really trying to get at levels of heterogeneity that I think are really important. But I think it is worth pointing out, maybe particularly in the second paper, about who is going to be left out of that analysis and the representativeness for the most disadvantaged Americans, given the very high rates of unbanked among some groups, and the fact that even the lowest income quartile, the authors cut off, as Peter mentioned in the chat, at $12,000 and above. So, you know, I was thinking about Jonathan's last comment about let's make sure we don't get out ahead of our skis on drawing conclusions. And as a little bit of a promo for the paper in the next session, I think we have some pretty strong evidence that there's some folks out there that are really hurting. And I think one should be careful to draw conclusions about the poorest Americans by looking at the very stunning results that are very compelling in both papers. Thank you very much.
David Wilcox.
Two comments or questions building off of Hillary Hoynes' observations. First of all, thank you for two fantastically interesting papers. I'm wondering whether, particularly in the second paper, you have any evidence on specific measures of distress for these households. For example, potential delinquencies on a rent or mortgage. It seems a little premature from the increasing saving rate to jump to a conclusion that there's not real financial distress. And then secondly, in both cases, particularly in this moment when we know that communities of color are being adversely affected by so many forces in a more virulent manner than majority communities, I'm wondering whether there's any capacity for expanding the reporting of results by race and ethnicity. That could provide some very interesting insight. Thank you.
Daron Acemoglu.
Yeah, First of all, congratulations to both sets of authors for these great papers. Just a quick question suggestion for the second Arlene's team. It would be interesting to see how much of the differences across quintiles can be explained by a simple shift share composition analysis, since your data would enable that. You know, some types of consumption are going to decline more because of the social distancing, and you know, those account for very different compositions across different groups. And that would be sort of relevant for understanding what will happen once the economy starts recovering in terms of the personal savings rate and increased consumption. I don't know, perhaps you've already done that, but it will be useful to do and see that. Thanks.
Thanks. I'm going to read, I'm going to excerpt from Claudia Sam's comment, which came in the chat, which basically, just to summarize it, she says she disagrees strongly with Jonathan Parker's view that the economists should kind of sit around and just watch what's going on and then think about it deeply, that we got a crisis on our hand and we got to get to work. And I have some sympathy with that, I have to say. Wendy Edelberg might share that view. Wendy?
Can you hear me?
Yes.
Wonderful. So yes, I of course I share that view, but I also share Jonathan's concern about jumping to conclusions. So I agree with everyone. So if one didn't pay too much attention to levels and you just thought about how much consumption was moving for low income workers relative to high income workers, you might come away with a conclusion that consumption for low-income households was not very much affected by what was happening to their incomes relative to consumption for high-income households, which, you know, it sort of upends what we generally think about marginal propensities to consume. Now, that of course, I started by saying we'd have to ignore levels. So going back to then how much consumption actually did fall for low income folks, what can we learn about marginal propensities to consume and thinking about policies going forward? Are these still folks who, if we gave them more money, would spend a large fraction of it? That's my question.
Hey, thanks. Unfortunately, I only have time for one more question. So Alessandro Rabucci.
Good morning, great papers, very quick. I'm wondering whether for both papers it's possible to use industry information to speak to the breakdown between services and goods. We know that services have been affected more, and here I think is important to try to think about the drivers of the saving behavior. Are we seeing evidence of precautionary behavior as opposed to high-income household that they can't travel, they have to cancel vacation, and so on and so forth? The policy implications are very different.
Okay, thanks. We're going to go back to the authors. So authors of the first paper, you're up.
Okay, this is Ryan Decker. I'm going to handle the questions for us if I can. Let me first just make a comment that I think we very much appreciate the discussion by Jonathan, wonderful points and things that, of course, we'll think about going forward. I'll say one thing about it, which relates to Claudia's comment about we sort of do feel like we're really we've been in a hurry to get analysis out, and that does have costs. But I'll also say we've been working with the ADP data for years. So I think our first paper we put out was in 2018. We looked in depth at things like industry representation, even pay frequency representation. And we've all put out several papers since then. And so we have a paper coming out in an MBR conference volume this year that got quite a lot of eyes on it in terms of academic pushback. So it is always, it's not without cost to do this. But on the other hand, we feel like we do know a lot about the data. And so we're sort of ready for a moment like this. And I'll also just thank David Wilcox, who made a comment, who inside the board really pushed us to think about these kinds of data for the last few years. And that's part of why we are where we are. There were some comments about PPP, the Paycheck Protection Program. We don't look at that specifically in this paper. There is some other work. David Autor, Leland Crane, and a big team of co-authors have a paper on PPP. It's actually being presented today in an ADP conference. And they're actually finding some interesting results and some interesting differences between small and larger businesses. And so there certainly is a lot of promise for policy analysis with these data. And I guess just a couple other scattered comments. We do have pretty good industry coverage across industries. When we think about these questions about the women versus men in different industries. Now we can't see occupation, but we were able to look and control for detailed industries. And we still find that much of the difference is existing even within detailed industries. And I think that that catches the main questions that I got. So
That's,
hand it off.
That's great. I think that we're going to need to, we could keep going for a long time. This is an enormous amount of work by a large team that's very careful. But on the other hand, we need to move on to the second paper's response. So second team.
Thanks. This is Peter speaking. Can you hear me okay?
Yes.
All right. So I'm going to try, if I'm allowed, to share one plot, because that plot is the virtually all of the questions have centered on that plot. It's not working. I'm having some issues with screen share. I'll just voice over. So the plot I have in mind that I'm going to talk about a little bit is figure 16, which is the bar plot that shows the changes in debit card spending, income without transfers, and income with transfers. If one of the other co-authors wants to share it, feel free to pull it up. Thank you, Arlene. That's great. So there are several questions, all of which can be answered through the lens of this plot. So the first question is, who's on the plot? And so we are using bank account data. Estimates of what fraction of Americans have bank accounts vary from 90 to 95%. So most Americans do, but some Americans, especially low-income ones, don't. So they're by definition not on the plot. Further, we require that you have at least $12,000 of labor income just to be in the sample at all. And I think we could have said that in the talk, and I just want to be very clear about that now. If you are earning less than $1,000 per month pre-COVID, you're not on this plot. The bottom quartile, to just focus on one specific group, is people whose annual labor income post-tax is between $12,000 and $24,000. So we are talking about households that are relatively low income, but are not the lowest income. The second question is, beyond how do you get into this plot, how do you calculate income changes for this plot? And in particular, what are we assuming about UI receipt, and what are we assuming about stimulus? So for stimulus, not all of the checks have gone out, but nearly all of them have gone out. So I don't think that's like a big source of uncertainty. A bigger source of uncertainty is states have been very slow to process UI claims and very slow to issue UI payments. And so I want to be clear, this plot does not assume that all unemployed are receiving UI. Rather, we are deliberately using the numbers from the Department of Labor about how many UI dollars have paid out to infer what fraction of the unemployed are getting UI. And so in the context of our simulation, that's on the order of 50% in April and on the order of 75% in May. So there's a lot of UI dollars going out the door. Going forward, UI dollars are going to be even larger than what the stimulus dollars were. But we're specifically targeting administrative data here rather than just assuming that all the unemployed are getting UI. And then the final sort of class of question is, what about heterogeneity? You know, we're saying that for people who are earning labor income between $12,000 and $24,000 a year, that their average spending is constant. But I want to emphasize that doesn't mean that everyone's spending is constant. It means that some people are up and some people are down. That's the definition of the average summing to zero. And so there was a question in particular from David Wilcox, and then a question also in the chat. Maybe it looks like someone answered it now, about rent or mortgage delinquency. So just a brief advertisement that JP Morgan Chase Institute is actively working to try to understand mortgage delinquency. And so that's not in this line of research, but I do anticipate that it will be in future research. I think that's about, I think I'm out of time, and I've tried to answer the big class of questions around income distribution and income receipt. And then I think my co-authors are going to try to answer some of the other questions that came up in the chat. The last thing I want to say is thank you so much, Jonathan, for taking the time to put together a really careful and incisive discussion. We really appreciate your comments.
Okay, thanks. That was great. So thank you everybody for such a great session and for being so prompt. So we're going to switch now directly to the second session. We're going to do a little bit of shuffling in terms of who's up on Zoom. So this might take a couple of minutes, but as soon as we're all set, we'll get going.
And if you're in the next session, it'll be helpful for me if you can raise your hand, and then I can just make you a panelist. Thank you, everybody. So, Jim, as soon as you start your camera, you can go ahead and start your presentation.
Okay, so first presentation, first paper is with Jim Sullivan, and so go ahead.
Great, thank you. This is joint work with Ji-Hoon Han and Bruce Meyer at the University of Chicago, and we'd like to thank Jim and Jan and Justin for including us in this very important conference. While we're thanking people, let me see if I can, for some reason I can't advance my slides right now. While we're thanking people, we should thank our funders. The National Science Foundation provided support for this, as well as the Wilson Sheehan Lab for Economic Opportunities at Notre Dame, and several foundations that support the Comprehensive Income Dataset Project at the University of Chicago. As motivation for this project, I wanted to quickly describe some quite sudden and significant changes that have occurred, many of which have already been discussed in the first session, but we've obviously seen a sharp decline in economic activity in recent months. If you just look at what's happened to employment as reported by the monthly CPS, you can see this sharp decline. In April, the decline of 14% is the largest decline on record. At the same time, we've seen an unprecedented government response. Just as one example, one of the largest programs was the stimulus payments or the economic impact payments. They provide $1,200 to individuals with income below $75,000 of income, and $2,400 to married couples below $150,000, plus $500 for each kid. Since April 1st, we've given out over 159 million payments and totaling more than $257 billion. In addition, there's been a somewhat dramatic expansion in unemployment insurance. This is increases in claims for regular UI, as well as the PUA program, or Pandemic Unemployment Assistance, which is expansion in the eligibility of UI to those who might otherwise not be eligible, like the self-employed, gig economy workers, et cetera. And if you look at the initial claims, just in recent months, since mid-March, we've had more than 49 million claims for unemployment insurance. So this program has expanded considerably as well. Taken together, it's natural to ask the question, what is the net effect of these dramatic disruptions on family income? And the problem with answering that question is we don't get household survey data on income until September of 2021, at least for the official source of income statistics and poverty statistics, the annual and social economic supplement to the CPS. We don't get that until really it's too late to inform policymakers and key policy decisions. We do get a lot of, as we've already seen, a lot of information on aggregate or using administrative data, but it's important to have near real-time information on questions like what is the impact of the pandemic on the poor and other parts of the income distribution, and are some demographic groups disproportionately affected? And the survey data are going to help us go a long ways towards addressing these kinds of questions. So what we do is we use family income as measured in the monthly CPS. And this is on that survey, which is our source of the monthly unemployment statistics. They also ask a question about, it's a global question of total cash income from all sources, from all members of the family over the past 12 months. And what we do is take that measure of 12 months of income and compare it to the official poverty threshold for that family of a particular size and composition. And we construct poverty estimates before and after the start of the pandemic. In addition to looking at poverty, it's important to look at other further up the income distribution. So we examine several different percentiles further up the distribution. And we consider the contribution that the key government programs played on the results that we will show you. So even though we're on Zoom, I have a sense I can read your minds on what you're thinking, and you're probably asking, wait, aren't these the consumption guys? And it's true that in a series of papers, we have argued that consumption is a better measure of well-being than income at the bottom. But to be clear, we've never said you shouldn't look at income. We think both income and consumption are important, and perhaps consumption doesn't get the attention that it deserves. And it is true that there are concerns about underreporting of income, and those concerns remain. In past work, we've shown that that's particularly important when looking at long-term changes in economic well-being. It's less clear how critical that is for the very short-term changes, the month-to-month changes that we're considering in this paper. So before I show you what we actually find, I think it's helpful to think about what we would expect to find given that current environment that I showed you. So I'm going to do this by way of three particular examples. So three scenarios. In all of these scenarios, think of a family of four with just one worker, and their earnings accounts for all of family income. And then for each of these scenarios, the worker experiences an unemployment spell at the very beginning of April, and following that collects the stimulus payment and unemployment insurance. And so the difference across the three scenarios are the different pre-separation income levels. I'll show you what happens for somebody at the 60 percentile of the poverty line. That's about working at the minimum wage full-time, full year, as well as a family pre-separation income at 75% of the federal poverty line and 90% of the federal poverty line. So if you look at what happens in April they receive the economic impact payments. They also receive unemployment insurance, which we're specifying as half of pre-separation earnings. And they also receive PUC. Now, PUC is pandemic unemployment compensation. That's the $600 top off per week in unemployment insurance payments. If you couple these different payments together, it's more than 5 times pre-separation monthly income for that family at 60% of the poverty line. So some people have said, well, instead of looking at 12-month income compared to poverty, you should be looking at monthly poverty rates. If we did that, given the size of these transfers, nobody would be poor. But because we're looking at a 12-month window, it includes these payments as well as the prior 11 months, where they were below the poverty line. By the time you look at May, where they no longer have the economic impact payments in that month in May, but it's still in their 12-month window, they're still receiving the $600 bonus per week plus unemployment insurance. That exceeds their pre-separation earnings, so income is rising. What you can see in May is that for really up to about any family that pre-separation was within 70% of the federal poverty line would be lifted above poverty under this scenario. When the PUC payments are due to expire at the end of July, now monthly income is below the pre-separation level. Incomes are falling, but because we're looking at a 12-month window, they're still above the poverty line for a reasonable stretch. And then you see incomes fall sharply as the economic impact payment falls out of the window. And the key takeaway here is, given the way we measure poverty, it's reasonable to expect that these federal programs could have a very significant effect at lifting a number of families above the poverty line. Now, before I show you results, let's do a little bit of benchmarking on the monthly CPS income. Because it's not widely used, it's helpful to see how does it compare to other income sources that we think are reasonably high quality and have been used in a large amount of economic research on income. So if you estimate poverty rates in the ASEC, the Annual Social and Economic Survey, in the CPS, that's the official source of poverty statistics in the US, and compare it to our estimates from the monthly CPS, what you see is that the poverty rates, well, let me make 2 points. One is that the level of poverty in the monthly CPS is higher, which suggests that the global income question is capturing less income than is the ASEC, which asks about 25 specific components of income. The second point, though, is that the changes over time are fairly consistent, that we see the rises and falls in poverty in both sources. If we were to turn to another source of income, the Consumer Expenditure Survey, that asks income on a quarterly basis using a 12-month reference period, the levels and changes line up really closely. So together, this gives us some degree of confidence that what we're measuring with income in the monthly CPS is quite consistent with other sources that have been used much more frequently. Okay, all that leads up to what we find. What I report, our main results here for poverty in the 25th percentile, I report the estimates of poverty using the monthly CPS for 2020, for the months that we have data. And what you see, if you combine January and February estimates and compare it to April and May, we see a decline as reported in the far right column of 2.3 percentage points, or just over 20%. And that difference is statistically significant. As we look further up the distribution, here I show you the 25th percentile scaled to a family of 4. What we find is between those two periods, an increase of about 11% to $5,000 at the 25th percentile. We looked further up the distribution and we see increases, evidence of increases in income through the 75th percentile, although the rises decline as we move up the income distribution. In addition, we looked at differences across many different demographic groups, as well as across states based on their experience with COVID-related deaths and their policies. And I report the change from the pre-period to the post-period here. And a couple of points to make here is that one, we really see evidence of a decline in poverty across many different demographic groups. You might point out that it looks like the other race group is experiencing more of a decline, say, than either Blacks or whites. The other race group is majority is Asian. And that is true, but we did look and we can't reject the hypothesis that any of these declines are the same across the subgroups. So we don't have enough precision to say those things definitively. And it also doesn't look like there are noticeable differences across states, whether you split them by death rates or various policies. So I think it's important to think about the role that government policy played here. So we're going to do something that's a little similar to what you saw earlier. What I'm reporting here in the green bars is the poverty rates for January and May that you saw earlier. I've blown this up not to exaggerate our differences, but so that you can see the actual changes. And then the blue bars are counterfactual estimates for poverty in May. And it turns out in the monthly CPS, we have really good data on whom is likely to receive these payments. So we impute economic impact payments in UI. We have information on family size and composition and whether or not they're unemployed. And when we look at the total sum of our imputed values, they match the government aggregates really closely. And quickly, what this shows is that we've seen, if you take out all of the government programs in the first blue bar, Those programs combined explain more than all of the decline in poverty that we find. Poverty would have risen slightly if we excluded those programs. And amongst the programs, the one that had the largest effect was the economic impact payments, where you see if you take out the economic impact payments, it really cuts down the decline in poverty that we find. The economic impact payments explain more than half of the decline that we find, with the other half being accounted for by UI programs, either combined all, and then here we show just the ones that were new as a result of the CARES Act. So taking all of this, we should probably put it in the context of some other evidence, and this includes evidence that we've seen just in the last session. But as you saw in some of the figures in the last session, disposable income grew significantly in April. We don't have the May numbers yet. So that's consistent with the rise in income we're finding from the survey data. But what we're showing is that it's not necessarily isolated at the top of the distribution. We're seeing rises at the bottom as well. Also, there's evidence on spending behavior that's already been talked about. If you look at credit records, there's an initial, although initial decline, that we see a rebound, especially for low-income zip codes. And then, as we just saw, the microdata for low-income households show a rebound in spending and a large increase in savings, and particularly for low-income households. And moreover, this early spending decline cannot be entirely explained by labor market disruptions. What coupled with our evidence suggests is that the spending decline is not because of a decline in income. It's also, we want to put this in the context of other evidence on economic hardship or economic well-being, and there's some evidence that hardship has increased, and you're going to hear more about that momentarily. But we should emphasize that we don't think that that evidence is inconsistent with necessarily with what we're finding. I think both could be true. So to kind of wrap that up and elaborate on that, it's really good news to know that poverty, or to find out that poverty has not fallen, has not risen, that it in fact has fallen, and that incomes have risen. But it's important to caveat that this is a very short-run finding, and as I showed earlier, this could actually change as we move further on post-pandemic. It's also important to point out that increase in income don't address all the challenges that people face, and so we don't want to necessarily say that people are better off. There are important health concerns and concerns about disruptions in social interactions, as people can't go out and interact with others, or it's more challenging. And there are real concerns about the future, and for that perhaps explains at least some of the declines in spending that we're seeing. And so this asks the important question of well, what's going to happen over a longer period of time? And although I can't tell you that now, the good news is that the monthly CPS is available, new data becomes available every month. And so in 3 weeks, we will give you an update to what we find, and hopefully that'll provide a clearer picture of the economic impact of the pandemic.
Thanks, Jim. That was very clear. The next paper is by going to be presented by Diane Schanzenbach, Social Safety Net in the Wake of COVID-19.
Fantastic. Thank you so much. Today, I'll summarize our work joint with Marion Bittler and Hillary Hoynes on how the social safety net for low-income families in the U.S. is responding during the COVID-19 crisis. Of course, in response to the unprecedented COVID-19 shock, Congress has greatly increased spending to individuals, with over $400 billion paid cumulatively to families out by June 19th, according to the daily Treasury statements. So relief payments, here shown in green, make up a little less than half of the total and started in mid to late April. UI expansions in orange make up about 51% of that total new spending. This includes regular UI payments, the $600 weekly top-up, and then also the payments through this new PUA program that extends benefits to workers who are self-employed or have little work history. These UI payments, as you can see in orange, have steadily increased across the weeks. The 2% of the increased payments in blue have run through the Department of Agriculture. This includes normal increases in SNAP participation that we see during economic downturns. It also includes a new provision that raises all payments to the minimum benefit level, and that impacts 60% of caseloads and brings in another $160 in those families per month. And also flowing through this line is a new program called the Pandemic EBT program, which provides food benefits for families who lost access to free or reduced price meals when their schools closed. Despite these payments, measures of distress are very elevated. In this graph, we monitor food insecurity, which is a survey measure designed to assess whether families have enough money to support adequate food consumption. In normal times, it's measured with a battery of questions asking respondents to what extent they agree with statements such as this: our food just didn't last and we didn't have enough money to get more. Or to what extent households report that adults or children skipped meals, cut size of meals, or went for a day without eating, specifically because there wasn't enough money for food. Subsets of these questions have been asked in both the Census Household Pulse Survey and the COVID Impact Survey, which allow us to monitor it in real time. In companion work that we describe in our paper, we assess how to make the old and new surveys as comparable as possible, and you see our preferred method here. In general, in the annual time series that we show here back to 2012, you can see there are two downward sloping lines that hover around 10%, orange for households with children and blue overall. Since food insecurity is an economic measure, of course it varies with the unemployment rate. And so using that relationship, we can project food insecurity out to February 2020 at the economy's peak, shown here in the square markers. Food insecurity was 8.5% overall and 9.4% among households with kids. During COVID-19, surveys indicate that food insecurity has doubled overall to 23%, and almost all of this increase can be explained by the increase in the unemployment rate after adjusting for misclassification. Food insecurity has also tripled among families with children who've been hit harder across many dimensions. Many are in single mother families, and they certainly lost school meals. Other measures of economic distress are also dramatically elevated. On the left here, we show rates of receiving food in an emergency food pantry, and those have spiked. This is consistent with reports from Feeding America, which is the umbrella organization of food pantries, whose members have reported a near doubling in numbers served each month. On the right are measures of mental health distress, such as feeling down, depressed, or hopeless, or nervous, anxious, or worried. And these rates have doubled relative to the last pre-COVID comparable study. Of course, this raises the question, why do we see so much need despite so much spending? And we think there's three reasons. The first is the timing of payments have been delayed. The second is outside of unemployment insurance, the magnitude of these payments has been relatively modest. And third, we'll show you that we think that there's evidence that we should be concerned about potential lack of coverage. So to start, thinking about timing, many of these payments came with delays, in part because they came with setting up new programs. For PUA, which is the new unemployment insurance payments that go to workers who are self-employed or who fail the work history test, and these are likely serving disproportionately low-income workers that we're interested in here, by May 1st, states representing just over half of the workforce had paid any PUA continuing claims. At the beginning of June, still over 10% of the population lived in states that hadn't made any payments. On the right, the new PBEBT program was quicker to pay families already on SNAP, but it was slow overall. By May 1st, we estimate that only 10% of payments had been dispersed. It's of course important to remind you that many families, especially low-income ones, lack savings and access to credit. So these delays in payments will understandably come with real hardship. But despite the suffering, also note that when the payments are eventually made, this is going to make them whole in terms of the annual poverty measure, which treats income today as the same as income with a 3-month delay, as long as it's in the same calendar year. Indeed, it is perfectly consistent to see both increased need and little change in poverty rates. So second, we must frankly praise Congress for taking action to quickly disperse increased money through SNAP. This happened much faster as measured by months since the business cycle peak during COVID, as illustrated here by the solid lines, than the Great Recession, which is illustrated by the dotted lines. These benefits, though, are relatively modest to individual households, about $40 a week, and they only went to the subset of current SNAP participants who are already relatively better off. So next, we're concerned that many low-income unemployed are not getting unemployment insurance. And I am very much aware that this statement is going to go against some very strongly held priors of many of you. So let me walk through the evidence of why we think this might be cause for concern. So here is step one. Many low-income workers are usually ineligible for unemployment insurance. Some of this was relaxed by the CARES Act, which I'll discuss next. This graph shows simulated usual UI eligibility in 2019 for all workers in blue and those earning below poverty in yellow. Normally, fewer low-income workers are eligible for UI. You can see here it's 63%. On the other side of the graph, 14% of these low-income workers are ineligible because they're undocumented, and that's been left unchanged during this crisis. 17% of low-income workers are usually ineligible due to failing the work history test. These are individuals with uneven earnings and spotty employment histories. 7% are ineligible due to being self-employed. So this combined 24% of low-income workers, highlighted in the orange box, may have seen their UI eligibility increase due to the CARES Act under the new PUA program. The second piece of evidence is that there is usually a gradient in UI receipt by education level. This graph shows the receipt of UI among the short-term unemployed at the trough of the Great Recession. About 30% of unemployed workers with a low education level received UI, compared to about half of the workers with high levels of education. So now we can come to the contemporaneous survey data from the COVID impact survey, which was collected at the beginning of June. This shows reported UI receipt in the prior week among furloughed workers by education level. At the beginning of June, fewer workers with low education report receiving UI. Some of you might find these levels shocking, but we're particularly interested in the evidence on the gradient here. So to be sure, like all data, this survey is not perfect. There's a modest sample size, the questions have limitations, which we discuss in the paper, and the response rate is low. And this is absolutely true for all the survey results that we report throughout this paper that were collected during the COVID-19 era. Now that stated, there are many aspects of the data that line up with our expectations. For example, as shown here, more furloughed workers report receiving UI over time across survey weeks, which is consistent with our expectations as state backlogs clear. Also, unemployed workers receiving UI report having lower rates of food insecurity, which also lines up with my priors. What we'd like to do is turn to more data sources, in particular administrative data during this time period. Regrettably, timely administrative data that break down receipt by income or education level are extremely hard to come by right now. The single exception we've found is from the California Policy Lab's regular reports on the UI administrative data from California. This is one piece of administrative evidence available. This is the only one we found by education group. And it shows the share of initial claims paid from March 15th through May 9th. A lower share of initial claims made by those with low education end up being paid. Next, we can look at administrative data on continuing claims, which we have not been able to disaggregate by income or education level. This also suggests incomplete coverage. 50% of the adjusted unemployment level in April is covered by UI continuing claims, and just over 60% in May. In sum, we read the whole of the evidence as raising legitimate concerns that UI is not, or maybe not yet, reaching as many unemployed workers with low income or low education levels. Time will tell if expansions to the PUA system will help, but it's very important and needs continued monitoring as more data become available. So taking a step back and moving to the conclusion, we need to make a broader point that we develop more in the paper, which is we have moved in the last 25 years to a work-based safety net that focuses on boosting low wages and rewarding work. But there is little in the current safety net that is automatically countercyclical. We have built a safety net that works for us in good times, but not for bad ones. It needs policy attention to expand it even during normal economic downturns, let alone this one. So what do we recommend doing? Well, first, we think that there's evidence that great need persists despite the heroic actions that have been taken already. The evidence is imperfect for sure, but given what we know from the literature about the long-term impacts on children being exposed to commonplace economic shocks, we think that overreacting here will surely be less costly than underreacting. And things will be absolutely worse if we let the current policies expire. So what to do with SNAP? Because of limitations in the broader safety net, we currently are asking SNAP to do much more during recessions. Of course, there's a limit to how much we can do through SNAP because of its limited fungibility, but we think we can surely provide more right now. We think that moving everyone to receiving the maximum benefits, which is worth about $170 per person per month, was a really smart move by Congress, and that should be extended at least until we're out of the worst of this recession. Maximum benefits should also be extended by at least 15% across the board. And this, we argue, is good policy in every recession. We also think we should keep paying out these PEBT benefits to families with kids on school meals over the summer because it serves a broader group than those just receiving SNAP. It's going to provide liquidity and protection over the summer, but importantly, it also means if we're shutting down schools again in the fall, the program will remain in place. Finally, regular UI payments just won't be enough in many states when the $600 go away, and we endorse the proposal by Jason Furman and co-authors last week to continue a $200 subsidy. Further, it is extremely important to understand, to continue and to monitor and understand to what extent UI is serving disadvantaged workers. We may need to make more payments outside of the UI system made if people are falling through these cracks. Potentially relief payments that are more targeted than the first round of relief. And we've got some thoughts on how to do that targeting. And certainly when everything has calmed down a bit, we need to more carefully assess structural reforms to the UI system so we can provide better insurance to low-income workers, which will be key to sustaining a work-based safety net during normal economic recessions. Thanks.
Thanks very much. Our discussant for both papers is Abby Wozniak.
Okay, thanks everyone. A thumbs up if you can hear me.
Yep, you're good.
All right, and thumbs up if you can see my slides advance.
You're good.
That was a new one I learned last week. So thanks Jim and Jan for inviting me to discuss these two really exciting papers. I'm just going to highlight the Federal Reserve disclaimer we've already seen. So I'm going to just heighten a bit what I think we heard from Jonathan, and I'm going to say that I've been really pleased to read two great papers, but I'm going to highlight that I think that within them they contain one big puzzle, and it's been exciting as I've read the different versions of the paper to see authors moving to really try to answer and address that puzzle, but I think we have a little bit of a ways to go. So let me say a bit more about that. So Hohnmeyer and Sullivan, we saw a really exciting, I think, exercise in improving the real-time measurement that we can do using data actually that we already have in the CPS monthly interviews. They find really strongly, I think strongly is a fair word here, declining poverty rates from February to May of this year, suggesting substantial poverty buffering of emergency income support programs. And the contrast here is with previous cyclical changes, we would have expected an increase in poverty rates. And in particular, the paper shows what that looked like in the Great Recession. Bittler, Hoynes, and Schanzenbach, I think, are telling what sounds like a fairly different story. They document sharply rising financial insecurity and significant increases in unease among households, particularly with lower earning adults, across really a variety of dimensions, but especially food insecurity. And this suggests the kind of body of evidence that they're able to assemble a larger and more acute increase in insecurity based on similar measures than we're seeing even over the entirety of the Great Recession. So what you really have in these two papers is a really different relationship to the cycle than we saw in the last recession based on which indicator it is that they're using. So I just want to say a bit more in terms of details on each of the efforts before I go into trying to talk about how we should interpret this set of findings together. Hohnmeyer and Sullivan are looking at income measured as self-reported annual total income from cash sources over the prior 12 months. So this is asking folks to give their income on a 12-month basis. They're surveyed in week 3 of each month, and that's going to come up in a timeline in a second. They established that this measure, although it hasn't been the focus of a lot of previous research or analysis or tracking or almost anything, nevertheless has a strong relationship to other income and poverty measures that we can compare it to using its previous iterations. A question I had, just as an aside, is this true in changes as well as levels? And it looked to me like the relationship maybe differed in expansions versus recessions, so exploring that would be helpful. Their basic findings are that poverty fell by 0.7 percentage points from November of 2019 to February. So we were on the end of our expansion, it turns out, and we saw a kind of decline of that magnitude over a period of 4 months. Then in a 1-month period, at the very beginning of the shutdown, poverty fell by the same amount, and then by 1.6 percentage points from March to April, the very large decline. And then another 0.1 percentage points from April to May for a total of 2.3 percentage points decline. Again, that timing I think is going to be important for thinking about this measure, and I'll come back to that. For context, the decline from the Great Recession peak to 2019 was about 4 percentage points. So we've seen basically about a half the change that we saw in the most recent expansion occur in a period of 3 months or less. Income is rising kind of throughout the distribution, but most predominantly in the lower parts. And perfect compliance estimates of the role of the federal benefit expansions can fully account for these changes in their estimates. By perfect compliance, I mean this is what everyone would get if they got every dollar of benefits through unemployment and pandemic assistance that they were eligible for based on their characteristics in the data. So I want to kind of underscore that because that links to, I think, some of the differences that the second paper is finding. So finally, and I wanted to draw this out because I think this is the strongest statement of their findings, they conclude that the increase in deprivation is not due to overall income loss, but rather to other disruptions. So Bittler, Hoynes, and Schanzenbach are taking a really different tack in a sense. The first paper focuses on a single estimate of income. The second paper focuses on really a suite of indicators. So they use a large range of data to examine changes in household well-being and economic security. And they're exploring the connections between this suite of measures and the extent of benefits receipt and disbursement. So they're really interested in moving away from this kind of perfect compliance or estimated benefit receipt that we saw in the first session to how many dollars actually got in folks' pockets and at what time. The findings here are, like I mentioned, a global rise in distress characterized by rising unemployment, particularly among already lower earnings groups, rising food insecurity, and declining mental health. What they find in terms of food insecurity is that it's largely in line with previous cyclical relationships. And this, I think, is also an interesting comparison with the first paper, in that the cycle here really provides a guide. So you can then take the information that you have from other indicators, for example, like UI, which they do in the second half of their paper, and ask what we would expect to see in terms of actual benefit receipt, kind of under this assumption that past cycles are a reasonable guide. And I think the evidence from the first paper would suggest that based on the massive changes in government programs, the past cycle is not always a guide. So again, that becomes another fault line between the papers. Can we use past cyclical estimates to extrapolate to our current situation and what it will look like, or should we not, or where should the caution be with that? So how do we interpret what I see as a bit of a tension in these findings? And again, I'm really glad to see that as the papers have evolved, the authors, both teams are really working to try to address this themselves as well. So the papers are looking, I think it helps to step back and say the papers are looking at signals of some kind of general household level well-being concept. And all signals, these are going to be somewhat imperfect. You can refine that a bit to say, if we had to put them under one umbrella, both papers are interested in financial security. Can households reliably cover their current, potentially that's important, that word, current essential expenses for food, shelter, and daily needs? So if we think of this as a situation where we have signals, the signals are giving us somewhat different pictures. And so in that situation, I think there are three options to try to understand what's going on. The first is that one of the signals is wrong, or possibly that both are wrong, but that one of the signals is wrong and that it's biased to a wrong sign extent. So it's telling us things are moving one direction and maybe in reality, they are not moving in that direction. Another option is that both are right, but they're representative of different US households that are experiencing these changes and support somewhat differently. And I will be candid that this was my prior after reading the first iteration of the papers. And then the second iteration of the papers, after responding to some questions about that, I have less weight on that. I'll come back to that. And finally, I think a third option is that these signals represent different facets of financial security, and these facets are changing in different ways. And I think that to the extent that they agree on this, they didn't have to answer it specifically. I think the teams are converging potentially on this third option. But let's think about these a little more closely. So I wanted to come to a timeline. I thought the slides that Diane showed on that were really helpful. I've broken it down in the following way, looking at the week-by-week events that happened between the beginning of March and the end of May. And this kind of shows you where the information that the two papers are using comes from in this timeline. I've highlighted the CPS survey weeks that the first team is using in green, and purple is really the beginning. It would carry through the entire kind of subsequent set of weeks of many of the indicators that the second team is using. I've also highlighted where those programs are starting, as was done in the second presentation. And what I want to highlight is that a first piece of evidence in the first paper comes from this third week of March survey, in which CARES was still being debated. We'd had 3 million initial unemployment insurance claims. CARES had not yet passed. And of course, none of the benefit support payments had begun. So that is that decline that I talked about between February and March in poverty rates of 0.7 percentage points is coming from that first green survey. The big decline comes from the difference between the first and the second week, highlighted at the bottom of the grayed out portion. You can see that in that period, these payment programs did begin, but roughly, I think we could say only about half to 2/3 of payments had really gone out by the time of that second CPS survey. So I highlight that timeline because I think it helps think about, could one of these signals have a wrong sign? And I want to talk about the first team's signal first. So I think they do a really admirable job of showing that the measure they're using has good consistency with other previous measures of poverty, both in the CPS and outside of the CPS. But I do think that change that's picked up in March raises some questions. And I would kind of counter, I think, an argument they have that a value to this is that the same question has been asked in the same survey for a long period of time. We're running into that same situation with the employed not at work example that many of us are correcting for in unemployment rate calculations. It's the same question, but jumping ahead to my bottom point, people are answering it a little bit differently than they did in the past. And so I want to kind of throw out an alternative possibility. So one possibility is people are not answering the question quite correctly and there's more bias in it. Another possibility is a specific kind of bias, which is that folks might be retiming or anticipating income and putting that in their kind of March response, or maybe even their April response as they answer that question. Overall, it will tend to give us the right picture of poverty over a couple month period, but it might not be right month to month. So understanding more about that, I think, would be really helpful. In terms of the other measures that the second team is using, again, it's nice that this is a suite of measures. They tend to align with one another, so that tends to make us comfortable, but I think the first team is showing similar evidence for their signal. There are many ways to compare these measures across a few different sources, and in general, the direction and general magnitude align. But as I think Diane was alluding to, the exact magnitude is often different by maybe more than we would like. That could be related to who these surveys are reaching. And that's kind of the point, that sometimes the levels differ from survey to survey. So it makes it hard to know precisely how big the actual change was. The direction seems to be consistent. How big was it? Obviously, that's a really important question. The caveat to both of these is really that we've never surveyed in a pandemic before. And so heightened general anxiety might affect how people answer these questions. It may also be the case, particularly in the income question, that folks are treating permanent and transitory income differently. And so transitory income may be reflected in their income reports. They may discount it when they're kind of trying to anticipate their food insecurity, gauge their mental health, or think about their expectations for spending going forward. I'm going to speed up very quickly. As I mentioned, my view is that both papers are looking at very broad swaths of the population. I don't actually think they're getting different stories because they are looking at different groups of the population, but that could be explored more. I do think it's worth thinking about a kind of third option, which is that the concept is different. Again, these are different signals of different facets of financial insecurity moving in different directions. I think an important follow-up to that is for both teams to really look a bit more at the evidence on questions around $400 emergency expenses. Those have been asked in a couple of these real-time surveys. They're comparable over time. And that evidence, which I would think would be consistent with cash inflows, nevertheless suggests rising financial insecurity. So I think focusing on that question to think more about exactly what the concept is picking up is useful. And so finally, I'm just going to conclude with what I think are the joint lessons coming out of these two papers. I do think, fortunately, in spite of some tension, there's a lot of overlap in what they would suggest for our next steps. Very briefly, they suggest that we should address known dimensions of distress with auto-stabilized packages, with supports that only end when the pandemic has fully concluded. We also need to continue to monitor persistence in the changes to annual income. Some of this will erode, and we're also not quite sure really if all of it has gotten to folks yet. So monitoring those things are incredibly important, and adjusting policies as needed. And then finally, this didn't get discussed, but monitoring price increases. Because of the substantial changes to the economy that the pandemic has generated, it may be affecting sectors that are relevant for overall well-being, but are not showing up in any of the other indicators already covered by these two teams. Thanks so much.
Okay, thanks. So let's go to general questions. Steve Davis has his hands up.
Great, thanks. Really interesting papers. I was struck and disconcerted by the troubling rise in food insecurity. And it's especially troubling in light of the massive income support programs that have been provided. And if those numbers turn out to be correct, I see it as a real indictment of how policy intentions get implemented on the ground in the UI system and the SNAP program in general. And I'd love to see if you have thoughts about that, but I think the economics profession in general hasn't devoted enough attention to the execution of policy intentions. And I thought I heard you say that, you know, we should wait till things settle down to figure that out. That's not my view. Okay, maybe I misunderstood. We ought to get on that right away so that the next time we roll out more income support programs, that they actually are more effective in addressing the most extreme forms of deprivation. And I read the data, your evidence is saying they failed on that score in a pretty big way.
Jason Furman.
My question actually is very related to Steve's, which is, to what degree is the problem the execution of policy, so people are eligible for programs and they're not getting them, versus the design of the policy, which is that people aren't eligible for programs because, for example, they're undocumented, and so that policy needs to change. You know, and to that end, to what degree is the policy priority, you know, continuing things, expanding amounts of money, versus a real focus on changing eligibility? I then had a separate, unrelated question, which is one interpretation one hears of the lines of food banks is that they're a form of precautionary savings, that even if you could afford the food now, you want to save more money up just in case you can't later. And also the opportunity cost of time is lower now. So why not wait on one of these incredibly long lines one sees? Do we have any evidence on whether those two interpretations, have any merit?
There were also some questions in the Q&A that the authors might want to address when they respond, in particular about what's driving the large numbers of unemployed workers who did not receive unemployment benefits according to the survey results. So if you could dig into that a little bit more, I think that'd be helpful. There were a couple of questions in that direction.
Okay. Oh, okay. Jay Shambaugh.
Thanks. These are fascinating, and that was a great discussion by Abby. I did have questions for the first group on some of the imputed benefits issues, and in particular around how they dealt with immigration. The immigrants weren't eligible for the stimulus checks at all. Anyone and in fact, I think even if you had an immigrant as part of your tax household, you weren't eligible. And so I just didn't know how that was handled with a lot of people who just wouldn't have gotten the checks. And similarly, then undocumented not being eligible for the checks at all, but also not being eligible for UI. And so it made me wonder, especially there was a comment, I think in some of, either in the text or the appendix, talking about some of the biases offsetting. And I'm just wondering if the biases that you're dealing with, the people not getting the checks being biased towards the people who are close to the poverty line or far below it. And similarly with the UI, and that I think some of the stuff Diane was showing made it look like, disproportionate UI non-receipt being at the very low income range. And so that makes me wonder just if there are a lot of people that you're imputing income to from the benefits that aren't getting it. And then the other question was for Diane on how much is food availability and food price an issue with some of the food insecurity stuff, at least as the household member going to the grocery store for a while. Like I noticed a lot of cheaper staples were just gone, and a lot of things that were SNAP eligible were sold out and things like that. And to what extent that was a problem.
Okay, thanks. So seeing no more hands raised, I think we're going to turn it back to the authors. So authors of the first paper.
It's okay if I go, Jim?
Yeah, please.
Okay. So let me emphasize that there are lots of reasons why food insecurity could have gone up besides a decline in income. We saw that there was a big decline in spending. There was a huge increase in uncertainty and worries about what was going to happen in the future. There also is a lot of evidence that the food insecurity measure has problems. It has very peculiar time series patterns, and it doesn't accord well with other measures of well-being. Also on the reports of not receiving unemployment insurance, I think we should stop using self-reports of unemployment insurance receipt. We have overwhelming evidence that people underreport their receipt. If you look at the total weighted reports of receipt in the CPS, which is a survey that carefully looks at their reports of receipt of benefits and has been around for 70 years. More than 40% of those receiving unemployment benefits don't report. So, and it's gotten a lot worse over time. So we really should not make anything from self-reports of unemployment insurance receipt. In terms of how we do our calculations in the simulations, there are some conflicting biases. We take everyone who is unemployed in May, to receive unemployment insurance benefits, and we use the number of weeks reported to calculate the number of weeks of receipt. Now, that's going to miss people who had unemployment spells but got a job, and we know there were a lot of those because BLS reported that despite increasing a lot of new initial claims, unemployment fell in the last month. So we know that there's been a fair amount of churning. So those are going to be people that we miss using just who's unemployed in May. And I think in terms of other biases, you know, we shouldn't make a lot out of the unauthorized. The latest Pew estimates are that they're less than 3% of the population. Now, in terms of policy, we may want directed policy at that group, though not going to happen in the near future. But in terms of explaining overall patterns, it's just not a big enough group to explain anything here. And also in terms of policy going forward, it seems like there's a lot of sensible concern about ramp up by the states in terms of not being able to get benefits out. But that's really an important water under the bridge problem, not something that really is affecting what policy should be going forward. I think it calls for more targeted policies towards those who really are being currently missed.
Okay, thanks. Hillary, or who's in the second paper?
I'm going to start out the response. Thanks, Jim. Thank you very much, Abby. Really appreciate the thoughtful comments and thinking about how to weave this together to try to see what kind of picture we can conclude from it. Let me start out by just kind of addressing a couple of threads that I see, both that came up through the Q&A chat feature, as well as the comments that were just raised. And I think that part of the two very broad questions are, number one, who is left behind and why? And to what extent are those that are left behind due to, as Jason raised, ineligibility versus implementation? And that obviously has very important impacts for what we would expect going forward and what we might recommend as policy. So let me sort of try to take bites of those two very important questions. First of all, Shamba mentioned an important feature that in our short time, Diane didn't have a time to mention, and that is the fact that the relief payments, which are clearly very central, did not go out to anyone where there was an ITIN filer in the household. And so there's a large class of individuals that are categorically ineligible for those benefits under current statutes. So that's one element, as well as what Diane talked about in terms of ineligibility for UI categorically by documentation status. So there are a lot of groups that are left behind through eligibility. Second, implementation, of course, matters dramatically. A couple of thoughts on that. To get back to the relief payments, as I'm sure many of you know, the relief payments were sent out automatically to all individuals who had filed taxes in 2018 or 2019, as well as augmented by individuals who were receiving benefits through Social Security or veterans payments. So estimates by the Center for Budget and Policy Priorities have that leaves behind 12 million eligible individual payments that are largely the most disadvantaged Americans who are eligible but not getting automatic payments. Those would be, a large share of those folks would be on SNAP or on Medicaid or very low earners in addition. And so that requires application, that requires getting over more administrative hurdles to get. And so it's a very clear recommendation, I think, around implementation is that the more automation we can do in providing these benefits to the eligible population, the more effective they're going to be. And then in addition to that, we know that there's been a lot of, on this question of, Peter Ganong asked this in the Q&A, which I think, the bottom line is I think time will tell. But Peter's question is, how much of the UI slowdown is a slowdown versus a sort of ineligibility? And I think, as Diane showed, both through administrative records as well as the survey data, the UI receipt is going up. So clearly part of this is a timing issue, though timing is still very important for people living on the edge. But all we can say is that the best administrative data we have that looks at heterogeneity, the California Policy Labs data, only on initial applications and their conversion to payments, shows that we have the same gradients across disadvantaged groups that we've seen in prior recessions. And how much of that has to do with the challenges of getting online and satisfying all of the requirements about reporting, I think is a picture that is not clear at this point. But all we can say is these gradients, which have been persistent across all economic cycles in America, are still present with the best data we have today. So I'll leave it at that.
Okay, thanks everybody. That was a great session. So we're going to take a bit of a break, give everybody a chance to stretch, and then at 12:15, which is in about 8 minutes, we will reconvene, 7 or 8 minutes, we'll reconvene, and Penny Goldberg, now at Yale, will be discussing emerging markets and developing economies.
Hi, Jim. It's Michael. Just wondering if my audio is working okay.
Working. It's working. Nice to see
Great.
you.
Okay, I'll remute.
Can you hear me?
Okay. Can you?
Okay. Okay.
All right.
Okay, welcome back. We have a session now on international effects, in particular on developing emerging economies and developing economies. And our presenter is going to be Penny Goldberg, and then we'll have a couple of discussants. So Penny, you're up. Penny, I think you're on mute.
Okay. Can you hear me?
Yep, can hear you and can see your slide, so you're good to go.
Okay. Okay. So thank you very much for inviting us to present this paper. This work is joined with Tristan Reed, who's at the World Bank in the research group, and I will present and Tristan will take questions at the end. So this is a very broad topic and I have a lot of ground to cover. So let me try to summarize the main findings. There is much more in the paper. The main expectation in the early months of 2020 was that developing countries would be hit much harder by the coronavirus, both on the public health front and on the economic front. And I was one among many who predicted that the effects would be catastrophic in developing countries. As was pointed out earlier in other sessions in the morning, we're still at a time where we all face high uncertainty. So this is one of the challenges of this conference. We can all be proven completely wrong. Nevertheless, in the spirit of what Claudia said, I still think it's useful to take stock of where we are now. And when we try to take stock of where we are with respect to developing countries, our message with Tristan is a little more optimistic than the general view. We find that developing countries are doing relatively well, both on the public health front and on the economic front. And when I say well, I mean relative to expectations, which were very grim to start with, and also relative to advanced countries. I will caveat what I said by pointing out that there is, of course, high uncertainty about the future. We don't know what the course of the pandemic is. And also by pointing out that our optimism refers to the short run. We are substantially more pessimistic about the long run, both because of the effects that the pandemic has on human capital and also because of the general trend towards deglobalization, and I will talk about this towards the end. So let me get straight to the findings now. One more caveat. Whenever one talks about developing countries, one faces the challenge that this is a very heterogeneous set of countries. So here I'm going to lump together countries like Vietnam or China that have fared fairly well with Brazil. So I'm going to make general statements about averages, but the caveat I just mentioned, of course, applies. So let me start with the public health front. At the outset, there were some reasons to be optimistic about developing countries and also many to be pessimistic. The main reasons for optimism were the age distribution and the low rates of obesity, both of which were identified as risk factors. Some speculated that weather might play a role. Low connectivity might have also been an advantage, surprisingly, but it meant that the virus arrived relatively late in developing countries. There were many more reasons to be pessimistic, most importantly, that most developing countries have no capacity in their healthcare systems. And that's the main reason that many of us expected devastating effects. And in addition, most people live in crowded spaces. There is urban poverty. Households live in multi-generational, households are multi-generational for the most part, and that might make policies that were implemented with relative success in richer countries less effective. So here's what we find when we look at this. These are data as of June 20th. We focus on one particular outcome variable, which is deaths per million people. So we focus on mortality. And the reason we do that is because the death statistics are more reliable than any other statistics. We know that testing has not been random. So when you look at cases or any other measures, selection issues turn out to be very important. I will come back to the data if I have time, but for now, let's look at these death statistics. The top curve in red shows the pattern for the high income countries. There is this curve. This is the curve for the upper middle income countries. In this curve, we excluded China. If you include China, this curve becomes very flat, and that might conceal the pattern for other countries. And down here are China, the lower middle income countries, and also the low income countries. And there are three things that are apparent. First, developing countries start having deaths much later than advanced economies. Second, the curves look very different. So the curves for lower income countries are both lower and much flatter. And no matter what concerns you have about data, and I'm sure you have many, I think the pattern, this difference is so strong that one cannot deny that there is a difference there. Perhaps a different way to portray this difference is by looking at by taking a snapshot of deaths per million and plot them against GDP per capita, which is what we did in this graph. The US is normalized to be 1. And again, you see a very strong positive relationship between GDP per capita and deaths per million. And that may catch someone by surprise, because most of us might have expected the opposite. We know from evidence within countries, and in particular within municipalities, we know from what happened in the US, let's say in New York City or in Detroit, that it's mostly the socioeconomically disadvantaged groups that suffer the most. So if you extrapolate it from these within country findings to the international setting, you would expect the opposite. That said, and Jan pointed that out to us earlier when she read an earlier draft, actually within the United States, we see a little bit of the same pattern, in the sense that in some of the richer states like New York State was devastated. And yet, so the spatial pattern tends to be different sometimes from the within municipality pattern. We think this is quite interesting because it can both inform epidemiological models, but also it speaks to the political economy of the response, and perhaps most importantly of the resistance to the response. As I said earlier, I'm sure you have many concerns about the data. And these are discussed in the paper, but I just want to point out that the differences are so big that it's very hard to explain them through measurement error or data manipulation alone. And here is a list of some of the numbers as they look for particular countries, just to give you a sense of what the difference in magnitudes is. So in Europe, that's where you have the highest numbers. So for example, in the UK, you have approximately 635 deaths per million. Germany is at the other end. Germany is a country that did very well with 107. This is one of the best performing countries in Europe. Now, if you go to Asia here, so I put Turkey here because it's right between Europe and Asia. Part of it is in Europe. You only have 60 deaths per million. If you go to India, the Philippines, Indonesia, these numbers are really very small. So India is growing now. Right now, there are rising cases and rising deaths, but even so, it will take a very long time and a very fast acceleration of the pattern to catch up in the negative sense with richer countries. This is the Americas. This is Latin America, where the coronavirus is ravaging the countries right now, and you can see higher numbers and also increasing numbers over time. So it's very likely that Brazil in particular is going to catch up. But even so, there are many other smaller countries in this category of upper middle income countries that don't show such rising deaths. By the way, these are the countries that account for most of the deaths, of the rising deaths in upper middle income countries. And this is Africa, where again, the numbers are tiny. South Africa has the largest death toll. For most of the countries, the numbers look like Nigeria or Angola, and these again are very populous countries. That's why we picked them here. So there's this positive correlation, which seems a bit of a puzzle. And then what we try to do next in the paper is try to unpack it. So we run various cross-country regressions. To be clear, these are cross-country regressions with all the usual caveats that apply to such regressions. And it's pure data mining. There is no theory behind them. So we try to, in some sense, to capture through these regressions what I'm sure all of us have been doing over the past few months, which is staring at tables and curves and try to make sense of this. So this is trying to put all these in regressions. So again, there are about 30 covariates that we use and about 30 regressions, various combinations that are in the paper and in the data appendix. And let me here summarize some of the main findings of this work, of this exercise. So first, if you just regress in log terms, COVID deaths per billion, we do everything in log scale. Against log GDP, you find this very strong positive coefficient. This reflects what I showed you earlier in the graph. The first thing we do is to then account for the time since the first death. We also tried alternative measures, so time since first 10 cases, it didn't make a difference. And the reason we do that is because this correlation could be mechanical. It could be mechanical because we know that developing countries started having cases and deaths later. So it could be just a mechanical effect. As you wait longer, you accumulate deaths. And now let me say that this particular variable, it should itself be an object of interest. So eventually, one day, hopefully when this is over, you would like to take it out of these regressions and run them without it, or you would like to really understand what lies behind it. So why is it that some countries started later? But for now, we thought we really need it because without this, this correlation seems implausibly large. Once we control, as you would expect, the impact of income goes way down. So a large part, and the R square also jumps up. So a lot of what we see in developing countries, it's simply explained by the fact that for whatever reason, it could be policy, it could be luck, it could be low connectivity, they started having cases later. Nevertheless, the effect of income remains. Next, we put two covariates that have been suggested in the literature as being important. One is the percentage of population over 70, and the other one is obesity prevalence. And both of them enter positively and significant. And once you put them in, the coefficient of income becomes much smaller and statistically insignificant. And let me just say, among the various specifications we run, these are the two effects that remained throughout robust. We cannot kill them anything, no matter what we do, we cannot kill them. Among other things, we put various health covariates, as you would expect, prevalence of diabetes, smoking, proxies for pollution, and so on. All of them were found to be insignificant once we have obesity here. So what this tells us is that these two variables are quite important. We wouldn't like to interpret them as suggesting that they completely explain cross-country variation. Remember that this time effect remains very large and significant. Nevertheless, they seem to have a very important effect. Another specification we tried is many specifications are specifications that include various policy variables, and we have very detailed policy variables from the Oxford database. The one that we found in earlier specifications to be most promising was a proxy for early action. So how many days did it take before countries took the first action? And in the latest data, in the latest regressions we ran, this turns out to be insignificant. On the other hand, once we put another variable in, the population density in the largest urban center, interestingly, we find that this variable has a very large impact on deaths, as you would expect. The denser cities are, the more deaths you have. But once you put density in, the coefficient on income becomes again positive and significant. And what this tells us is that developing countries have done relatively well despite having very dense cities. And that again poses a bit of a puzzle. So we have cities like Nairobi and Lagos and Manila, and Manila was exposed very early, and yet you don't see a very high number of deaths. So specification 10 is actually our preferred specification because we want to include the population density. This seems to be very important. And so the main takeaway from this column is that yes, time since first death matters. Age and obesity are extremely important. These are the two covariates that we always find to be important, and so is population density. There is still a fraction that we cannot explain. And whatever the reason for that is, it's actually good news for developing countries because it means that fewer lives were lost. So this is one more thought before I go on. What about policy? Perhaps it's a bit unsettling that we consistently find that policies are not important, various measures of policy. One interpretation is that policy mattered, but in a much more subtle and nuanced way as we capture here. And just to give you one example, the stringency index for countries like Germany and the US is approximately the same. But there were huge differences in the way policies were implemented in the two countries. And this is perhaps something we are not capturing here. Interestingly, we found that if we put measures of mobility, we do find that as mobility declines, then deaths also decline. So the effect goes in the way you would expect. However, that doesn't explain the difference in developing countries. And this is partly because there is other work that has shown that in many developing countries, despite strict containment measures, mobility did not decrease as much as in more advanced countries. This can be partly attributed to the informal sector. So what are the tentative conclusions from that? Tentatively, we say we find that developing countries have done well. This may change in the future. But what this implies is that perhaps they can start to cautiously ease lockdowns while remaining vigilant in order to avoid importing infections, and testing and tracing going forward is going to be important. Next, we look at the economic effects. And when it comes to the economic effects, we start by looking at the external exposure that developing countries have. And we start by focusing on financial data for the simple reason that financial data is available compared to data on macro variables. And I'll try to tell you the story in a few graphs. This graph shows the net non-resident portfolio flows. The source is the Institute of International Finance, and this is going to be the source for many of the graphs that I'm going to show you. These are the outflows in March that set markets in panic. These outflows were truly unprecedented. They were on the order. So this is a subset of markets. These are all the major emerging markets. It was about $80 billion for the markets that I show you, it was a 100 total. However, and then now comes the perhaps more optimistic message. If you look at a more general measure of capital outflows, so net capital outflows that include, in addition to stocks and bonds, also foreign direct investment and bank flows, then that's the picture that emerges. And I'm sure Shepner will talk about this, but this is a subset of emerging markets. These are just 12 markets, and these are, again, estimates from the Institute of International Finance, but actually these are estimates in the past have done very well in terms of comparison to balance of payments data. And when you look at this graph, there are a few things to point out. The first is that, again, you see these very large outflows. They are very large, but I would no longer characterize them as unprecedented. They're in about of the same order of magnitude as what happened in 2015 during the commodity price bust at that time. So more importantly, we also plotted here the price of oil. And you can see that these big capital outflows trace very closely the price of oil. So that looks very much like a commodity price bust, rather than just the coronavirus crisis. And the oil price shock itself was the result of two different shocks. There was, of course, the demand shock during the coronavirus crisis, but there is also a supply shock due to the fact that there was price war between Saudi Arabia and Russia. And of course, you're going to say this is partly because of the demand, the anticipated decline in demand, but nevertheless, the relationship with Russia was very strained. So our takeaway from this picture is not, I'm sorry, that things look good, they look bad, but they're as bad as they've always looked. That's perhaps one way to interpret the graph. On the right, we show what the accumulated net flows have been over the most recent year for several countries. And what's interesting is, so the biggest outflows are for Saudi Arabia. This is consistent with a view that the oil price shock played a very important role in this crisis. But the other interesting thing, and that's perhaps the more optimistic part of our message, is for many countries, you see still that a net positive despite what happened. In the paper, we look at next at the borrowing costs. One proxy of this borrowing cost is the hard currency bond spreads. These have increased dramatically in the year in March, subsequently came down, up again after debt forbearance was announced. And since then, they have come down. So again, financial markets seem to be doing a little better than before. That's a good thing for developing countries. Nevertheless, what's striking is how much borrowing costs have increased. And to us, that's the biggest alarming message. I also want to use this graph to make one more point. This is the time, at the peak, this is when the G20 announced its conference call, and subsequently the bond spreads came down. That showed that this initiative calmed down markets. Then here in April, late April, the G20 announces the debt standstill, and immediately afterwards, the spreads increase again. Why? Because the markets priced in the risk, the increased risk. This was perceived as increased risk. And since then, even though 77 countries are eligible to request forbearance, according to the IMF, there are only 22 countries that have requested to do so. And they always cite, the main reason they cite for not having taken advantage of this initiative is that they're afraid that they're going to be downgraded. Their credit ratings are going to go down. So that shows that there is a trade-off between initiatives to give debt relief to developing countries and the higher borrowing costs they face, and risks about downgrading. And these are concerns that are very much in the minds of developing countries. Commodity prices, again, there the picture looks better than before. They came very sharply down. The oil was the major driver. But since then, they have come up and they look better than before. And so if we ask in the end, how large is the external exposure of developing countries, ultimately, it's the countries that are very rich in natural resources, so especially oil, and these are low-income countries. This is where the biggest vulnerability is. And of course, remittances are another issue. this is only the financial side. Then we come to the economic effects, and there the main effects came from countries' own containment policies. We don't have official data yet. We have many estimates, but we have many surveys, especially phone surveys. And the picture that emerges is very similar to the picture that the last paper in this conference presented. People report large employment and income losses. So even in countries that have very few deaths, many people report difficulty meeting basic nutritional needs. Countries report food insecurity. There is disruption also in education and basic routine healthcare, and also people report increases in domestic violence. So the picture that emerges from surveys is a much more somber picture. Finally, when it comes to the long run, there we can only speculate. We don't have data. And this is where we are most pessimistic. And there are two main reasons for our pessimism. The first is there have been, during this period, there have been many school closures and disruption of routine healthcare. And these are painful in every country, but they're particularly painful with potentially long-run detrimental effect in developing countries. For example, in the case of schools, we know from the Ebola crisis that when schools closed, many girls didn't come back. They got married, they had kids. So the effect on the education of girls and women could be very important. Similarly, when it comes to routine healthcare, there are many concerns that maternal and child mortality will go up. There are vaccinations that are getting missed. So that's the first concern that we have. The second one comes from the fact that the current crisis has accelerated, I wouldn't say it has generated, but it has accelerated a pre-existing trend towards deglobalization. And what I mean by that is, of course, all the sentiment against immigrants, against trade. But even if you abstract from these two, there is much less willingness now in many advanced countries to help developing countries. And we are at a point in time where developing countries desperately need this help. So I will conclude with some final thoughts on policy implications. So our record of how developing countries have done so far seems better relative to expectations. Nevertheless, there is still very considerable economic fallout and a lot of uncertainty about the future. So the thing that's clear is that countries will need stimulus. Monetary stimulus doesn't do much in most developing countries. You need fiscal stimulus, but in most countries, there is no fiscal space. So external help will be needed. But as I said before, there is very little willingness to help. And that's the main reason to be concerned. Debt relief will be needed for many countries, but there again, there are many questions for whom. Many countries are facing insolvency, but is that the result of the COVID crisis, or is it the result of pre-existing long-term structural issues? In general, as the interest rates, as the spreads show, there is a trade-off between providing substantive debt relief and countries facing a further increase in borrowing costs or further capital outflows. And so against this background, the standstill seems like a good idea in the sense that it buys everyone time to figure out what to do, but it's absolutely clear that it's not going to be sufficient. So I will stop here. Thank you very much. And I'm looking forward to your comments.
Okay, so we have two discussants. So Shebnem Kalemli Ozkan, you're up first.
Okay, let me share my screen. It says I cannot share my screen. Okay, let me try. Yeah. Okay, I hope everybody can see and hear. Thank you very much for the organizers for inviting me to discuss this extremely interesting paper. Let me start with a very brief overview. The key message of Goldberg and Reed is, as of June 22nd, 2020, emerging markets and developing countries have fared relatively well. The authors investigate the impact of COVID on these group of countries on two fronts. On the public health front, they show that these countries experience a lower number of deaths, and this can be explained by their younger population and lower obesity rates. On the economic front, the short-term economic effects are limited and economic recovery is underway. there can be devastating effects in terms of medium and long run, and these effects are going to be directly due to containment policies through output and indirect effects on education health. The authors realize that we live in extremely high uncertain environment, and they caution that paper's conclusion can be reversed if infection and deaths accelerate in emerging markets and developing economies. My comments is going to be on 3 points. First, I do agree with the authors that death is a useful metric, but I would like to look another metric to evaluate the short-term public health impact. My second point is going to be on whether we can explain low deaths in emerging markets and developing economies with some other factors too. I agree with them that demographics and health are going to be powerful variables, but of course these variables don't let themselves to policy response. So I would like to dig a little bit in deeper in terms of other variables that we can devise policies for. And my third comment is going to be revisit the nature of the COVID shock for this group of countries. Instead of just focusing it as a commodity price shock, it is a shock with many layers. And by doing this, I will try to come up with alternative ways to evaluate the economic impact, both short-term and medium-term. And here I'm going to use both some data as much as I can, real-time data, and model-based estimates. And we'll draw lessons from history. So my discussion is going to be a cautious view from an optimist. I am known as an optimist, but I believe what we have learned since February is we are always behind as far as this pandemic goes, and COVID is ahead, and we hope for the best. And I do hope the authors' results survive the next 6 months, but we do have to prepare for the worst. So let me start with my first comment on the metric. The authors, as you just saw, focus on the deaths per million, which is a very useful metric, no doubt. But I would like to look at also cases, because I believe there is information in cases. So this is a figure that I'm sure you've seen many times in press on the daily new COVID cases. The figure on the left is an update from June 22. So this is data from Johns Hopkins. And you can clearly see the alarming increase in daily new cases on emerging market and developed economies. Yellow line, the upward trajectory of the yellow line. Red line is China. And the dark blue is the advanced economies. So these numbers might be off, but the point is this difference, which is very critical for us, is not likely to be that off. Where the advanced economies turn their curve, there's now a little uptick due to the recent increases, mainly in US, and these guys are really on an upward trajectory. This becomes really impressive when you compare this figure to slightly older version of the same exact data. This is from Martin Wolf's FD column on June 9. It's exactly the same data. You see the same pattern. Advanced economies have their curve in terms of new cases with pink. Emerging markets are really increasing, not almost surpassed, shown with the blue line. But notice that the number here is 80,000 cases as of May 27. And in just a couple of weeks, in a very short time, now we are at a number 120,000. Again, I mean, given this picture, it is going to be extremely interesting to see if emerging markets and developed economies can keep the low number of deaths, because that means we really have to learn from these guys, right? And in that sense, this paper is extremely important and timely because it makes us think really what is going on. So this brings me to my second comment. Why do rich countries have more debts? I would like to show you two figures here. So this figure on the left is a visual representation of author's headline result, which says, look, there is an extremely strong correlation between COVID deaths per million and the GDP per capita in cross-country regression. And, certain variables can explain that. Size of the country is given with the bubble. Rich countries have more deaths. This figure on the right is from the work of my colleagues at the fund, shows the opposite result for counties. Now, this controls the state fixed effect, so you don't have a New York effect here, but this is the US countries that tells you deaths are lower in rich countries. And here I use the poverty rate for county that tells you that poorer the country, more deaths there. And I believe now there is actually recent work from Europe looking at European regions and at a very granular level showing the same result. Although we have Lombardis and New Yorks of the world, it looks like spatial patterns when you look at real detail tells you that being rich is actually a good thing in terms of reducing the debt. So what is going on? So clearly there is this thing that GDP proxies for in cross-country regression. paper's headline on this is older population, high obesity rates are the key variables. These are the variables that render GDP insignificant. So they are the ones GDP is proxying for. Of course, any X variable that is positively correlated with GDP and has a positive beta on the deaths is going to create an upward omitted variable bias. This goes with any variable negatively correlated with GDP and has a negative effect on COVID deaths, like testing and contact tracing. That's also going to create an omitted variable bias. The usual suspect we all think is this is about delaying policy action, disease arrived late in emerging markets and developing economies. That must be it. Authors look into that, and these are important, but not enough to explain away the role of demographics and health. Other suspects seem like in paper's robustness test is about testing and tracing variable. And this is really exciting for me because I do think we should be doing more in terms of testing and tracing. And knowing that these variables are also impactful is important. These variables can explain the positive relationship between GDP and death. Now, it is very hard to interpret these variables, as the authors pointed out. Testing is not random. There are only 3 countries with random testing. But maybe it is better testing capacity, or maybe it's misreporting. It can go either way. My favorite interpretation is it can be that there is better contact tracing in emerging markets and developed economies because of limited civil liberties. For those of us who are from these countries, and I'm being one, we know that it is pretty easy for governments to track people in these countries. So I'm going to revisit their results. So they graciously provided their data. I'm running their exact same regression here. I'm regressing their death variable on GDP per capita, and then the mechanical variable, which is very important. And then I purposefully omit the demographic and health variables, and I put this group of testing variables, which seem very important, especially the contact tracing variable you can see in red has a negative effect on number of deaths and actually renders the positive correlation between GDP per capita and deaths is practically insignificant. The same effect that obesity and young people have. So this is really good news because this is something then we can pursue in terms of public health policies. And this is consistent with our anecdotal observation of South Korea and Germany, right? South Korea and Germany, there's nothing going on in terms of income differences. They both did this very well. Okay. Now, my final point is going to be on the nature of COVID shock and the economic impact. This shock is a multitude of shocks. So it is a health shock, supply shock, and demand shock for everybody. But for emerging markets and developing economies, it's also a capital flow shock, an exchange rate shock, and a commodity price shock. Paper does a very good job on focusing the commodity price side, and I fully agree with those results, but I would say it is much bigger than that, especially for many emerging markets and developed economies that are going to be commodity importers, not exporters. They are going to be hit from the other layers and not through the commodity price side. And of course, we all want real-time macroeconomic data. We are not going to get this. Second quarter GDP and very important balance of payments, capital flows data is not available. Still, this is a large crisis. No crisis requires out-of-the-box policy response, so we should, do these papers. So what I'm going to do as an alternative to the paper, I'm going to try to look at inference from almost real-time data and some model-based estimates where the model is an epidemiological macro model specifically done for an emerging market. First, let me look at an almost real-time data. This is PMI survey. It tracks industrial production with 1 month lead. So industrial production numbers now we have is only April. This is also we have for May. What you see here is both manufacturing and services extreme contraction. This is a survey that tells you there's contraction when the numbers are less than 50. This is this dotted black line. You see that contraction in both sectors. More importantly, you see that there is no difference between advanced economies and emerging market and developed economies. They are contracting the same way. In March, shown with green bars, maybe EMD countries were a little better, but in April and May, practically there is no more difference between advanced economies and emerging market and developing economies, both in manufacturing and services in terms of economic contraction. Now, the latest VO from yesterday, compared to April VO, World Economic Outlook, IMF is projecting a much deeper recession in 2020 and a slow recovery in 2021. They came loud and clear yesterday as no country is spared. Global growth is expected to decline minus 4.9%. The number for this group of countries the paper is considered with is minus 3. If you exclude China, it's minus 5, right where the global growth is. Geeta said yesterday the cumulative hit to GDP growth over 2020, 2021 in this group of EMD countries the paper is focusing on is going to be worse than the advanced economies. It's expected to exceed that in advanced economies. Of course, we all realize there's a high degree of uncertainty and countries should be agile with their policies and adapt to changing environment. In this juncture, I put the key important variable as the capital flows and external financing for this set of countries, for EMD countries. Now, let me tell you very quickly what is wrong with the capital flows data we have. The high frequency real-time capital flows data is only on portfolio equity and portfolio debt. And this unprecedented capital outflows we see now everywhere, and Penny also showed the minus 80 number, which is minus 100 billion for equity and minus 30 billion for debt. Now, we don't really care about this number, do we? Because this is not an important class at all for this group of countries in their external borrowing. Actually, if you look at developing economies, now if you separate these emerging markets and developed economies, and the separation is going to be very important here, it doesn't matter for developed economies at all. And for emerging markets, it's going to be a very tiny piece of external financing. Portfolio that is going to be mainly about sovereign borrowing. It's completely fine that investors leaving the sovereign debt because they expect a sovereign default, and they leave equity because it's the riskiest class. Authors realize this. They use a broader measure of net capital flows that is going to incorporate everything, banking, loans, bonds, FDI. But unfortunately, this is only for 12 countries. And again, account identity. It is trade balance and the reserves. But we learn from all the previous episodes of sudden stops and crisis. So all the previous episodes of sudden stop, crisis in all the emerging markets and developed economies, this doesn't matter. What matters is gross capital flows, what foreigners do, not the net, because net will be what foreigners do minus what domestics do. What matters is what foreigners do, non-resident, which is the portfolio data we have, and especially banks. So if we look at the real data over 34 emerging markets and developed economies from previous two big events, global financial crisis during the fourth quarter of 2008 and taper tantrum. So you see that this is the very negative bar, by the way, much larger numbers we are looking at here, much larger than what we see now. You can see what we see here is like the big blood is out of the private sector. So this is how much the banking sector and this is how much the corporate sector loses in these 34 countries. And you can see that sovereign is just lost a little bit. And this is going to be consistent with what we've seen so far. Taper tantrum, another very big exogenous event for emerging market developed economies, third quarter of 2013, the same story. Nothing is going on with the sovereigns then, and it's a lot of capital flows came out of the banking and the corporate sectors of the emerging market of developing economies. Now for COVID, we can only do the first quarter of 2020 with the recently release of the BIS data and aggregating up the micro data on loans and bonds. And again, actually, what you see is this very little in the sovereign bonds and as matching the real-time data. But then in terms of the private flows, they are still borrowing. In the first quarter of this year, both corporate sector and the banking sector in the 34 representative emerging market and developing economies still borrowing. So it is too early to tell, to know what is going to happen with capital flows moving forward without having the actual bills of payment data and second quarter numbers.
Okay, so Sebnem, we need to wrap up here.
Yes, my last point. In terms of the medium and long-term effects and the effect of lockdown policies, what I would like to say is recovery of local demand and effect of lockdown policies is going to be very important, as the author is saying, but that's going to depend on foreign demand, international linkages, and external finance. And the model we did, an epidemiological macro model, shows that partial lockdown policies are going to give you higher losses than the full lockdown because of the importance of domestic and external demand. Let me wrap up. So this is a heroic effort to evaluate the health and economic impact of COVID on emerging markets and developed economies for such a large and uncertain shock. Global epicenter is moving to south, and if that remains low, this will be a big success for EMDEs and it will provide valuable lessons. There are still a lot of known unknowns and many uncertainties in terms of which factors make people vulnerable, how epidemiology linked to economic outcomes, and more conferences like this. Hopefully we will learn more and be ahead of the disease at some point. Thank you very much.
Okay, thanks very much. Michael Kramer.
Great, thanks very much. Oh no, great. So it's a pleasure to discuss this paper. I think makes two very nice claims. First, it documents very convincingly that there are fewer COVID-19 deaths in lower income countries. And second, it argues that many of the economic costs of the epidemic are less severe than anticipated, but that the containment policies have had large costs. And the potential policy implication is that perhaps we should be relaxing some of these lockdown policies. I'll argue that understanding the reason why we have fewer deaths in lower income countries is critical for policy. Goldberg and Reed focus on demographics and obesity. I'm going to argue, as I think Penny acknowledged, that there may be more to it than that, and there's a deeper puzzle. I also wanted to make a bit of a note on methodology. So when epidemiologists, and I'll focus really on the first part of the paper, the epidemiological part, but epidemiologists, they typically use models and they calibrate those models, much like macroeconomists do. They'll calibrate things using microdata. This paper has a complementary approach of using cross-country data, and I think there are advantages to combining them. I think this paper brings some insights to bear that of some issues that might be there with just a standard epidemiological approach, but I think the epidemiological approach also it's useful to bring some of that into this paper, bring in some of those models. So I'll try to do that. So let me start with the sort of canonical epidemiological model for diseases like COVID-19, which is the SIR, or susceptible, infected, recovered model, which I think maybe economists wouldn't have known about before, but now I think probably most people are familiar with these equations. So the change in the susceptible...
So Michael, if you're referring to slides, we can't see your slides.
Oh, I've been trying to share my slides throughout.
That's okay, but you've been very articulate until we start talking about SIR equations.
Okay, why are my slides not being, okay, I'm gonna get some tech assistance here.
Well, I'm sure you can be articulate talking about SIR equations too.
Hey, Michael, this is Anna. I'm going to pull up your slides from my computer, so hopefully you can see them.
Oh, it's okay. I just forgot to click screen. Yeah. Gosh, I thought I could do it. Oh, picture. There we go. I think, are my slides up now?
Yes.
Yes.
Great. Thanks a lot. Okay. Now let me just see if I can go to the the view that'll focus in on them. Okay, so the change in the number of susceptible people happens when a susceptible person meets an infected person, and then there's transmission with a probability beta. And N is just the population, which you can think of as normalizing to 1. What's the change in the number of infected people? Well, the number of infected people grows when there's an infection event, and then you have to subtract off the rate at which infected people recover, which is gamma. I'll ignore deaths here. And the change in the number of recovered people is just the gamma, the recovery rate times the number of infected. This is a standard model. The R0, which is the number of people each infected person infects in a naive population, is beta over gamma. So if beta over gamma is greater than 1, then the disease is going to spread. If beta over gamma is less than 1, the disease will not take off. And you can estimate R0 by looking at the initial doubling time. And people have done this, and they take the data from Wuhan, they take the data from Lombardy, and you get pretty high rate of R0, something like 2.5. So in these models, the initial growth is going to be close to exponential, but eventually there are fewer and fewer susceptible people. The infected people don't meet susceptible people. They meet other infected people. They meet recovered people. They don't spread the disease to new susceptible people. And the epidemic slows. And eventually, when you get to herd immunity, when 1 over R0 people are susceptible. You'll have a little bit of transmission beyond that point, but basically the disease will start to die off then. So that's a pretty pessimistic picture. If R0 is 2.5, that suggests you're going to need 60% of people to be infected before the disease slows down. Okay. So that's the canonical model. Now, what about mortality? Well, you could just add an element to this, allow the total deaths to be equal to the number of people who are ever infected times the infection fatality rate. And there we know from microdata, and here comes the calibration part, we know that older people are more likely to die. We know that there's obesity is correlated. If you just use Chinese data, for example, and then you look at the difference in death rates by demographics, you expect a 5-fold difference between developed countries and low-income countries in mortality, just based on the fact that there aren't so many old people in very poor countries. Obesity would strengthen that effect, but on the other hand, there could be some things that would work the opposite direction. If you have a weak healthcare system, which low-income countries do, you might expect more mortality. If you've got a lot of air pollution, maybe you'd expect more mortality. So, but let's say we're expecting something like a 5-fold difference from this factor. Let me argue that that's not going to fully explain these differences. Again, not inconsistent with the preferred specification in the paper. Okay, so the death toll in the UK, where I happen to be right now, is greater than the death toll in low and middle income countries representing half the world population. That's a more than 50-fold difference in the death. So it's not a 5-fold difference. It's much, much bigger than that. So but there's another thing here, which is this, the main regressions in the paper are they don't exploit the time dimension. They're all about the deaths at the cumulative deaths. We've got a lot more information by taking advantage of the time path. And if you look at the time path, and this was clear in the charts that Penny showed, this shows you have a much, much flatter curve for low-income countries or lower middle-income countries than in the OECD epidemics. This is from Lee, 2020. So you can see that it's not, you really don't see this shape of this rapid exponential growth at the beginning in low-income countries that you do in in high-income countries. You don't see that in low-income countries. So something else is going on. And remember, it's not, if it was just something affecting the fatality rate, then we'd have the same shape of the curve. It would just be 1/5 as large at any point. It's not that. It's a different shape of the curve, a different trajectory. So if bringing in a little bit of the epidemiological model suggests that there's more going on than just things that would affect the death rate. I mean, maybe you could tell some story why demographics affects the infection rate, but it would probably go the opposite way. Older people would probably get out less. So, okay. So why is the curve both lower, but critically also flatter? Well, could it be measurement error? Well, Penny argued it's just not big enough. And I think that's right. But there's another issue here, which is if you want to explain the flatness of the curve, you would need the implausible downward trend in the fraction of COVID-19 deaths that are attributed to COVID. So just to be clear, it's very plausible that in low-income countries, there are a lot of COVID deaths that never get attributed to COVID. That's for sure. But it's hard to tell a story, not impossible. We try to be creative in this profession, but so it's not impossible to tell a story why you'd be missing more and more of those deaths over time. But that's the type of story you would have to tell. You'd have to be missing incredibly more of those deaths to explain why the curve is flatter, not just why it's lower, but why it's flatter. So I don't think that can be the story. What about a shorter gap between the epidemic arriving and lockdown measures? Well, under a standard epidemiological model, all that matters, you're going to get to that herd immunity. This is what if the parameters, if those beta parameters, the contact rates go back up to normal after a lockdown, you go right back up to, you're going to go to herd immunity just as you would otherwise. So that's, you'll go to that 60% prevalence. So that doesn't seem to be doing it. I don't want to speak too strongly. There's a lot we don't know, but it's certainly if we take the data in this paper, the policy variables don't seem sufficient to explain the results. Obviously, as was pointed out, maybe you could tell a more complicated story. I don't want to rule that out, but it's not easy. I'm going to suggest another hypothesis. Endogenous behavior change possibly could get you there. You'd probably still get to the same herd immunity level because if individual behavior change depends on the risk, then you'll get to the same place. Or roughly the same place. Let me suggest an alternative hypothesis. And this is very speculative, just to be clear. I don't have evidence for this. I'm working on this, hope to get there, but right now just take this as speculation. So there's lots of reasons to think that epidemiological parameters might be heterogeneous across communities. We know from microevidence that there's very high transmission in places like nursing homes and bars and meatpacking plants. There are certain groups of people that are present there. We also know that there are some potential factors that are correlated with income, temperature, ventilation, what type of house you have, or other things, time spent outdoors, the pattern of social interaction. So consider a model with different types of subcommunities and some limited interaction across groups. So imagine there's a low prevalence subcommunity that's 20% of the population with an R0 of 2.6. And imagine there's a high prevalence subcommunity. And I'll consider a few different cases. You could think about R0 of 1.1. You could also think about R0. Let me make it even more stark case, an R0 of 0.8. So what's going to happen when we do what the epidemiologists often do? I don't want to say as if they're a single group, but take the sort of standard epidemiological models, the canonical models. Well, when you think, let's think about I'm sorry, that I see my slide is backwards, where it says low prevalence. That should not be low prevalence. That should be high R0 and low R0. Think of the low R0 as 0.8, not as 1.1. Okay. Think about what happens if that's the real world and you go out and you try to estimate R0. Well, where R0 is 0.8, you're not going to see any takeoff of the epidemic. But where R0 is 2.6, you're going to see the epidemic take off. And you're going to estimate that R0 is 2.6 based on the early data. And you'll come to the conclusion that we need 60, 70% of the population infected before we get to herd immunity. In fact, you need 60 or 70% of the high R0 communities infected. That's all. And so once you get to 15 or 20% prevalence, you'll be done. Okay? So that would be consistent with some of the data that we see, and without necessarily saying that policy played a key role. I don't want to claim that policy played no role, but this is obviously not a true model of the world, but I think it gives you food for thought. Let me skip over this slide, but I think it illustrates slightly more nuanced version of this. But let me note that optimal policy in this world with heterogeneity is going to be very sensitive to parameters. So let's assume that governments can put in containment measures that are costly, have economic costs, and that cut the spread rate by 25%. Well, if the high R0 groups have already reached herd immunity, and R0 in the low spreader group is less than 1, then containment measures are going to be unnecessary because we're already there we're already at herd immunity in the high groups, and we don't need this in the low groups, and we can just relax, no problem. We don't need all these lockdown measures. On the other hand, imagine the low group has R0 of 1.2 without the containment policies. Well, then relaxing the containment measures is potentially costly. So, what would be a conclusion from this? I guess the conclusion is that we might think that epidemiology is easier than macro, but it's actually pretty hard. Things are very sensitive to the details of how you specify things and how you construct the model. But I will note one cause for possible optimism, which is we often talk about lockdown measures as a binary variable, but actually there's a whole bunch of different policies, and they vary in their likely impacts on spread of the disease, but also in their economic and social and even health side effects. There are some fairly low-cost measures like masking or restrictions on nightclubs where the disease spreads a lot, There are other things like shutting down trade or shutting down immunizations for kids that have very high economic or social costs and that may not do that much to prevent the spread of the epidemic. So we could perhaps continuously vary these things. Now that suggests if we have a lot of uncertainty about the model and about the parameters, what could we do? Well, you could do repeated prevalence surveys so you track what's happening to the epidemic over time. Then you could progressively relax the restrictions with the lowest epidemiological risks and the highest economic benefits. And start out by saying, well, we're gonna allow basic mobility, but keep the nightclubs closed. If you're monitoring R throughout this process, then when the R starts to go up and you get close to R starts to go above 1, you can apply the brakes. Let me note that this policy makes sense for an individual country trying to control the epidemic. But I want to emphasize that as we do this, we'll start to learn. Right now, I threw out this possible heterogeneous story with heterogeneity, but I don't want to claim there's evidence for that. But if we started to do these types of surveys, we might notice some patterns. We might see, for example, that actually, perhaps in rural areas of low-income countries, it looks like R0 is less than 1, even without containment. Well, in that case, you could actually have pretty relaxed policies in those areas. But maybe in other places, maybe in urban slums, for example, it looks like R0 is greater than 1 unless you have containment policies. And then maybe we say, well, those places, we need those policies. I should note, I just want to emphasize something that Penny mentioned, but I think is very important. Now, these containment policies are causing huge amounts of suffering. The disease causes huge amounts of suffering, but we really need to know where the containment policy, where containment policy is necessary, where are they not necessary, and which containment policies are most effective. And if we can start to get to the frontier of choosing those policies in a smarter way, then which obviously was, there was so much uncertainty at the beginning. I'm not saying that I don't want to second guess decisions that were made, but if we can collect the data, then we can get to a point where we can choose policies that will allow the economies to recover and prevent some of the terrible suffering that people are undergoing from the economic and social consequences of the lockdowns, but also will be effective in avoiding unacceptable spread of the disease.
Thanks very much, Michael, and thanks very much for everybody in the session. We are over and we haven't had time for any questions. So what I think we're going to do is go take a break right now, and then we will go to our lunch breakout sessions. And if this is a session that you are particularly interested in, then please join that lunch breakout session. My understanding is that Anna Dawson is sending all the participants an email with the links for the breakout sessions. I will be joining the one on the session on poverty, but I'm going to get some lunch first. So we'll see you at the breakout sessions. And then if you're watching on the webinar or otherwise, we will start again with session 4 at 1:50 p.m. Eastern time. Thanks.
And if you wanted to have a question on this particular session, then we ran out of time, join the emerging markets breakout room, and the authors and Shebnem for sure will be there to have further discussion. And then the other breakout room is on the consumption and labor market, the session, which was the first one this morning. So choose a session, we'll continue the discussion there.
Go into my breakout session.
Go ahead, Shebnem, do you have a question?
Okay, so I'm going to disconnect from this and I will go and reconnect to the session, the other link, right? Correct? Okay.
Hi there, this is Anna from Brookings. It would be helpful if you're on the panel 4, if you could raise your hand, I will get you in. Thank you, Jesse. All right. And this is just a note to Jim and Jan. Give it a few minutes, about 2 minutes to start so people can get back on.
And Jesse, you have your slides ready to go?
Yes.
Okay, I'll go straight to you with a very short intro.
Okay. Should I wait to share my screen till after that?
Yeah, wait, because they have this slide up.
Yep.
So Meta, we'll go to you right after Jesse.
Okay.
Thanks. I'd like to welcome everyone back for the afternoon session. Thank you for the many comments during the morning session and during the breakout rooms at lunch. This afternoon, we have the same format. So for those of you who were not with us in the morning, and to remind you, when we get to the open discussion in the Q&A, if you have access to the participant list on Zoom, then please raise your hand so that we can call on you and you can ask your question verbally. If that's not possible, or if you just have a technical or a clarifying question, you can ask in Q&A. That's also a good place to put questions that we don't have time to follow up in, since there's so much content in these sessions. So this session is on labor markets and the economics of non-pharmaceutical interventions. The first paper is measuring the labor market at the onset of the COVID-19 crisis, and the presenting author is Jesse Rothstein.
Hi. Can you all hear me and see my slides?
Yes, all set.
Great, great, thank you. So thanks a lot for having me. This is joint work with Alex Bardick and Marianne Bertrand and Feng Lin and Matt Unrath. And I want to mention that we're relying a lot on data from Homebase, which we're very grateful for, and we'll talk a lot more about that as we go. Oh, let's see if I can get this to move. Okay, there we go. So we're really after what we think of as two big goals. One is just trying to understand and document the nature of the labor market decline at the beginning, which sectors, when it is, which workers, the role of firms, and we're going to focus a lot on small businesses because that's what's covered by the data we have. And then second, to kind of provide some at least preliminary evidence on the effects of the shutdown orders and other economic interventions at the onset of the crisis. So the first finding is just that this is a really different recession from other recessions. I think others have seen this as well. We just have some ways of trying to illustrate it. So this just shows job losses by sector from the CES payroll survey for the Great Recession and this one. And you can see that in 2 months, we lost 60% more jobs than we did in the entirety of the Great Recession. A much sharper decline and very differently distributed. Where you think of a traditional recession as driven by male-dominated sectors, construction, manufacturing, this was very dominated by female-dominated sectors, in particular leisure and hospitality. And that makes it a very different type of cycle. Another thing that makes it different is there are extremely high rates of temporary layoff and very high rates of recall expectations. Most of the workers who lost their jobs expected that they would be going back, which is not something that we've seen at all ever in the past, and certainly not in recent recessions. We're going to be relying a lot on data from a firm, Homebase, which provides scheduling and time clock services to small businesses. We'll be relying on the time clock. So when hourly workers at small businesses go in and start work, they punch in and then they punch out, and this collects the data. That allows us to have daily data on the number of hours worked by worker and firm for the Homebase clients. Now, Homebase is not representative. It's very much disproportionately very small firms. So over half of the firms have less than 5 full-time equivalent employees. So it's very small firms, very concentrated in food and drink and retail. So you want to think of this as restaurants and shops are using this. That's fortunate in that those are sectors that were really particularly hard hit by this crisis, and so we can really zero in on them. But there's no sense in which this is representative, and we need to be clear about that. We can use these data to just see hours of work by day since the beginning of this crisis. And we normalize everything relative to the end of January. And we can see that basically the entire collapse happened in 2 weeks. On March 12th, hours worked were 96% of their late January average. 2 weeks later, it was 44%. So that was almost all of the collapse. The nadir actually almost perfectly lined up with the CPS reference week in April. And then we've had gradual recovery since then. So now we're back up about halfway to where we were before the crisis in terms of the number of hours at home-based firms. Second result is that these firm shutdowns and reopenings have played a large role, at least in the home-based data. So we can see that about half of the home-based firms shut down for at least a week, which we define as nobody reported any hours at that firm in the week. Those shutdowns account for about half of the lost hours, with almost all of the rest of the half coming from individual workers who didn't work in a week. Not so much from workers whose shifts were cut. About 60% of the firms that have closed have since reopened, meaning they had a week without hours, and now they've had at least 1 week with positive hours. And they're averaging about 2/3 of the scale they had before the shutdown. So they've reopened, but at a smaller scale. When they've reopened, it's almost always come by rehiring workers who worked at the firm before. There are very few workers who are new. The share of new workers is growing over time as we get further and further from the crisis. But that's maybe not so surprising because these are firms that have pretty high turnover in any case. It would be surprising if a huge share of the workers at these firms were the same as the workers in March, even without the recession. If you look at which firms exit, the small firms are much more likely to exit than larger firms. And interestingly, there is this harvesting that the firms that were already unhealthy, the firms that had shrinking employment in the year leading up to to the crisis. They're much more likely to exit than firms that have been growing or stable. The firm size for reopening doesn't seem that much different. The small firms are more likely to close, but the small and large firms that closed are about equally likely to reopen. By growth rate, the firms that were already shrinking are much less likely to reopen. So it does look like this drove some firms out. The next set of analyses we do is who are the workers who lose their jobs. When we're looking within industry and within state in doing this. And we generally see is a pattern you might expect, which is the more disadvantaged workers are the ones who are more likely to be laid off, and they're the ones who are less likely to be rehired. So we can look across age. You see that the youngest workers and the oldest workers are much more likely to be laid off. These plots are showing marginal effects in percentage points from a regression that's controlling for the other characteristics and from industry and for industry and state. So the workers under 25 are about 8 percentage points more likely to be laid off than workers in their 20s and 30s. Workers over 65 are 14 percentage points more likely. The older workers are less likely to be called back when the firm reopens. So it does look like some of these workers have exited for, maybe not for good, but for a while. That's not as true for the younger workers. There's a big education gradient in layoff. The least educated workers are the most likely to be laid off even within these firms and within these industries. There's not as much of an education gradient in rehiring. And then there are big racial gaps. In particular, Black workers are much more likely to be laid off and much less likely to be recalled. We see something similar with Asian workers, although obviously the samples are smaller there. This is what we see this is current population survey data. So this is not based on the small firms and home base, but based on everybody who was working in March and not in April, or everybody who was not working in April but was in May. But we get pretty similar results if we look within the home base data and look at workers who are laid off. One thing we can do in the home base data is we can match it to a survey that we did of home base workers. So we can get information that goes beyond what you have in typical administrative data. So we collected a bunch of demographics in the survey. We also collected some worker expectations. And what we can see in this is that if you look at the people who stopped work and were not working at the time of the survey, and you ask them, do you expect you'll be rehired? The ones who do expect to be rehired are much more likely to go back to work in the subsequent weeks than the ones who didn't expect that. So whether we phrase it as, do you expect you'll be rehired, or did your employer say they would rehire you? Those are very strongly predictive of whether you actually wind up going back. Now that's, I think, helpful because we do know that the large shares of workers who lost their jobs during this downturn said that they expected to be recalled. And so to the extent that that's informed, that these results generalize, that says that these are pretty highly likely to be recalled workers. On the other hand, as we move on from the trough, more and more of the workers who are there are the ones who didn't say they expected to be recalled. So I think that we're going to have smaller, harder times getting people back as we go forward. Fourth finding, if you look at the shutdown and reopening orders and try to use variation across states in when they implemented an order or when they lifted it, you can then look and see whether hours recovered right after the reopening or whether they went away right after the shutdown, and compare those to other states where the orders were at different times. We're going to find that the orders do have an effect, but it's small relative to the broader time pattern. And so I'll show that here. These are event study models where we allow for state-specific trends and we allow for common time shocks across all states. And we do two separate models, one for shutdown orders and one for reopening orders. If you look at the shutdown orders, which are the red line, we see that in a couple days after a shutdown order goes into effect, we see about a 10 percentage point drop in number of hours worked. It does look like these orders do have some effect. This is matched by pretty similar declines in the number of people who are traveling to businesses, if you look at other data based on location patterns. So my interpretation is that this is in large part reflecting the declines in demand when these orders take effect, but we're not entirely sure. And then when you look at the reopening orders, they're not quite as sudden, but they have a comparable magnitude, about a 10 percentage point increase in hours worked in the 10 days or so after the order is lifted. But you can compare those 10 percentage point effects to the calendar time effects. There's just a pure effect of it being April 1st relative to early March. And you see that those are effects that are common across all states. And we see that those are 70%, 60% declines in hours worked. So it does look like what happened is there was this really sharp decline in hours worked, in late March that was common across all states, whether or not they implemented shutdown orders. And then the shutdown orders added a little bit more to that, but not very much. Most of it seems to be driven by the pure calendar time effects. And again, that's mirrored by other measures that seem like they're proxies for demand. Most of the hours drop seems to be that the customers went away, not that the government said you can't go to work. And then the last set of analyses that we've done is trying to compare states that were trying to look at the effects of policies. The PPP program, the Paycheck Protection Program, this was the loans to small businesses. There's no state policy variation in this. It's a national program, but it was pretty haphazard in the way the loans went out. And some states, it seems like they got more loans than others. And it looks like it was driven by some banks were better prepared to process these loans quickly. The first wave of PPP ran out very quickly. And so if your bank wasn't ready to process loans on day one, you might not have had a chance at those loans. We can look across states by what quartile they're in, by the amount of loans they got per payroll. Fourth quartile is the highest disbursement states. We've also divided states by the replacement rate from the Ganong and Noel and Vavra paper, by the unemployment insurance replacement rate. So the fourth quartile are the states that had the most generous unemployment benefits. And what we can see is that the most generous states by unemployment insurance, also the highest PPP volume states, are all states, they had smaller declines in hours worked, and if anything, larger recoveries, faster recoveries afterward. Now, you might have thought that the unemployment rates, a lot of the concern has been that the very generous replacement rates are discouraging workers from going back to work. But what we see is the states that have the most generous replacement rates are having the fastest return to work. Now, this is not a quasi-experimental analysis. This is just a cross-state regression. And a lot of it goes away or at least shrinks and becomes insignificant when we put in state census division fixed effects. So I don't want to say that this is causal, but there's at least very weak evidence that these policies, that the unemployment rate retarded recovery. It looks, if anything, the evidence looks like it goes the other way. The same issue with the PPP loans. The states that got more PPP loans were states that were already having larger declines in employment when the PPP program was passed. So it can't be that it's entirely the causal effect of the PPP loan program. But it does look like there's at least some evidence that it kind of is associated with faster recoveries. So that's the basic results. The kind of conclusions, this is a very different recession. And we want to be very careful, I think, about generalizing anything we know from other recessions to what's going on here. It was extremely fast. The recovery was extremely fast. We kind of got lucky that the CPS happened to be timed to the nadir of the recession. If this had happened 2 weeks off, we might have missed a large share of the decline in the official statistics. It's led by very different sectors than the ones that we usually think of. It's all in-person services employment have been really the drivers of it. And the unemployed workers overwhelmingly expect to be recalled, which is very different. And many of them have been recalled. We're definitely seeing kind of gradients that the more disadvantaged workers have been the most likely to be laid off and the least likely to be rehired so far. I think I'm concerned that will persist, but we obviously don't know what will happen in the future. In the short runs, we find effects of both shelter-in-place orders and then the lifting of those orders on hours worked, but they're small relative to the time pattern, which we think is mostly just the customers disappeared, not that the workers couldn't go to work. I think there's some indication that the PPP loans sheltered the blow, and no evidence that the unemployment insurance replacement rates slowed recovery. But we don't have strong identification of those effects, but at least the first order patterns don't point to that. So I will stop there. I think I'm a little bit early.
Yeah, thank you very much, Jesse. The later open discussion thanks you for the extra time. The next paper, we're going to pair these two papers before we go to the discussants, is tracking public and private responses to the COVID-19 epidemic, evidence from state and local government actions, and the presenting author is Sumedha Gupta.
Thank you. I'm going to share my screen now.
Great.
Sorry about that. All right. Thank you for the opportunity to present this work. Today I'm talking about mandated and voluntary social distancing during the COVID-19. I'm Sumedha Gupta, I'm Assistant Professor at the Department of Economics at IUPUI. And this is joint work with Kosali Simon and Cody Wing, both at Indiana University. The primary response to the COVID-19, the primary non-pharmaceutical intervention to mitigate the transmission of the virus has been social distancing. And our work finds that a large amount of social distancing has occurred, but we also find that a lot of that happened prior to the state's mandated stay-at-home orders. And it, in fact, also occurred in states that never implemented stay-at-home orders, which seems to suggest that the substantial decline in mobility was at least in part due to private response to new information about the risk of information than policy induced. So it seems that these findings highlight that individual behavior can play an important role in the dynamics of the disease evolution. And of course, there is a big body of literature starting from Kermack and McKendrick based in the SIR models that traces the dynamics of the disease. But there is a smaller body of econ epitype models which nest individual behaviors within the SIR models and find that individual behavioral choices these adaptive responses may reduce the infection transmission, which the SIR models traditionally do not take into account. And there is, of course, a much larger body of literature which looks at the production of health as an investment as well as consumption. And in this work, we sketch out a very simple micro model of the individual behavior of social distancing, not of transmission, but of the behavior of social distancing. So in this model, an individual maximizes the utility, which is based on 3 commodities. There is the regular kind of commodities, like you go to a restaurant, you enjoy a meal, and then there is occupation, which generates income, and then there is the health status of the individual. And each of these commodities which go into the individual's utility function are produced with market goods, with the time which is devoted to the production of those those commodities, and the amount of physical contact involved in that commodity production. The health production function also has inputs of market goods that go into it, the time which is spent in producing health, and then also the physical or the social interaction with people. But in this case, it enters with this parameter rho, which is an exogenous parameter and captures sort of infectious disease risk environment. So if in a normal environment, when there is no epidemic going on, this rho is normalized to 1. But in the case of COVID-19 now, where the risk of transmission is high, individuals, when they maximize the utility, the derived demand for the social interaction might be lower in this case. And of course, then we have, of course, the optimization is done with respect to the budget constraint and the time constraint. With this model, so while this model helps us motivate the fact that individual behavior can lead to lower social interaction, what it does not take into account is that there are externalities here. Lower social interaction, individuals are not taking into account that lower social interaction has a positive externality on other people. And as a result, there is market failure, and there is role for government policy. And there are several policy instruments which might be possible. There are more nuanced ones where you could have targeted ones where you tax certain kinds of social interaction, but those may not be feasible in the short run. In the short run, when an epidemic hits, then most likely governments are, the options they have is like emergency declarations and shutdowns. In the case of COVID-19, the state and local governments have taken those initiatives of implementing social distancing inducing policies. And the federal government, so far at least, has been mostly focused on the financial help part of it and the economy. So what kind of policies have we implemented? And we, of course, most of us have heard of stay-at-home orders, but actually there are about 15 to 20 different measures which were taken. And we have collected data on this from different sources, including releases from the governor's offices, data collected by University of Washington and Boston University researchers. And after we sift through all of these, there are about 7 to 8 prominent ones, which I plot on this graph. On the x-axis is the timeline starting from early January, when the first case, which is the purple line, when the first cases started to show up in the different states. And on the y-axis is the percentage of the US population that is residing in states that have been affected by those events or policies. And we find that very quickly, starting from the 20th of January, by the first week of March, all 50 US states had first confirmed case of COVID-19. And around the start of March, states started implementing emergency declarations. And soon after that, it was followed by school closures, gathering restrictions, restaurant and business closures, and only towards the second half of March and the end of March, states implemented stay-at-home orders and non-essential business closures as well. So together, although these are a whole bunch of policies, we can think about them in our work. That's what we have done, is to think about them in 2 different ways. They bin them as informational events, which are like first confirmed case, first death, and emergency declaration. And they're informational and not restrictive directly. They do not mandate social distancing, but they are information which people might perceive as a sense of urgency that, okay, now the epidemic is at my front door and I need to socially distance. And then there are mandates which directly restrict social interaction, which is like school closures, restaurant business closures, gathering restrictions, and stay-at-home orders. The reopenings looked somewhat different. So on this plot, again, on the x-axis is the timeline. Each state is represented with its timeline, starting from the stay-at-home orders represented with the red scatter dots. The orange scatter dots represent the timing of their announcement of reopenings, and the blue scatter plots are the actual initial openings. You can see there's a whole lot of variation going on. There are states like South Carolina, which closed pretty much in the beginning of April, and 20 days later they reopened. There are 5 states which never had stay-at-home orders, but had official initial reopenings. And there are states which opened everything right away. There are states which opened things very gradually. So unlike stay-at-home orders, which are somewhat homogeneous across the states, reopenings are relatively heterogeneous in terms of what exactly they mean. So how much social distancing did actually occur? The usual data sets which are at our disposal do not have good measures or high frequency measures of social interaction. So we have used in our research data from cell signal aggregators, Apple Mobility, Google Mobility, Place IQ, and SafeGraph. And there are a whole bunch of measures. We have considered about 12 different measures. And why it's important to look at these different measures is that they capture somewhat different subpopulations. They have more or less representation in different geographic areas. They capture different types of app users. So it's really important to examine several of these measures to assess the robustness and the generality of these results. So what exactly did mobility look like during COVID-19? So here I present 2 plots. These are looking at the one on the left, which is labeled as the mixing index. It comes from Place IQ. Mixing index measures the number of smart devices in a specific geographic location. And we take that as a measure of a proxy of social interaction, and therefore it's important for transmission. On the x-axis is again the timeline. We look at the period from mid-February to about start of June. each of these faint gray lines represent one of the 50 US states. The line turns red when the state implements stay-at-home orders. And then the line turns green when the state officially reopens. The solid black line is a smooth 7-day moving national average of these. Right away, we can notice that there is this big drop in the mixing index around the mid of March and prior to the states implementing stay-at-home orders, which is the red part of these lines. And again, looking at the beginning of May, end of April, we again see that these mobility measures start tilting up before the lines turn green. So people started moving before the states officially reopened. We see a similar pattern if we look at another mobility measure, which is the fraction leaving home. This is the measure that comes from SafeGraph. And in this, we again notice the same pattern. Mobility drops before stay-at-home orders and starts increasing before initial openings. And not only this, I talked about 12 of these. You can keep going through the whole list of the mobility measures, the same pattern over and over again, over and over again. You can see that. These are two measures which measure the amount of time people have been spending at home. One is called the median hours at home. You find a significant jump up middle of March, and then the time at home starts going down before the policy initial reopening as well. So clearly, there has been private responses before the policy have been implemented. So how much of this response has been policy? We evaluated that using standard event study regressions, in which YST is the amount of mobility in state S at time t. And then we have all these dummy variables to event through time. And WST is a vector of state by day, temperature, and precipitation, because we don't have mobility data from previous years. So this is a way to adjust for seasonality. We have state and day fixed effects, and we have standard errors clustered at state level. So what is the effect of the policies on closure? Providing, here I plot two of the event studies. One is the effect of emergency declaration, which is an informational event more than direct mandates on social distancing, on the mixing index again. And the second one is the effect of stay-at-home orders on the mixing index. The gray vertical line represents the period before, the day before the implementation of these policies or events. And right away we see that following the emergency declaration, there is a significant decline in the mixing index. And after the stay-at-home orders also, there is an immediate significant decline, but this is much more short-lived. And these estimates are, of course, noisy because these are daily measures. But we do not find evidence of significant pre-trends in this. But these are, of course, I've talked about a whole bunch of policies, whole bunch of mobility measures. So in this table, I try to summarize that what about the effects of other policies and the other mobility measures? Overall, we find that for the informational events like first confirmed case, emergency declaration, and first death, within 5 days, so effects after 5 days, there's a 1 to 14% decline in mobility following the informational events. And after 20 days, we find from about 9 to 52% reduction in the as a result of the informational events. Comparing that to the mandates like school closures that stay at home, the gray shaded cells depict the event studies in which the pre-trends were significant, so the parallel trend assumption is violated. So we will not causally interpret those. But here also, for instance, looking at school closures, we find that there is a significant decline, but these are of much smaller magnitude as compared to the informational events. So in this case, of course, we have noticed that both policy as well as private responses have mattered. So it's interesting, it's relevant to see that how much of the decline in social mobility has been due to private responses versus policy. And we can use our event study estimates to try and decompose that effect. So if Y hat ST is the fitted value of state S on date T from our event study regression, then the estimate of the counterfactual mobility in absence of policy is Y star ST, which is the difference between the fitted value from our model and the estimated coefficients effects of the post period. So doing
Netta,
that,
you should start wrapping up pretty soon.
Okay, thank you.
Thanks.
So we can do that for each state based on the timing of policy. And if we take an average of this across as a national average, looking at the effect for the mixing index, we find that between the first week of March and the second week of April, there was a significant decline of 142 points in the mixing index. 35% of that came from prior secular change, and about 65 of it can be attributed to policy changes. So the policy effects of reopening, again, just to recall, people started moving before the initial openings. Here, the effects are much more noisy, but here also, while we don't find anything for the mixing index, and there are some pre-trends, though not statistically significant, we find a small increase in fraction at work as a result of state reopenings. Again, I'm not going to go into the details, but across all the mobility measures, the effect of reopening has been smaller in magnitude, but we do find some statistically significant effects. And decomposing between the effect of policy versus secular changes, we find for the fraction at work, for instance, that in this case, about 70% of it has been due to secular change, and a smaller share of about 30% has been due to policy. So to conclude, both private response as well as policy induced social distancing has occurred during the closures as well as reopenings. And in the case of the closures, we found that informational events were more effective in inducing social distancing than hard mandates. And that's important for us to know, because for future epidemics, as well as potentially a second wave that we might be looking at, to know that which policies are most effective as NPI at lowest cost. So potentially targeted policies. So thank you.
Thank you, Samudha. That was very clear. The first discussant is Carolyn Bucky.
Hi, let me just share my screen. Okay. So thank you for inviting me. I'm the caveat here, I'm an infectious disease epidemiologist. I'm an associate professor at the Harvard Chan School, and I am not an economist. So I should just be very clear about that. I'm going to talk about the epidemiological aspects of this in relation to the non-pharmaceutical interventions, and just give some opinions or some views about how epidemiologists think about some of these kinds of issues to do with timing in relation to the epidemic, and what kinds of indicators we can use to look across states and look at heterogeneity in space. I'm just showing this graph because I think it illustrates nicely the nonlinearity inherent in epidemic processes and the geographic and temporal differences between different parts of this country. So of course we had early outbreaks in New York and New Jersey and other states on the coast. And then, as we've now seen, we're gradually moving into the other parts of the country, the South and the Southeast. And I think one important thing about that is that it means that people are reacting not only to messaging on a national level, but also to their local environment and the extent to which they perceive risk to be real to them and relevant. So I'm just going to talk about three things, really. The first thing is about this mobility data that has just been presented. I've worked with this kind of data for a long time, and I think it's not totally straightforward to interpret. Next, I'm going to talk about testing data. In one of the papers, testing data was used. I just want to talk about some of the epi aspects of that. And then third, just thinking about nonlinear dynamics and how we think about timing of policies. So just by way of introduction, I'm part of I started a network to analyze mobility data to support operationally policymakers around the country and internationally. And we've been working with multiple sources of data on quite local levels. And I've been doing this work for a long time now using mobile operator data as well as data from apps and ad tech and so on. So I just want to point out a few things about this kind of information. So normally we think of this data in an ideal world, this kind of data would be like so. So you have a person and you're able to monitor their movements over time, and you have users, and together that gives you a picture of what's happening. So that is one kind of data that you can have access to. There are many privacy frameworks and different types of aggregation that has to happen in order for this to be safely shared. But fundamentally, we think that this is kind of the underlying kind of data that we're getting. For many data providers, however, especially providers like SafeGraph, when they talk about monthly active users, that is the total number of users altogether, but there's a ton of churn. So that's a very different thing than actually people appearing in your data set consistently throughout the month, or indeed daily users in a certain place. So although there may be many millions of people in the monthly active user axis, that actually doesn't mean that there's necessarily lots and lots of people in your data set. So there are some representativeness issues. We have started to look at comparing all these different data sets against each other. This just shows you a preliminary analysis looking at Google, Cubic, ad tech data, Facebook data, Mapbox, and so on, and trying to understand what these metrics mean. So a lot of data providers are putting out matrix like regular data about mixing indices and dwell times and stay at home, fraction of users staying at home, and these kinds of things. They're not all calculated in a standard way. The mathematical notation around how you do the aggregation can vary a lot. The representativeness varies a lot also. So there are some issues. This is from a paper that we were looking at county level variation in different characteristics that are relevant for COVID-19 in particular. And if you just look at this population over 70 years old axis, it's variable within states and variable across counties. And so if we imagine that smartphone users who are going to be represented in this data are generally younger, we are going to have both geographic biases and demographic biases that are important to think about. So the other thing is the metrics look different depending on what you're looking at. So this is just two examples from random counties, Suffolk County, New York, and one from Louisiana. And we're looking at movement in and out of a particular grid square compared to movement within, which might be more like the mixing index that we were looking at before. So the first thing is they look different, although maybe the trends are similar. These fits aren't very good, I'm afraid, but movement in and out, which is what we think of as kind of commuting patterns potentially, those are showing a stronger response. But again, depending on the county, we're seeing different fraction reduction. So this issue of trying to explain reductions of a certain percentage of reduction in mobility, it might mean something very different in New York compared to Louisiana for many reasons. And so interpreting percentage change in some of these metrics is challenging. And I think we need to be aware that there might be some systematic differences in different parts of the country and how we interpret those. So now I'm going to talk about testing. And this has been the bane of epidemiologists' life since the beginning of this outbreak. Confirmed cases is a very poor indicator of where we are with the epidemic. Sometimes it's all we have, but it's really problematic. So this is a paper from Mauricio Santillana looking at the correlation between new cases and new tests. And you can see the strong positive correlation. Essentially, this says the more testing you do, the more cases you find. So that means that what we're looking at when we see changes in the number of cases happening over time, we're seeing some combination of the true epidemic curve and whether we're able to test for it or not. So this just shows for these 3 states as well, we've got the new cases in red, the new tests in blue, and in some places we have sort of a problematic relationship between those two things, which makes it very difficult to use case counts, especially as you've got this distinctive nonlinear dynamic associated with it. And so for an infectious disease epidemiologist, we don't use obviously linear regression or even quadratic regression when we analyze this highly nonlinear data, because the timescales are very short and things are changing quickly. If we use an SIR regression, so we fit it to a mechanistic model, then we can understand what's going on, we can make predictions, and we can interpret the coefficients of our model more effectively. And so this is some work that I've been doing in collaboration with Nick Menzies' group at Harvard. Because testing is so weak as an indicator of the epidemic, instead we use deaths. We fit death data, which we think is more reliable, although still not completely reliable. And then we use an SIR kind of framework to back calculate what the incident infections were that must have led to those deaths, because based on the premise that the test data itself is unreliable. So we have modeled outcomes of incidents. And if you use that as an indicator instead, then you can see that there's going to be variable number of kind of estimated cases despite what were being reported at the time. So just to point out that that's a difficult thing to keep track of. And in fact, in order to look at linearities, one thing that we can do is look at the reproduction number. So use the growth rate, which should be something that is going to change in a more step-like way in relation to these social distancing metrics. So if you measure the reproduction number over time, instead of trying to fit case counts, then you can get a growth rate, step changes in the growth rate, and you can compare that to your mobility patterns. So we have seen today that the stay-at-home orders were somewhat variable across states, but everybody actually seemed to stop moving in mid-March. And that's consistent with what we find in the epidemiology as well. So this paper is from Laurie Gardner's group, and they used data from Teralytics, which analyzes mobile operator data. And here you can see they've measured a sort of a social distancing ratio, which is a metric of mobility. Again, quite opaque to interpret this, but similar to what we've seen, right? This big drop, as Dr. Gupta was showing us before, mid-March, despite differences in the social distancing. And they measure this change in mobility in relation to the growth rate rather than cases, and then they're able to estimate how efficacious the lockdowns were. In fact, when we looked at this step change function in the reproduction number, and we compare the estimates of when the growth rate in the epidemic changed to when the mobility patterns changed, it converges among all county, each of these dots is a county, to that date. There was this step function change in the growth rate of the epidemic around the middle of March. So this really confirms and is consistent with the analyses that we've seen here, that the lockdown orders themselves, people's behaviors were changing before the lockdown orders themselves, irrespective of kind of what was happening locally. But of course, that depends on very different epidemics that were happening in different places. So in that mid-March region, new cases were taking off in New York, but there were barely any in Texas. And I think that probably played an important role in what happened subsequently, and and the extent to which these mobility metrics are actually good indicators of what was happening with social distancing or not. The last thing I would say is just that we have a lot of micro heterogeneity in the epidemic itself and in the behavioral responses to social distancing orders. So this is a paper that we wrote where we looked at the seroprevalence. So how many pregnant women coming in to deliver, how many of them had antibodies, so had already had the virus in New York. And what you can see was that there's this heat map just shows the estimated prevalence. In some parts of New York, we had a quarter of the people have already had the infection, whereas in Manhattan, very few. And when we looked at commuting patterns, so this wasn't all mobility metrics, this was a very local look at commuting one way in the morning, the other way in the afternoon, you can see that it correlates perfectly. And here's the correlation between the decline in commuting movements and the relationship with seroprevalence. So that's to say that a lot of these metrics on a state level or even on a county level are obscuring important heterogeneities at a very local level. And we think that, you know, this picture is driven, of course, by people that were not able to social distance and continued having to commute for work. So we can start to understand maybe something about what that means in terms of which jobs did people keep having to do and which areas were able to social distance and stop working or not. But these are quite local differences. So the conclusions are, I think that there's great consistency between some of the two papers in terms of the messaging and the orders were, at least on the lockdown side, didn't seem to have a huge impact on changes in actual behavior and on the epidemic itself. The lockdowns were effective, but people locked down just all at once rather than because their state told them to. These non-linearities and the variable timing that are intrinsic to epidemic dynamics and the local heterogeneities are very important. And then both testing and mobility data have very important limitations. And I think sometimes to use them too precisely as quantitative measures is problematic. And then the last thing I would just say as an epidemiologist is, I think the discussion of the economics and labor markets is fascinating, especially as from an epidemiological point of view. We are very, very far from this epidemic being over, and we may well have to go back into lockdown again. Or if not in lockdown, makes major adaptation to the current policies. So it will be interesting to see how the public responds to further changes in that regard. So I will stop there.
Thank you, Carolyn. That was really helpful, and I'm sure we'll spark more discussion afterwards. The other discussant is Victor Chernizukov.
Okay, thank you for the interesting presentations and discussions. I just want to say that I find all of these studies are very interesting and very innovative. Lots of interesting new facts, like also using modern data, private data. Can you see my screen fully? Yeah. And what I will do, in my discussion, I will mostly focus on the effect of NPIs on behavioral and economic outcomes, and also I'll highlight the connections to some complementary findings that we've reported in this paper, which is called Causal Impact of Masks, Policies, Behavior on Early COVID-19 Pandemic, where we did the sort of exercise that Caroline described. You look at the growth rates in deaths and cases, you control for the testing rate for cases, and you study the effects of policies, behavior, and masks. So like we as part of the analysis, we did touch upon the effect of policies on behavior, because this is one of the channels through which policies realize themselves. And maybe I'll raise a minor methodological point about the fixed effect estimators at the end, if I have time. So I enjoyed reading the first paper. They really document well the collapse of the labor market, the small business labor market. It was extreme and sudden. Everything happened in the last 2 weeks of March. Turning to the effect of NPIs, the paper focuses only on the shelter-in-place policies and finds the effects are small. When I was reading this paper, it gave me the impression that other NPIs played relatively small role. And I want to highlight in my discussion that, well, it's only one of the policies, and there were many other policies adopted exactly in this last 2 weeks of March, and I'm going to highlight that their role, hopefully. The second paper also focuses on shelter, stay-at-home policies and emergency declaration as purely information policies, and establishes the association between this mobility and these policies. They find that during the shutdown phase, the large decline in mobility happened whether or not the stay-at-home policies were mandated. And then therefore they proceed to suggest that a substantial share of the observed decline is a private response to the new information. In particular, the case announcements, emergency declaration reduced mobility by large amounts, essentially all of the observed decline. Again, I want to kind of raise here a gentle objection. While shelter is only one of the many policies, also the informational effect of the emergency declaration alone is unclear to me. Personally, I actually didn't pay any attention to such declarations until the schools and restaurants and the gym got closed. And to me, the causal channel of school closures is super clear. There are hard policies restricting mobility, like parents have to stay at home if schools are closed. They probably don't go, like with smaller children, you don't go out as often. You just order food out and things like that, right? So then I'll just look at this some of these data cuts that we have also looked at. So here's the Google mobility behavior shows big drops in time in work, retail, transit in late March, followed by another decrease in April. Like this is workplace intensity, retail intensity, transportation intensity. And the question, of course, how does this relate to policies? Well, there's state of emergency, which is a pure declaration, but it's a pure declaration that allows governor to issue a package of executive orders, like the hard policies, such as school closures, non-essential business closures, restrictions on restaurants, like movie theater closures, gym closures, and so on, right? So by mid-March, these emergencies were declared, and they were like right away they were followed by school closures, followed by more slow rollout of the other policies. So here's the plot for the rollout of policies. Like, yeah, you see the school, like almost all school got closed. Yeah, everything got closed within 2 weeks of March. But the other policies were more, they were rolled out more gradually, maybe except for the restaurant closures. So like what's okay, so that's one point. When I look at the correlation, and these are like week level, like we always work with MA7 data, like MA smooth data. So this is, you could think of this as weekly correlations. The emergency policies that are purely declarative are super highly correlated with hard policies such as school closures, and less so with restaurant closures and movie closures. So for example, the correlation between the state of emergency and school closures is 95%. So personally, like I wouldn't if I have to assign some efficiency to the policies, like I would be more careful. I wouldn't want to say that the effect was purely informational, just looking at this correlation alone. Second point that I want to make is that the school closures had very little cross-sectional variation. So what it means is that we have we're going to have an identification or attribution problem. It's going to be hard to tell apart the school effects, closure effects from the general information or private response effect. So the policy evaluation results are going to be very sensitive as to how we model the time effects. So perfectly flexible time effect models, like the fixed effect time effect models that are being used, will mostly observe the school closure effects due to lack of cross-sectional variation. As a result, we may end up incorrectly allocating, attributing time effects to private response to the information, where in reality, I think there's little identification. In fact, the opposite could be true. So here's just to illustrate this point, here's an exercise that we did where we predict this Google mobility time at work, retail, and transport 2 weeks out using various policies in place. So, and then we have two sets of specification. One is with rich specification for the time effects, and one with the less stringent specification for the time effects. You do find like each of the policies matter, but the school closure effects are like really large if you don't control for time effects flexibly. If you control for the time effects flexibly, the school effects are much smaller. So the truth is probably somewhere in the middle. Like if you don't do flexible time effects, like the policy maybe explains like more than half the observed decline of the effect. The more than half of the observed decline, and with flexible time effects, it maybe explains roughly half of the observed decline. That's what this table shows. Another point that I want to make, it's more probably it's more minor. So here we're using this fixed effect estimators. You have this latent. Sorry, you have the dependent variable, which is typically a growth rate. Then you have time varying policies. You have latent effects, FIs, which are also called fixed effects, and they're correlated with the XITs. You could also have time effects as part of the XITs. And the assumption, the standard condition for unbiasedness of the fixed effect estimators of beta is that these innovations here have to be orthogonal to the leads and lags of XIT. So they have to be orthogonal to the leads and lags of the policies, and then the informational variables, which I think it's just probably not, maybe true, maybe, but certainly not true for some of the specifications that are present in many of the COVID papers. If T is short, and I can argue that T is short, then there's going to be substantial bias in the fixed effect estimator. This bias is still this estimator is still consistent, but it will have a bias. This bias needs to be removed. An alternative approach would be something called correlated random effects approach or mixed effects approach, where you just model FIs as using time invariant covariates and so on. And this is actually what we did in our paper. We went with correlated random effects approach. However, I want to say that one could do the fixed effect approach estimation with debiasing. And in our tries of debiasing the fixed effect estimators, for example, we noticed that it materially impacts the estimates. So for example, shelter stay at home effects, they were materially larger after doing bias correction. And I also want to make this point here that the T here is short. So the debiasing is going to matter when the time series dimension is short. And what is T here? Well, T is, roughly speaking, is the number of approximately independent blocks of data. And so T is probably counts it's probably proportional to the number of weeks and not to the, is probably closely related to the number of weeks rather than number of days. And therefore I could say, yeah, it's short. And if T was large, that this debiasing wouldn't actually matter. And if one is interested more in this, we have like an expository paper on this where we reanalyzed the causal impact of democracy on growth, and we also found that after bias correction, the effects of policies was much larger than without bias correction. And then we have Stata in our code available if anybody wants to use it. That's it on my end here.
Okay, thank you, Victor. You can unshare your slides and we'll open up for discussion. I'm gonna go to the attendees. We have a few hands up already. I'll start with Jason Furman.
Okay, great. My question is for Jesse, and I wanted to know if, we're still seeing 2 million UI claims a week, including pandemic. So a lot of people are still losing their jobs. Do we know anything about the different characteristics of the types of people or the types of jobs that are being lost now compared to 2 or 3 months ago? How many of them might be sort of secondary, more normal recession-like, as opposed to primary, directly impacted? And what might any of that mean for the trajectory of employment going forward?
My co-authors can jump in as well. That's a good question. I think we're seeing some evidence. I'm drawing not on our paper, but on Sylvan Wachters' work with California unemployment insurance claims, that the people who are filing claims now are less heavily selected than the people who were filing claims at the beginning. At the beginning, it was very heavily less educated workers from particular industries, and they're looking more representative now, which I think is consistent with the idea that we were shutting down these couple sectors, and now we've got something that's becoming closer to a real recession. But it's still pretty fragmentary and pretty indirect.
I'll share a quick graph from our paper that I think speaks a little bit to this. So this shows from the CES. This is the payroll employment by month by industry, and you do see kind of like the pattern that we had, like leisure and hospitality and other services decline, especially at the start. At least through May, you're not seeing necessarily an acceleration of kind of like durable goods, manufacturing job losses or construction job losses. If anything, like the construction sector seems to have rebounded more than some other sectors. And so they might look different in June, but at least some of the kind of aggregate data through May is not seeing quite as much of those of kind of more typical recession drops as I might have expected actually prior to May.
Thank you.
Great, thanks. The next question will be from Hillary Hoynes.
Hi, thanks so much. This is a little bit speculative, but I wonder if you could indulge me in speculating. And that is, it seems like one piece of the labor market, the stuff you show is super clear and extremely spot on for, as you point out, the home-based coverage is very appropriate for measuring what's happening in real time, which is great. But I wonder whether, could there ever be a day that we could match up who gets the PPP with your home-based data? Because it seems like one really big thing that I'm not understanding is the extent to which that actually led to changes in the connectivity of workers to firms, who got it, did it end up where we would have hoped, and many other aspects and understanding role of that in the evolution of the labor market. So I wonder if you guys could speak to that at all.
So I can handle that, Jesse. So we can't, I think right now we haven't done that yet, but we've been collaborating with a team of other folks at Harvard, Zoe Cullen and Glazer, Michael Luca and Chris Stanton, to do a firm survey of the home-based firms. And we've gotten, which we've closed recently, that includes questions about whether or not you've applied, whether or not you've received PPP. And so I think with that other team of folks, I think we're going to see if we can use that to try to kind of directly look at the effects of PPP receipt in a more direct way, in a more kind of quasi-experimental setup than the analysis without that firm survey that we did here.
So was there ever going to be a public listing of those firms?
Oh,
so Hillary, I'll just add one thing there. So I think up until last week, there was, kind of only the data at the state level was going to be available, and some breakdown by firm size and by loan size. And it seems like the Treasury has just decided they're going to make more data, kind of more data public that would identify the name of the companies that received the money, at least for the bigger loans, if I remember. So I think it is not all of the question, that we require getting some kind of agreement with Homebase that, this administrated data, if it does indeed become available, could be linked to the tens of thousands of employees we have in Homebase. It's not all of the question.
Thank you.
Okay, let's take the next question from Steve Goss.
Jan, thank you very much. Can you hear me?
Yes, we can. Go ahead.
Oh, wonderful. Okay, a quick question, probably largely for Caroline. There's been a lot of talk about seasonality, and people have looked at Brazil, for example, but of course, Brazil's in the Southern Hemisphere. so opposite seasons to us, and they've had a surge. Now, where the EU has had great results over the last several months coming down, the US not so much, is part of the EU's success related to seasonality, and they may not be as lucky come the fall. And if they won't be, then how will we be doing in the US come the fall?
So the other circulating coronaviruses are quite seasonal, and we see a strong effect in the summer. There's likely to be some seasonal effect for this one, but probably not huge from what we can tell so far. With, again, the main risk factors being, crowding indoors and so on. So I think the relative success or lack of success in the US compared to the EU is largely a policy failure, testing failure, messaging and social response issue. I don't think it's to do with seasonality. Having said that, in some of the southern states in the summer, it's very hot outside and we will have people indoors, and that seems to be very problematic, and why we may not have had upticks in cases from the protests, for example, because they were outside. So I think it remains to be seen. My best guess is that there is some seasonality, but that's not the dominant driver. Are we worried about the fall in the US? Absolutely. And that is to do with school openings and potentially colleges going back, and as well as this winter month issue that will bring other seasonal viruses on top of this one, as well as the flu season and so on. So if that explains it.
Okay, thank you.
Okay. Thank you for that. There was a question that came up in the Q&A that you answered, Carolyn, but other people might be interested in knowing. Henry Aaron asked about treatments and whether improved treatments were factored into any of the modeling or whether that was showing up in the data. So we've talked a lot about spread and death, but we haven't talked about treatments. Can you pick up that thread?
Sure. The question was about whether the trends in deaths can be related to changing in treatments. Maybe partially, but there haven't been any big breakthroughs on treatments. There was a recent trial of dexamethasone that shows partial reduction in mortality in people that require supplemental oxygen. And of course, there are many other trials ongoing. Those haven't been rolled out widely yet. So I don't think that they're having a massive impact on treatment and the death rate. What I think it has happened is that at the beginning of the outbreak in this country, we had a huge fraction of deaths occurred in nursing homes and assisted care facilities. And subsequently, as we've had this reopening, we're seeing many more cases in young people. So of course, they have a lower mortality rate anyway. So it's quite hard to disentangle whether that's a demographic shift reflecting transmission, but also probably social distancing behavior where older people might still be distancing, whereas younger people are less so. And we're just seeing a shift in age group as well. It's hard to disentangle exactly what's happening, but that I suspect is going to be one important factor.
Okay, thank you very much. So let's go back to the authors for their responses. Let's start with the first paper. Jesse, Marianne, I don't know who you want to have give some responses to the discussants and to the Q&A.
I can go. So I'll handle a couple of the first ones, and then I think there was one you were going to handle, Jesse. But I think the first one of the first big comments that I think came up in both Victor's discussion and Caroline's discussion, what I think is totally spot on, is that we had kind of in this first analysis focused on the shutdown orders. I think for a variety of reasons. One, just because that was what we were most confident we were measuring correctly, and then because it's kind of been like some of the most discussed policies. But we totally take as a spot on comment that we should kind of incorporate the fuller set of policies into our analysis, and it's something that we can definitely do in the next draft. I mean, particularly given the daily data of the daily nature of the home-based data does give us some capacity to kind of look at relatively fine measures of timing. Just one kind of clarification I would like to say, make sure that we said, is that we're not, at least in our analysis, taking a strong stance that the time effects are information per se. Like our interpretation of those was that they reflected kind of reduced consumer demand for in-person services, which could in part be a function of schools being closed. That changes how parents consume in-person services, which I think a lot of anecdotal evidence that that's true. But I think totally it's spot on that we should kind of look at this kind of richer set of policies, and I think that's definitely going to be one of the things that's on the top of our to-do list going forward.
I can take on just the question about the nickel bias issue. We've estimated a bunch of different models trying to do this. We presented the basic fixed effects models in the paper, but we've also done synthetic control style models that match on pre-treatment outcomes, and you get very similar results. I think in theory, there's an issue. I'd be surprised if it's a big issue in practice in these models. And these panels aren't all that short when we're looking at daily data. We've got 30 days before the treatments happen in some cases, I think, in the models. So I'm not as worried about it, but obviously it could be an issue.
Yeah, and one thing that we haven't done yet, but that actually is possible given the nature of the home-based sample, is we have home-based data for 2018 and 2019. And just for simplicity, we haven't done a ton with that previous period data, but we can kind of, to some extent, extend CAP-T going back, which should also help.
I mean, I think there's some concern that, I don't know, that state fixed effects are stable over time, and maybe that the specification gets wrong if we start to put in 2 years of data in there. But
okay, thanks. Any comments, responses from the second paper, Sumedha, Kosali, Cody?
Yeah, I will start by thanking the discussants for their comments. Starting with Caroline, I think I couldn't agree with you more. I agreed with like every slide you put. I'm like, yes, that makes perfect sense. Lots of heterogeneity, completely. I noted that as well. We've noted that in the manuscript as well. And I think that is what you said, that we do need to look at all these measures. They're saying different things. They are very opaque. We don't exactly know all we should know and want to know. And hopefully as we move forward, because these are so new, at least to econ research, unlike the experience you have for a while, that we are hoping to discover more about how exactly they are capturing these things. So right now our approach has been, let's look at all of them. Let's look at all of them and see if they give us a consistent story. And if they do, we feel a little bit more comfortable saying, okay, maybe not the exact magnitude number, but it seems that generally this is the direction of the effect. So that's for Caroline. We did do some of the analysis looking at some local, I did not have the time to present them, but we looked at some like rural versus urban differences and things, and they are in the manuscript. And yes, they're important. We find very different effects in those. So points well taken. With Victor, I'm very curious to find out more about your bias correction, and we'll definitely look at the papers to see if we can implement it. Regarding the emergency declarations versus stay at home, I think the point is true that if you look at the entire timing of this, all of this happened within 3 weeks, the whole bunch of the initial policies, and maybe the stay at home orders stand a little bit further down the line. And so it is really hard to disentangle the effects of each and every one of them. And I think the way we discussed it in the manuscript, and I should mention here as well, is that we think of the emergency declaration sort of like a reduced form effect for the bunch of these policies. It almost is like it triggered the start of what can be considered as a whole bunch of these policies. But yes, it's hard to we did do some estimations by including controls for all of them, by having linearized event time studies to see the effects for all of them simultaneously. But I agree that it's hard to distinguish. And I think we only want to say that there has been a private response, which is very large. There is obviously some policy response, whichever that policy you want to think about and you feel you're confident you can disentangle in that short period of time. But yeah, point well taken. Thank you.
Others? All right. Terrific. Thanks to both sets of authors and both discussants. Carolyn, I hope it's not your last economics conference. And we will take a break until 3:20. We'll come back for the next session with the Steve Davis reallocation paper. And we'll see you in a few minutes. We'll be back in this same link, so you can just pause from this session. Steve, you have your slides ready to
I do.
flash up? Perfect.
Hope I can keep up with this great program. It's been really good. So seriously, it's set a very high standard.
Welcome back, everyone. We're ready to start session 5 on macroeconomics and epidemiology. The first paper is titled COVID-19 is also a reallocation shock, and the presenting author is Steve Davis.
Okay, have I succeeded in sharing my screen or not?
Not yet.
Not yet, okay. Okay. Tells me I have to grant privacy access, which I've done many times before. I'm not sure why it's asking me that now.
Stephen, just to save time, this is Anna. I can pull up your slides if you've sent them.
Yes, I have.
Okay, give me 2 seconds.
Okay. I'm trying, as you try, I'm trying.
Oh, Steve, I think you got there first.
All right, great. Great, okay. So this is joint work with Jose Maria Barrero and Nick Bloom. We are delighted to be part of what's really been an outstanding Brookings program. So the thesis of this paper is stated in the title, okay? So to use the word unprecedented again, you know, we've had an unprecedented contraction in economic activity with interesting demand and supply elements. The focus of this paper is though on another aspect of the COVID-19 shock, and that's the reallocation aspect. The paper provides multiple types of anecdotal and systematic evidence to try to flesh out this reallocation shock or the reallocation aspects of the shock. In my remarks today, I will focus on 5 types of systematic evidence. The first bullet point speaking to the short-term reallocative aspects of the shock and pretty much the near-term wake of the pandemic. Point 2 is about the large share of pandemic-induced layoffs that are likely to be permanent in the sense that the job losers don't return to their old jobs. I'll then turn to some evidence on the work from home phenomenon, both trying to quantify the magnitude of the existing shift to work from home, but then more novelly, providing evidence on the anticipated post-pandemic shift in working from home relative to the situation before the pandemic. And then perhaps the most novel methodological piece of the paper, not necessarily the most important evidence, is we're going to use firm level forecasts of their own outcomes to construct forward-looking measures of job reallocation and sales reallocation. And then I'll briefly talk about some evidence on from the stock market before turning to policy implications. So Nick and I are involved with a team at the Atlanta Fed that fields a monthly survey of business expectations called the Survey of Business Uncertainty. We also use this survey to field timely questions on topics of interest. Here's 2 special questions we asked in the April SBU. We asked the panelists in our firm, and these are senior executives in the businesses. We'd like to ask you about how developments related to the coronavirus are affecting staffing levels at your firm. We asked them this question in mid-April. We asked them to go back to the beginning since March 1, and then we asked them also to look forward over the next 4 weeks. And we had 5 response categories that you can see written at near the bottom of this slide, covering temporary layoffs and furloughs, permanent layoffs, and so on. So let me start by drawing some evidence from this, the answers to this question. The first is really just a kind of a validation to see whether our answers make any sense. And so if we take the results from the survey, they imply a roughly 14% drop in employment from March 1 through mid-May. And that's very similar to the paper than what's found in the ADP-based paper that John Grigsby presented earlier today for continuing firms over the same time period. So that gives us some comfort that our sample is at least tracking the current outcomes. Now, one thing we could do, because we asked about gross new hires of these firms, permanent layoffs, temporary layoffs, is we could calculate how many new hires there were during this time period from March 1 to mid-May relative to the number of layoffs. So of course, we all know now there are tens of millions of layoffs. There were 3 new hires for each one of these layoffs during this period. And I think we were the first kind of to put that fact on the table. Since then, there have been other pieces of information that have kind of come to bear from other data sources that reinforce that, and I think in fact suggest there are even more hires were occurring during that period. So we can now draw on JOLTS data for March and April, where we see 4.3 hires for every 10 layoffs. Gross hiring rates in JOLTS, weekly business formation data from census administrative records also show lots of hiring activity. So point one is there were a lot of hiring activities, even in the midst of the massive layoffs and enormous contraction that we experienced during that time period. Now, we were also interested in what fraction of these job losses were permanent and what fraction were temporary. So we asked firms to make that division of the data. In the SBU data, the firms themselves, as of mid-April, perceived 23% of these layoffs to be permanent. Independently, there was a Washington Post Ipsos poll that came out a couple weeks after our survey of persons that got the same 23% job loss number. And then just in the last few days, this California Policy Lab data that has come up at least twice earlier today. This is probably the best quality piece of information. And it's basically, it turns out California, when you apply for a claim for unemployment benefits, they ask you, do you think your layoff is temporary, permanent? And they also allow you to say unknown. That also generates 23%. You can try to generate this permanent layoff share of job losses in the CPS. I don't think the CPS is particularly well suited to do that. You need to make strong assumptions. We've done that in the appendix to the paper, but I think the first 3 sources I mentioned are better suited. I'm going to go forward with that 23% permanent layoff share as perceived at the time the response, the survey response or the initial filing. Now, historically, many layoffs that were seen as temporary when they happened turn out to be permanent after the fact. And here we rely on two studies using different data, different methods, and very different time periods. One from Katz and Meyer, and one based on work by Fujita and Moscarini. So what these studies provide for us is the fraction of layoffs that were perceived as temporary that turned out to be temporary ex post. That was 72% in the Katz and Meyer study and 87.5% in the Fujita and Moscarini study. And then they also tell us what fraction of layoffs that were perceived as permanent when they happened turned out to actually be temporary. So if we take those historical experiences and we apply them to the 23% permanent layoff share that's perceived at the time the layoff happened, we get a projection of realized permanent layoff shares of 32 to 42%. Now, if you think about that in connection with the tens of millions of layoffs as measured in UI claims, you very quickly get to something on the order of 10 million or more permanent layoffs in the last, since the crisis really took off in mid-March. So we think that's an important fact to keep in mind. There are many workers who lost jobs and they aren't coming back. That's the central point that we want to take away from that analysis. Now, we've got two sources of survey evidence on on working from home. One is a survey of US residents that we conducted. We sampled 2,500 adults who earned more than $20,000 in 2019, and we asked them about their current work status. And you can see that in the black bars on this chart. And then we also weighted those responses by their earnings, okay? And those are the red bars. And so if I just pick out the fraction of people who were working and earning at least $20,000 in 2019, who are working from home now, it's 50% on an earnings weighted basis, about 42% on an unweighted basis. If we take those numbers and adjust for the people who aren't working at all, what we find is that currently, and this is as of late May, 62% of all labor services in the US economy, according to this survey, are being supplied at home, and 2/3 of labor services on an earnings weighted basis are being supplied at home. So the point there is that's just evidence of how massive this social and economic experiment is in working from home. Now, ultimately, we want to know what's going to happen after the pandemic's over. And here we go back to the survey of business uncertainty, the May wave of this, where we asked questions of businesses both about how much of their workforce was working at home before the pandemic in 2019, and there we paralleled questions from the American Time Use Survey, and how much do they think or do they expect will be working from home after the pandemic is over. You can see on this slide that we get very similar answers to 2019 to what the American Time Use Survey found in 2017 and 2018, which is pretty comfortable. The bottom line number, according to both these sources, is something like 5 to 5.5% of all full work days were done at home before the pandemic. After the pandemic, businesses tell us that they think it's going to triple relative to that 5.5% number. So that's equivalent to taking 1/10 of all full work days and shifting them from business premises to home. Now, if you disaggregate our results, which we talk about in the paper, and you focus on office worker days, what we find there is 1/5 of all office worker days will shift from business premises to home, or coffee shops for that matter, after the pandemic is over. And that, we think, has potentially very important implications for worker spending power inside the business districts of cities, because that's where a lot of office workers work. Now, turning to the forward-looking measures of reallocation. So each month we ask these business executives to forecast their own firm's outlook for jobs and sales at a 1-year look-ahead horizon. And then we use those to construct what is essentially a forward-looking excess reallocation rate that is the analog to what John and I and Dunn Roberts and Samuelson did with respect to excess reallocation of jobs. And many other studies have used these measures, but always in a backward-looking sense. We use them in a forward-looking sense. So here's what we found. You see the averages here for these forward-looking rates, and these are expressed as a percentage of employment before the pandemic struck and in the last 3 months of our sample. Now, we have a rotation scheme in our sample. Each firm, there's kind of a 3-month rotation scheme. So we're actually using different firms to respond in April, May, and June. And we have a modest size sample, so we're trying to maximize the sample there. Basically, what you see here is, according to firms, they expect in aggregate the reallocation rate of jobs and sales to double for jobs and roughly quintuple for sales compared to what was going on before the pandemic. Now, in terms of stock returns, the reason we looked at stock returns is not because it's the perfect measure, but we can go back far in time. So here we're taking firm level data on stock returns, and we're calculating the interquartile range of the value-weighted distribution of firm level equity returns from the last trading day on 1 month to the last trading day on another month. And basically what you see here is this episode we've just gone through stands out as one of the major stock market value reallocation episodes in the last 30 years or so. Now, briefly, why you should expect some of this to persist, and I'm gonna run short of time here, but I wanna make 3 points. And I'll summarize what's on this slide. First, we've engaged in these massive experiments with respect to working from home, consumer spending pattern, and business practices, especially with respect to travel. There's been both learning by doing that makes us more effective at those things and should lead us to expect that they'll continue. There's also been experimentation, so that we've learned in some cases that working from home works better than we think. On top of that, there have been complementary investments by the businesses in making things like working from home and virtual customer meetings work. On top of that, there's been complementary innovation incentives. You can see companies like Facebook are trying to make these platforms better. And then lastly, it's also important to note that in some areas, at least, the COVID pandemic has knocked down regulations that had previously inhibited a shift from in-person to virtual interactions. And I think the most important example I'm aware of in this regard is the delivery of healthcare services, where virtual medicine is taking off, mainly because of changes in Medicare and Medicaid reimbursement practices. Now, on policy messages, our chief message here is that there are many elements of the US policy response to the landscape and legacy features of the US policy landscape that will impede the reallocation of jobs, workers, and capital, and in doing so will slow the recovery. We talk about several categories of these policies in the paper. Since I'm only got a minute left, I'm going to turn to just one example that I think really illustrates some ways in which the initial policy response was, in our view, off the mark. And that is the US Treasury agreement with major airlines, which basically provided tens of billions of dollars in subsidies to the airlines in return for barring layoffs and furloughs before October. And the reason we think that is a mistake is because we think even as of mid-April, it was quite obvious these jobs weren't coming back at anything nearly like 100%. So if you just look at passenger counts, US airports, they're still down roughly 90% or so. They were already down by about 90% when this policy was implemented. If you look at the announcements from airlines, they've already announced major reductions that's in staff that they are anticipating, saying that they don't think things are going back to normal. Boeing has announced that it's cutting jobs, so is its suppliers, because they don't think things are going back to the old situation. So our point is that in circumstances like these, employee retention subsidies for, say, airline industry workers are just delaying the redeployment of workers and other productive inputs to more effective uses during the crisis and afterwards. So zombie jobs are not a path to recovery. And this doesn't mean there's no possible role for subsidies that encourage the maintenance of employment relationships in certain respects. But nuanced versions of those policies have not been put in place in the US, at least not to date. Thanks.
Thank you, Steve. The discussant is Catherine Abraham.
Okay, are you hearing me and seeing my slides?
We hear you, we don't see the slides.
Okay, let's try that again.
There we go, it's coming.
All right. We're good now?
Yes, thank you.
Great, thanks. So it really was trying to make three main points. One is that the large negative shock to many businesses caused by COVID-19 has been accompanied by significant hiring at other businesses. Secondly, that the COVID-19 crisis can be expected to cause significant permanent restructuring. And thirdly, that given these facts, that the emphasis with respect to policy should be towards supporting needed reallocation rather than emphasizing the preservation of existing employment relationships. So I'd like to organize my comments around those three main points. Steve's already talked about the evidence related to hiring since the onset of the crisis. There's been a lot of news stories about companies like Amazon and Instacart and others doing a lot of hiring. The responses to the April survey of business uncertainty indicated that at those firms, along with large numbers of layoffs, there was also a lot of hiring. That evidence is consistent with data from the Job Openings and Labor Turnover Survey and other sources. So what should we make of this evidence? I think it's very clear that while overall demand fell sharply at the onset of the crisis, there have been some firms that have been experiencing real surges in demand. In evaluating this evidence, I guess I think the results from the survey of business uncertainty are very interesting, but on their own, I wouldn't take them as definitive. It turns out that in this case, they're very consistent with other evidence, but I would point out that, as Steve indicated, the survey sample size is quite small. The sample frame underrepresents small firms, so there's potential issues of coverage bias. And if you look back at the response to the survey, starting from the recruitment stage, going on to actually getting firms to agree to complete surveys, about 42% of the people approached agreed to participate in the panel, and of those, about 62% ever completed one survey. And then on any given survey, there may be non-response. So there's some issues about potential non-response. As I said, I don't think that's so important in respect to this finding, but it may be important with respect to other results based on that survey. So what do we make of the fact that we're seeing layoffs along with hiring? And the point that I would make about that finding is that even in a recession, there's going to be quite a lot of replacement hiring. What we're really interested in, if we're thinking about reallocation, is non-replacement hiring. Unfortunately, we don't really have measures of that. So what I've done is gone into the JOLTS data and tried to approximate non-replacement hiring. So what I'm calling non-replacement hiring is hires minus quits. If you think that somebody quit, the employer would want to replace them, minus other separations. And you can see what that looked like prior to this latest crisis. In the Great Recession, we had an increase in layoffs. What I'm calling non-replacement hiring has been quite stable. Well, what happened in this crisis, the current crisis? You can see we had an enormous increase in layoffs, but non-replacement hiring looks a lot like it looked back through history. So I guess I look at these data and I'm not really seeing any obvious evidence here of a lot of reallocation going on in the sense of surges in hiring to offset the big increase in layoffs. But that's maybe not the important thing to think about. The more important thing to think about is, going forward, are we going to be seeing a lot of permanent restructuring? And the paper offers, it talks about a lot of changes that have gone on that we might expect to be permanent. The results on potential increases in working from home are particularly interesting, though that's not implying restructuring directly, it's restructuring indirectly related to shifts in spending that people do near where they work. The baseline estimate in the paper is that about 42% of recently laid off workers won't be coming back. And then Steve talked about the jump based on the SBU responses in forward-looking excess job reallocation. I do have some questions about this evidence. As I've already indicated, I'm a little bit leery of drawing strong conclusions from the SBU data. I believe the result about the share of layoffs that people think are going to be temporary versus permanent. What I'm not sure about with respect to that calculation is whether we can take evidence from the past regarding shares of people who end up getting recalled and apply it to this situation. The thing that I'm a little more leery about with the SBU data is this forward-looking excess reallocation and how it compares to excess reallocation we've seen in the past. And there, I think the survey composition may be an issue. The survey underrepresents small firms. The baseline level of reallocation at small firms is much higher than at larger firms. And what I think that means is if the shock has had a similar effect on adding to reallocation at large and small firms, the proportional of impact is going to look a lot bigger at a sample made up of large firms. I guess the second question I have about this evidence on permanent restructuring is that there is actually just an enormous amount of uncertainty about where we're headed. I hope Nick Bloom doesn't mind. I've taken some data he pointed to in a different presentation in a different venue. If you look at the VIX volatility index, it shows a lot of near-term volatility. We're at very high levels. If you look at something that Steve and Nick have produced, this news-based economic policy uncertainty index, it's at extremely high levels by historical standards. And so the point is that if we're really uncertain about where the economy is headed, it's very hard to say, how many of those jobs are coming back? How much permanent reallocation there really is going to be. It's just a very uncertain situation, I think. A final point that I would make about this is that the extent of the eventual reallocation is going to depend in part on what sort of policies are implemented. So the responses that firms are giving about how many of the jobs they think are going to be coming back are going to be based presumably both on what they see going on within the firm and also what they think the economy is going to look like, which is going to depend in turn on what they think policy is going to look like. As the paper notes, a lot of reallocation in normal times occurs within industry and regions. So it's one firm doing a particular thing, going out of business, and a new one coming into existence to take its place. If we look at not the paper that was presented this morning, but a different paper by Bartik et al., they present results suggesting that liquidity is an important factor in individuals' in businesses' projected survival. And what that suggests to me is that the extent of the eventual reallocation that we see is going to depend a lot on what policy looks like. Which brings me to the paper's messages for policy. I may be stating this a little bit more baldly than the authors actually do in the paper. They talk about some of the provisions of the CARES Act. They are concerned about the $600 a week in federal unemployment benefits that for many people means that their replacement rate is over 100%. They talk about linking firm aid to employee retention. There's also a discussion in the paper about what Steve, I think, termed legacy features of the US policy landscape that may inhibit reallocation, land use policies, occupational licensing, business regulation. I'm not really going to have anything to say about those other than that they're not, that's sort of a general issue, not one that's tied to this specific situation that we're facing. So let's think about the unemployment benefits and the subsidizing employee retention. I would agree that continuing the $600 a week to everyone who's unemployed is not good policy. I'm less concerned than the authors are, I think, about the job search effects of unemployment insurance in a weak labor market. My reading of the evidence is that in a weak labor market, it doesn't really affect job search and job finding success that much. I would note that the very high replacement rates that are cited in the paper don't account for the possible loss of health insurance. But all of that said, as the economy starts to recover, I would not want to have large numbers of unemployment insurance recipients receiving larger incomes when they're not working than when they're working. A policy that focused on raising replacement rates rather than giving everyone a flat, large benefit would seem preferable to me. I do think, though, that an argument can be made for subsidizing employee retention. And I'm not going to have time to go through this slide, which is adapted from a recent policy brief by Blanchard, Philippon, and Pisani-Ferry. But I think I can make the basic points. When would you want to subsidize employee retention? You would want to subsidize employee retention when, if you compare the value of what the workers are producing to the shadow value of their time, what they're producing exceeds the shadow value of their time, which might well not correspond with when it made sense for the firm, looking at its own private calculation, to keep them on. I guess one reason why I have a different view of this than the authors is that, from my perspective, the shadow value of time for laid off workers is really quite low during the current and foreseeable future. If you think about what people who become unemployed do at home, you might think that if they're at home, they're doing all kinds of productive things. Historically, at least, what unemployed workers primarily do with their extra time is they sleep more and they watch more television. The creation of new jobs is likely to lag the destruction of old jobs, so their immediate job prospects are likely to be poor. A second consideration is that if firms shut down because they aren't currently viable, even if they would be viable in the long run, and then other firms eventually take their place, there's costs to shutting down the old firm and starting the new firm. And then I would also add to that unemployment has adverse consequences on people's well-being that go well beyond their loss of income. Being displaced from a job can have very serious long-term consequences for affected workers. So taking all of that into account, I guess I'm more favorably disposed towards, for some period of time, continuing to subsidize the maintenance of employment relationships than I think the authors are. So the authors clearly are right that the COVID-19 crisis is going to lead to some amount of economic restructuring. It's unclear what the extent and nature of that is going to be. If I think about policy, I would say, and I don't think anyone probably would disagree with this as stated here, you want to protect adversely affected individuals, preserve otherwise viable employment relationships temporarily affected by the crisis, and create an environment in which needed reallocation occurs in the medium term. I guess as I read the paper, it was really pedal to the metal on moving towards encouraging reallocation, and I'm not quite prepared to go there. But let me stop. Thanks.
Thanks very much, Catherine. So we're going to open up for discussion now and have about 5 or 10 minutes of comments from the floor and response from the authors. So I think Olivier Blanchard has a question. We'll start with Olivier.
It's extending on what Catherine just said. It seems to me it's essential to distinguish between temporary shocks which will almost surely come to an end within a year or two when vaccines or something like this are introduced, and the ones which are permanent. And if you think about the ones which will go away when the vaccine is there, then the question is, why do you want to basically let workers and firms, firms disappear and workers move, if basically what you need at the end is the sector to go back to normal? So it seems to me it's very important to distinguish between the two. The argument for reallocation is very weak in the first case. It's stronger in the second, although I agree with Catherine that putting a lot of people in the unemployment pool at this stage doesn't seem like a great idea.
Okay. The question from Shabnam. Go ahead.
Yes, I would like to ask on this liquidity point that Catherine brought up.
So purely Vigonja and I, we estimated the bankruptcy rates related to the liquidity shortfall, not in the US, in European countries, in 20 countries. And this is very significant. This is based on their positions at the end of 2019. These are viable firms, and they are going to bankrupt because of the liquidity shortfall. Of course, if the shock becomes more and more persistent, it will be hard to separate liquidity from solvency. And then I do understand that point that will, balance it towards reallocation. But I want to get your views on this in terms of the US, given the tremendous policy action to support especially small firms' liquidity needs. Thank you.
Okay, next question from Daron Asimoglu.
Hey guys, so I think this point was implicit in Catherine's discussion, but I want to put it slightly differently. Suppose we see a lot of reallocation at the moment. That still doesn't mean that it's efficient. That things that look like reallocation may be exactly because we are going through an inefficient period and jobs have to be destroyed because of demand shortage or other things. And the efficient thing would be for that reallocation not to happen. So I think to argue that we should encourage reallocation, you need to first document that this is a reallocation shock in the data as it appears, and that's not due to inefficient business closings and separations.
Okay, and John Van Reenen next.
Hi, can you hear me okay?
Yes, go ahead.
Great. So it's a kind of the same theme in a sense. So the way I would position the thinking now as we hopefully emerge from lockdown is to try to get this balance correct as best we can from a policy making view between protection and reallocation. And I'm as economists, we're all totally on board with the reallocation. We all love reallocation. But I think one thing we have learned over the research over the last decade, including Steve's own research suggesting this fall of reallocation in the US, is that reallocation is not immediate. It takes a long time to happen. Sometimes people get reallocated to inactivity, and that has a big long-term cost, as Catherine said. So I think getting the balance right between reallocation in the medium and long run and some degree of protection of workers in the shorter run is really important. My sense is that you've put probably too much of the emphasis on reallocation as we emerge from the lockdown period. And I would kind of want to kind of balance that with some more degree of protection. I think you want.
Okay. The most popular question in the Q&A was whether Catherine was going to play the drums or not. So we'll skip that one and let the authors respond to some of the points that were made by the discussant and from the audience.
Yeah, sure. I'll start, and maybe my co-authors will join in afterwards. Thanks, Catherine, for the comments. Thanks from the audience. I think there's less distance between our view and the views that were expressed by Catherine and some of the audience questions than appears on the surface. So what the paper takes a stand against is subsidizing employee retention, irrespective of the employer's long-term commercial outlook. Okay, now that's a mouthful. We don't say it over and over again, but I put the airline example up there because I think it's clearly not in that category. Okay. On the question of liquidity support, the paper explicitly comes down in favor of liquidity support for businesses. Okay, so there's no disagreement there. On Daron's point about reallocation not necessarily being efficient, yeah, I take that point. That part of the reason that I quickly went through the slide on economic persistence mechanisms is precisely to speak to that issue. We have, for better or worse, undertaken a massive social and economic experiment where people have, millions of households have tried online delivery and shopping for the first time for pretty much everything. In my household, we haven't been to a retail outlet, including the grocery store, for more than 3 months. Everything gets delivered to us. So there's a lot of learning by doing, both on the customer side, but also on the business side in the delivery. So there's learning there, there's investments in complementary inputs. those investments by themselves alter what is efficient going forward. Same thing on working from home, where I think there may be even larger changes because of the learning by doing, because of the experimentation. And there's evidence coming online now that most businesses are positively surprised by how well work from home works now that they've actually tried it at scale. So these are things we didn't know back in February, and they have implications for what the efficient resource allocation is as well. On the business travel side, again, businesses have been forced to shift to virtual meetings with customers and clients out of necessity. Some of them have learned that it works very well. That will change what is efficient for them to do otherwise. I didn't have time to talk about it in my remarks, but if you look in the paper, we briefly summarize 5 or 6 recent studies that drill into the heterogeneity in stock returns among individual firms in the wake of the pandemic. There are several things that come out of there, but by my reading, the most striking one is how favorably the pandemic shock has affected many firms that are well positioned to take advantage of the shift to working from home, or either as suppliers of those kind of complementary services, or just in conducting their business. You know, one anecdote along those lines, Zoom video, we're using it now, has seen a $50 billion increase in market cap. Okay, obviously that is suggestive that there's an expectation that we're going to be doing a lot more virtual meetings going forward. So I do think that, back to Daron's point, we do have some pretty suggestive evidence that much of the reallocation that we talked about is in fact efficient and not only probably will happen, but probably should happen. Let me just, last thing on the sample. So it's true we have a small sample, and it's a challenge. We don't have the BLS or the census sampling frame to draw from. We are using essentially done in Bradstreet. It's not quite as, I think, concerning as Catherine suggested, because what we do is at the recruitment stage, we can and we do adjust our recruitment contact rates to achieve a balance, a sample that meets our desire with respect to firm size, firm industry, and state. And then we're also doing ex post sample weights to match the industry distribution of activity. Now that's far from perfect, to be sure, but 2 things on that. One is Nick and I have already fielded with a team of others at Census Bureau a survey that has the same format as the SBU, but is within the Census Bureau. And we have more stuff like that online, coming online. And there are discussions underway to try to roll out large scale repeated samples, drawing on the census sampling frame and everything the census can bring to bear to do this. So you might think of this SBU as in some sense a pilot for trying to scale up. We'd be happy if the BLS wanted to get involved in this as well, not just the Census Bureau. And the SBU design has already been imitated in other countries around the world, most notably in the UK, where Nick is involved in that project as well. One last point about this. Also on the agenda is to take the SBU microdata, move it inside the Census Bureau, where then we can take the standard approach that many researchers have used, which is to ex post, after the fact, construct sampling weights using the Census Bureau universe frame and get better versions of the sample statistics that come out of the SBU. So there's lots of work to do there, and we hope we can excite people to participate in that kind of activity. Thanks.
Great. Thanks, Steve. Thanks to the authors and to Catherine, the discussant. We'll take a minute or less. We're just going to flip over to the next set of authors and discussants. So we'll have the slide flip over and to start the next paper.
Jim, you can go ahead and share your slides and start your presentation.
Okay, are we good? Can you see the slides?
We can, and we can hear you.
Okay, great. So thanks very much. Okay, so I'm talking today about work with David Bakei at UCLA, Emmanuel Farhi, a colleague of mine in the Harvard Economics Department, and Mike Minna, who is an epidemiologist at the Chan School of Public Health. So let me just get started by looking at what the current situation is in terms of death rates and cases in the United States. So on the left is New York, New Jersey, Connecticut, and Massachusetts, where death rates and cases have been declining quite steadily, and we're now in different phases or medium or early phases of opening up. The rest of the US, as everybody's aware, what we're seeing is declining deaths, although most recently it's kind of a plateau in deaths, but most notably we're seeing an increase in confirmed cases, so positive testing results, which raises the question of a second wave. And if we do have a second wave, what are the policies for that? So I think I'm going to be able to summarize the paper in just a couple of slides. And I will say that I guess the brief synopsis is that we have a fairly optimistic view, which is that the second wave does not have to be, it certainly could be a W-shaped recession leading to long-term unemployment and a large number of deaths, but it doesn't have to be. So we're going to do some simulations in some version of an SIR model with some economics accounting linked in, and I'll explain that in a minute. The chart that you see on the left is one that we're going to be going through. It's this format that we'll have. And in this particular case, we happen to have an unemployment rate which is pretty high. We have a second wave, so the second wave of deaths is just around the corner. It's a plateau over the course of the summer, and then it starts to increase in the fall as there's more opening up. This reflects a variety of things, but basically people getting tired of being in lockdown mode and an overall opening up. I'll discuss the way that the unemployment rate stays high. We have a control rule set up in there, and that can either represent a government that is taking conservative actions in terms of trying to fight this with economic lockdowns, or alternatively, you can interpret it as individuals who are concerned about going out when deaths are actually increasing. So the question is, can something be done about this that would have a better outcome both in terms of deaths and the unemployment rate that is quantitatively plausible? And our basic message is that there's no silver bullet, but certainly it seems to be possible based on the parameterizations and the calibrations and the sensitivity analysis that we've done. So on the right, what we have is we have a governor or a population that recognizes that something is going wrong, that a second wave looks like it's about to emerge, and it has a temporary concern about going back to work and going shopping, but most importantly, takes a number of additional precautionary measures that are not related to economic shutdowns. So in particular, there's a testing and quarantine program. It's not at all a perfect testing and quarantine program. It's actually a pretty imperfect one that's rolled out. There's enhanced protections for the elderly, some of which are already, many of which are already outlined in Center for Medicare and Medicaid Study Services guidelines, but perhaps not fully implemented. It would be increased wearing of masks and personal distancing, so required mask wearing, such as been ordered or is contemplated in a number of different states, but leaving businesses largely open. And so there's a little caveat on that largely, and I'll get to that. So, and importantly, schools are staying open in this scenario. So I think for this optimistic view to be one that you think has any credibility, I need to convince you that the model has some credibility. So the main task that I'm going to spend the next, 5 minutes on is trying to convince you that the modeling effort that led here is using the best available evidence that we can, trying to calibrate things as well as possible based on the economics and the epidemiological literature at hand. Okay, so let me describe the model. We're looking at a 66 sector economic model and married to a 5 age group SIR model that's extended to have an incubation period, that's the exposed component, a quarantine period, and then also deaths. So Caroline Buckey suggested using what she called SIR regression, and that's how we're going to approach this. Michael Krimmer talked about heterogeneity of contacts, and that's one way to say heterogeneity of R0. That's a main reason that we have 5 different ages. Kids are different than adults. Kids have tons of contacts at school. They also seem to be, the evidence so far is that they do not transmit the virus as much as adults do. And then there's the elderly who are particularly exposed and threatened by the virus and have the highest death rates. So the 5-age SER QRD model is able to distinguish among those. And then we build in a variety of time-varying specifications of non-pharmaceutical interventions, some of which are economic and some of which are non-economic. And I'll go through those in due course. Finally, we close the model using a control rule. Control rule, we talk about it in the paper as a governor. I think that one of the lessons, which we all know from the previous papers, is that these control rules are government mandates are only part of the story. If you close schools, kids don't go to school. On the other hand, the lockdowns had minor causal components because people had already started self-isolating out of fear. Another way to say that is you can allow restaurants to open, but that doesn't necessarily mean people will go out to eat. So we have a decision maker that could be thought of as a governor or an individual explicitly following CDC guidelines in terms of how to modulate their behavior. There's a vast related literature. And it is exciting that so many people are working on this, and that is a great opportunity for the profession to triangulate on what we hope can be some helpful policies to try to avoid long-term unemployment and a long-term malaise. A core feature of our model is that different people of different ages have different contacts. So this is summarized in what's referred to as contact matrices. We have some contact matrices up on the top here. The normal status quo contact matrix, which is estimated as described in the paper, is here on March 2nd. So we have daily contact matrices. You can see that the kids were going to school and they have a lot of contacts with the other kids. They also have contacts with their parents. And the parents are going to work and they're going to other activities and the ball game and so forth. And so in this group, there's a lot of contacts. Contacts become less as you get older, simply because people don't move around as much. So the 75 plus, I don't know how well this is coming out on the screen, but there's reasonable numbers of contacts where 45 to 64-year-olds then go visit their parents, or maybe they're healthcare workers and they're providing services to the elderly. This is what the contact matrix we estimate looked like on April 15th. So basically schools were closed. There were not nearly as many people going to work, and there were a lot fewer contacts with the elderly, although notably there are still pretty many contacts among the workers. And then here, once you see this, you realize we can manipulate some of these cells once we have calibrations, to think about different counterfactuals. So here's a counterfactual where it's an age-based go back to work policy. So the 65-year-olds don't go back to work. And we have additional protections in place for the elderly. So there's fewer contacts with the elderly. So maybe you don't go visit your elderly parents if they're in a continuing care retirement community or a life care community. And we still don't have the kids going back to school. Some of these contact reductions we're able to, I wouldn't quite say measure, but we're able to calibrate using these mobility indexes that we've seen that Caroline Buckey and the other papers in that session we're talking about. So we use those to calibrate the contact matrices. Other aspects we simply don't have any data on. So we don't have data on masks, on mask wearing. I mean, it would have been, I suppose, interesting to see if we could have gotten CCTV data on mask wearing, but that instead what we're going to do is we're going to estimate a flexible functional form that's going to indicate what additional protections you might take beyond contact reductions that would reduce the transmission of the virus. And that's this thing called a phi factor, a flexible functional form that's described in the paper. Okay. Oh, and I should just say one important piece of this is our contact matrices are the sum of three things. You can meet people at work, or you can meet people at home, or you can meet people in your other activities. And that gives us flexibility. And if you're at work, you can, there's 66 different sectors. And so different sectors have different degrees of contacts and proximities. You know, contact and proximity in fishing and forestry is very different than wholesale trade, which is very different than home healthcare. We calibrate some of the parameters, or we get some of the parameters from the epidemiological literature on age-dependent infection fatality rates and other things like that. We fit it to 7-day moving average of US deaths. This is an estimated plot of the effective R, or effective R0, if you want to call it that. This is from our model using that phi parameter and then the calibrated mobility indexes. And then this is a non-parametric estimate that's whatever, local non-parametric estimate. Okay, and then we have, I described the control rule. We have two different scenarios, fast and slow, and then we have a variety of different NPIs. And so I'm going to talk about those in order. I will mention that in the paper, we just to go through in some detail about a GDP to risk index and consider sectoral openings that prioritize certain businesses. When we took that to the model, it didn't seem to make, it was a second order deal, so I'm not going to spend much time on it here. Okay, let me just walk you through some of the scenarios. So here's the case you want to avoid. It's a W-shaped recession. We have a reopening, which then gets out of control. We have a second wave. Even if you're the fast governor, or even if you don't particularly mind, you get a little bit skittish and you have some shutdowns. So we have the first wave of unemployment, and then we have a second wave of unemployment. We have to rather optimistically end the year at about 7% unemployment rate, which is higher than a lot of forecasts, but we do so having had 444,000 deaths. So what happens if you just slam on the brakes and you cut down on contacts at work? So you reduce contacts at work, you sort of deal with this by economic lockdowns. And what you do, what you see happens is that the unemployment rate stays up at 15%. You actually do reduce deaths. So if you compare the two of these things, the deaths are lower. So instead of 440,000 deaths by the end of the year, we only have 370,000 deaths by the end of the year. But the main point is that this is not a first order solution, that this mitigates somewhat. If all you do is lock down the economy, that mitigates contacts. But the thing is, there's still lots of contacts that are happening in other circumstances. You haven't put your masks back on. This by itself is only a piece. Well, so I'm going to walk through a number of different scenarios. One of this, what if you required working from home? Now, if you require working from home, and this is all going to be with the same control rule, so we're going to be sort of pro-opening the economy. If you work from home, you have fewer contacts, so you're going to be less spread of the virus. What that allows the governor to do, or the shoppers to do, is do a little bit more shopping. Well, as they do a little more shopping, there's a second round phenomenon here, which is a little bit more shopping means you're going to actually have more deaths. So the deaths, there's sort of a rebound effect of deaths. But even after you net that out, we've got a lower unemployment rate. And the deaths have been reduced by about 40,000. Not a silver bullet, potentially a useful thing to do. Here, what if you do this marginal GDP to risk index? You can't see any difference between the two plots. So that was a second order deal or third order deal. What if you don't allow any workers that are younger than 65 to go back to work? Well, that actually reduces deaths too by about 25,000. But that's a second order thing. What if you do all three of those, which is you have a sectoral prioritization, work from home if you are able to, and you're not allowing any more 65 plus on site. And that actually also makes a difference, but you haven't stopped the second wave. So you basically took out a big arsenal here of economic interruptions, and it hasn't stopped the second wave. So we're going to look at non-economic NPIs. First one is, what if you say nobody goes back to school? That actually makes a difference, doesn't make much of a difference, and that's because based on the current epidemiological literature, the kids don't have as much transmission, both from adult to kid and kid to adult. So you sort of don't see that as a big effect. What if you have enhanced protections for age 75 plus? So some of those are potentially in progress already, although I think my understanding is that there's underfunding and staffing problems and capacity problems at some of the nursing homes to actually implement the CMS guidelines, but some of these are in process, and that makes a difference. But if you have a 10% quarantine rate, well, 10% quarantine rate sounds low. I would argue that that's actually pretty high. If 40% of the population is symptomatic and half of them actually bother to get a test, so that 20% are tested and detected, and then half of them actually bother to quarantine, then you're at a 10% quarantine rate, or a 10% isolation rate. So that makes a difference. It's not a silver bullet. What if we go back to wearing masks, not all the way back to where we were in April, but if we go a little ways back towards April? That actually makes a big difference, masks and social distancing. What if we do all of those things together? 10% quarantine, mask and social distancing, and protections of the elderly. That's where we want to be. So that's the bottom line. I'm out of time, and I suppose I should probably try to obey our rules. There's a lot of things that we could do here. We have not done any cost-benefit analysis. We have a little bit on that in the paper. Let me just make one comment, which is that I think that there is a thread through the literature on cost-benefit analysis using evaluate statistical life, trying to say, well, what is the economic cost versus the death cost? What we're trying to say is that that's the wrong either or, that we can have, through disciplined use of non-economic NPIs, we can both reduce deaths and make room for the economy to reopen. And it seems like now is a good time to start. Okay, so thank you.
All right, thanks, Jim. The discussant is Daron Asamoglu. Daron, you have your slides to share?
Yep.
Great.
Perfect. Thanks, Jan. Thanks, Jim. So it was a pleasure to read and discuss this paper. You know, I don't think the topic needs much introduction, and Jim already did it. You know, this is a huge public health emergency and the cause of the greatest US recession since the Great Depression. So some sort of return to normalcy is absolutely necessary, but how? And a major concern, exactly like Jim articulated, is whether this is going to cause a second wave, and that will depend on policies, but smart policies perhaps might help, and this is where the current paper comes in. So it develops an extended SIR-ACIR model with 5 age groups, 66 sector, careful calibration of most of the parameters, and considers various reopening scenarios, as well as simple feedback of local policies on a feedback controller type approach of the governors that respond to unemployment and death. The bottom line is that smart reopening is feasible and can save both the economy and lives, but of course the details do matter, and that's what I'm going to talk about. So in my opinion, this is an important contribution to the policy discussion, and it is a rich and ambitious paper, and I believe the paper is going in the right direction. But the question is, you know, what is the absolute aim? Is whether the paper is an academic contribution or a policy piece. And I think it's it could make progress in both of those. It's not as well calibrated as it should be, either as an academic contribution or as a shovel ready for policymakers. And I'm going to try to argue that. So first, on the academic contribution, of course, some may say this is not a priority, this is our hour of need, but this will not be the last pandemic. This epidemiology economics intersection will be important, will remain important, but even more importantly, I think unless we distill the qualitative insights appropriately, these contributions will not have impact on the policy debate. So the question is, what are the robust qualitative new lessons? And I want to sort of put this in the context a little bit of the past work, in particular, since my thinking is colored by my work with Dr. Chernosukov, Ivan Werning, and Mike Winston, I'm gonna sort of put it in that context, and then I will come back to issues of policy from there. So essentially, the paper that Victor, Mike, Ivan, and I wrote can be viewed as a special case of the current paper with one little exception, but that little perhaps matters. We don't have sectors. We have only 3 age groups: young, middle age, and old. Just like them, we allow for a contract matrix, but we start with a uniform, which I'm going to show in 1 second how the contract matrix matters. But one notable difference, we consider optimal policy and focus on Pareto frontiers. I think that's actually quite important because multiple waves of infections is actually a feature of some of the early papers from the epidemiology literature, like Ferguson et al. And the question remains as to whether they are inevitable or whether they are because of policy mistakes. So bunching in suboptimal policy, I think, harms our ability to draw the right qualitative conclusions, in my opinion. So here is a summary of our paper, and I want to do that as a way of transitioning to the current paper's discussion. So you can express everything in terms of changes in the Pareto frontier. Every point here is an optimal policy, but for different trade-off between excess deaths and excess economic damages. Excess deaths are on the horizontal axis, PDV of economic losses on the vertical axis. The origin is where you want to be, no excess deaths, no economic damages. And if you just use uniform policies, which is sort of what some of the early epidemiology and some of the early economic contributions did, the Pareto frontier would be these red dashed lines. And various different types of targeted policies, I'll talk about some of them in the context of the current paper, can essentially be viewed as shifting you in to a lower and therefore preferable Pareto frontier. And in particular, here is focusing on the point that we show here as a dot. That point, a dot, would be one that says you should never let fatalities rise to more than 0.2% of adult population in the United States using early R0 and early numbers, which don't take into account some of the things that we want to take into account, just like Jim and company do very successfully, such as face mask wearing, better testing, better isolation. But without those, the way you could do that is with high economic costs. So you would need to do a lot of lockdowns. Why? Well, because the relevant parameter in the SIR model, as Jim explained, is really a product of two things. One is, what's the probability of infection conditional on contact, and what are the contacts? So if we cannot change infection conditional on contact, the only way we can reduce the spread of the disease, the R0 or the effective reproduction rate later, is by reducing contacts, which involves the economic lockdowns. Now, that has significant economic costs. So it might cost like a 15-20% recession in 1 year, and over a year and a half is even more economic costs. So what if you do smarter policies, just like the authors of this paper advocate? So one that we can easily see again from the optimal policy perspective is to allow different lockdowns on different groups that by their vulnerabilities. As Jim already hinted at, if you look at the over 65, or it's even worse for the over 75 group, their case fatality conditional on infection is 60 times or more greater than the younger groups. So optimal policy takes that into account and says, well, you have a stricter lockdown on the older groups, therefore you can actually let the younger groups go back to work. Actually, the gains from that are quite significant in our analysis, and that's a qualitatively robust feature, as like the shift of the Pareto frontier shows. And that actually reflects some differences in the modeling, which I don't want to get into here because time is short. I want to talk about a few other things, but I think that's important, and we can follow up on that in the discussion. It really depends on how you model working from home and the lockdown on the older groups. But network structure matters a lot. And the network structure matters a lot, both in terms of giving you new options, but also in terms of what different types of policies achieve. In particular, the polymod data that that Jim and co-authors use has significantly lower contacts for the older groups. And I'll come back to that. When that's the case, you can actually do a lot more even without targeted lockdowns. And in fact, here I'm showing you the data from the BBC pandemic, which is much less extreme in terms of the lower contacts of the older group. Even in that case, you see the optimal contact starts releasing the older group out of their lockdown. Why is that? Well, because when they interact among themselves, once you kill the infection among the older group sufficiently, you can let them in. You can let them sort of interact, go back to consuming and go back to some of their work. Of course, it doesn't last because once the infection builds up within that group, you need to lock them up again. So actually, the quadratic nature of matching in these models implies that non-monotonicities could happen. That's another reason for actually thinking about optimal policy. So now from this slide, what are the academic lessons from the current paper? I think the most important one is that smart reopening is better. And a lot of that is really comes to non-economic, non-pharmacological interventions. And I think Jim was very clear on this. I think this was clearer in the second version of their paper, and the discussion is even clearer on the presentation was even clearer on that. But one problem is that, of course, these are non-economic. So exactly in what way they interact with the economics is important. So why do we need an economics model? So what are the general qualitative lessons we can learn from simpler models? For example, one that doesn't have any economic component and just as a pure epidemiological model, and you say, let's look at the effects of face masks. So I think those are sort of interesting discussions. What we learn from the economics epidemiological interaction. Another question that's relevant for me, given how I've come to this, is that now that we have a 5x66 model, do we really need that? Can we have a lower dimension of representation without sectors, for example, that gives the same results? You know, the results in the current version hint perhaps that's actually true because the GDP to risk ratio, which Jim did not discuss, doesn't bring much gain. So I think that's something that may need to be investigated a little bit more. But I'm actually very keen on the sectoral structure. I really liked the paper first when I saw it because of this sectoral structure. So let me actually talk a little bit about the GDP to risk ratio, even though Jim didn't. I think that's an important innovation of the paper, but I think they need to dig deeper. What is the GDP to risk ratio? I didn't put the mathematical formula here because I thought Jim would present it, but it's the ratio of the derivative of GDP to a policy divided by the derivative of R0, the initial reproduction rate of the disease from reopening. This is actually conceptually very useful, but actually it's important to emphasize that it's not a sufficient statistic. What is R0? And you have a network-like model. R0 is the largest eigenvalue of the Jacobian of the dynamical system over the graph. So this is a very important concept, but it actually doesn't have a lot of the relevant information. In particular, it doesn't have information about the mixing properties of the induced Markov chain. What does that mean? So let me try to illustrate what it means in words. So take two societies. Imagine they have an island structure, which means that people, just like in the polymorph data, I think it's a little bit too much in the polymorph data, but the old interact with old, kids interact with kids. That's like an island structure. And the islands themselves are weakly connected to the rest of society. Then R0 approximately is the same if two islands have exactly the same internal structure. But when you think about it a little bit, you'll see that that's actually not what you want to capture, because the mixing properties are determined by how those islands are connected to the rest of the graph. So what are they? What does that depend on? Well, it actually depends on the rest of the eigenvalues. In fact, it's determined. It's dominated by the second largest eigenvalue. So you can easily build better measures than the GDP to risk ratio, and it may actually give you a little bit more mileage. So I think those are some interesting issues. So
you have about a minute left.
Okay, I have about a minute left, and in that minute, let me actually say what I would really benefit from the current paper is that if there is a better discussion or a more detailed discussion of why these choices. Like, for example, I think the current paper notes but doesn't model nursing homes. 40 to 50% of deaths so far in nursing homes. So why not model that? Actually, you can do that if you have a Markov chain over the graph that has both slow mixing and fast mixing. I think that would be an interesting thing. Face masks, I think they are super important. I would like to understand more. For example, recent evidence shows that ICU nurses at Mass General have 2% infection rates. and they're dealing with COVID patients, and it's just face masks. So I think, is it just about face masks? How much can we get just with face masks, which is something we can deal with simple policies? I think more can be done on the education metrics, and also, as I pointed out, why not look at optimal policies? Finally, what can a non-economist policymaker learn from this paper? I think here the paper can vastly improve its appeal by getting rid of the governors and the feedback rules. I think if you take these results to a non-economist policymaker, you cannot say that these are the optimal policies. They are the optimal policies constrained by the behavior of governors. But we're trying to change the behavior of the governors. I mean, I'm all in favor of incorporating political economy into our analysis, but I don't think this is a good way of incorporating political economy. And I think for the policymakers, you need to have really simple messages. What are going to be the simple messages? GDP to the risk ratio, face masks. I think if the message is actually it's non-economic, non-pharmacological interventions coming from economists, I'm not sure how effective it will be, rather than we just go for one sort of thing. Is it face masks together with its economic interactions and how we can change the economy? And then I would actually also, I think Jim and co-authors are ideally suited to thinking a little bit more about how confident should we be in some of these numbers when there is parameter instability and uncertainty, because that's a classic Bayesian or robust control type of issue. Finally, I think there are a lot of things here for us to think much more about. I think this relates to the issues that Steve Davis talked about. There are going to be social changes that are long-lasting, how we shop, how we work, how we interact. There's a lot of evidence that firms are going much more in the direction of automation. Then there will be sort of political changes. These are, of course, beyond the scope of the current paper, but I think are useful for us to think in terms of the economics, epidemiology, and social science perspective. Again, I thoroughly enjoyed it. Great work, and thanks for giving me the opportunity to discuss it. Thank you.
Great, thanks, Duran. We have about 5 minutes, so I'm going to take just a few questions from the floor, and then I'm going to squeeze Jim's response time a little bit. So let's start with Justin Wolfers, and then we'll go to Alan Auerbach. So Alan, you can get ready. Justin?
Yeah, sort of glibly, but actually seriously, I wanted to push Jim on Duran's last point, which is where are standard errors? Obviously, in lots of contexts, we don't care that much because when stuff is linear, it all averages out. But you miss R by a little bit on one side and we explode in one direction, you get it a little bit on the other. And so that's got to create a tremendous bias toward being conservative. And it would be useful to hear you say more about that.
Okay, thanks. Alan, and then Thomas Philippon.
Thanks very much. I enjoyed the paper, and I also enjoyed the discussion. And I wanted to pick up on a point related to one of Duran's last comments, which is when you're thinking about how to model the behavior of different agents under different rules, economic and non-economic interventions, it would seem that it's important, even though you're trying to come up with policies that are better and to target those policies, be useful to think about the feasibility of these in a broader context. I mean, one of the reasons why we're observing surges in various parts of the country right now is that people have basically decided they can't sit in their house anymore. And so when we have social distancing, or even wearing masks, when people feel that that's somehow an infringement on their personal freedom, that modifies, limits, but it also alters the trade-off among different policies, because some policies that you've looked at may seem less attractive, but they also may be more feasible in terms of what can actually be accomplished beyond simply providing information about what you might want to do.
Okay, Thomas Philippon, and then Austin Goolsbee.
Yeah, hi. Nice paper and discussion. I just want to point out that even if the risks are very different across age groups, it doesn't mean that you want to impose lockdowns on the older people. Because when you think about policy, what matters is not the level, it's the difference between what people would do by themselves and what you would like them to do in equilibrium. And it's very clear if you think about the data that old people have the lowest externality rate because they have low contact rate and high personal risk. So by themselves, they're going to be very careful. The young, even though they are not very risky, they are the opposite. So even in a model where the risk is tilted toward the older generation, that does not imply that the policy should target this group. In fact, it's very likely it would be the opposite, and you would still tell young people not to go to bars together, even though ultimately you want to protect the old.
Okay, I'm going to give Austin the last question here, and then we'll go back to the authors.
My question or encouragement to you, Jim, is to think about this issue of in the data from China, the highest infection rates happened at home, and you got them from family members. And age is certainly a risk factor, but so is obesity, and so are a series of medical conditions. And you could plausibly make the case that 50% of the US population is at a high risk group if you start thinking about that. And then the fact that they live with one another makes it seem like that targeted lockdown, it's kind of hard to see how it works. And I wonder if even just on a simplest measure, if you went to the CPS or others and found sectors of where people work and what sector their spouse works in, if you could have some, the R naught value for people in different sectors might vary on those grounds.
Thanks, Austin. Jim and other speakers, can you guys take literally a minute to wrap things up?
Yes, so let me just say two quick things. So in terms of the lockdown of the elderly, I think the biggest, one of the places where there's been the biggest amount of deaths has been nursing homes. So that really is not a self-isolation issue. That's sort of a nursing home administration and capacity issue. On the optimal control, so Jerome and I, we've gone back and forth on this. I think that there's just, I'll just, since I have no time, I will just say I disagree. And I think that there's virtue to actually modeling people following CDC guidelines in these complex circumstances. I suppose, you know, I think I'm going to leave it at that. Mike, do you have anything you want to add to this?
No, not with the time. I think it was a great conversation here.
Emmanuel?
I just wanted to say one thing very quickly, which is, so in the spirit of trying to make things a little simpler, we've made a few choices that probably actually reduce the economic impact of the lockdowns. And we have a short discussion of this in the paper. So the trade-off is probably worse than the one that we highlight, and we have a way of exploring that. So, you know, you can worsen the cost of lockdowns easily by 20 or 40% by bringing in more realistic pictures like complementarities or Keynesian spillovers and things like that. But that doesn't change the overall message of the paper, which I think at the end of the day is very simple, is there are not that many contacts that can lead to infections in the workplace. And so, you know, the big game is to try to reduce these other contacts. And there's a question as to how effective we can be about this, how much of that is going to be driven by policy versus induced, and that kind of stuff. But that's where the real money is in some sense. And I think that's a very simple message that comes out of what we do. And maybe we can do an even better job with the contacts and bringing new evidence and everything. But that comes out pretty robustly of what we've looked at.
Okay. Thanks a lot, guys. Terrific session. We're going to come back at 4:45, so that's 3 minutes from now, for the Fed program session with Arvind Krishnamurthy and Marcus Brunemeyer.
Thank you, everybody. Bye-bye.
Bye, thanks.
Anna?
Yes.
How do I, it's okay, let me get the video. Oh, there we go. Can you see me?
Yep, you're good to go. And then as soon as you do your presentation, it'll come up on the screen here. And you can
Okay,
just...
and you'll flip the slides when I ask you to move the slides.
Yep.
Great, thank you.
No problem.
Hi, Ben. Good to hear you. I can't see you.
Hey, Marcus. Hi, Arvin. How are you?
Good.
Last but not least, I hope. My gosh, what a long day.
Yes, for the guys who can really hold it out till the end.
Mm-hmm. Marcus, we can only see the top of your head. You might want to reorient your... There you go. Much better.
Thanks. Actually, let me see. Okay, great. Oh, I see Arvind now.
Yeah,
Okay.
I'm here. I think they want to see our slides, not us. So.
So Arvind, do you know why the second eigenvalue, did you hear Ron's discussion?
Marcus, let's do this offline since we're all live here.
Okay. Oh, we are live. Oh, sorry.
I want to welcome everybody back to the last session of the day, where we'll be discussing the Federal Reserve programs in response to the COVID-19 crisis. The paper is by Arvind Krishnamurthy and Marcus Brunemeyer on corporate debt overhang and credit policy. And Arvind is presenting.
Okay, am I good to go? Can everyone
Yep.
hear me and see me? See my slides?
All set.
Okay. Thank you, Jan and Jim, for including this paper on the program and what's been a terrific conference so far. This is joint work with Marcus, and the topic here is credit policy in the current recession. So in the last recession, credit problems really lay in the financial and household sectors. In the current dimension, the new dimension, the current recession, the new dimension is really credit problems in the corporate sector. We come into this recession after really a decade-long increase in corporate leverage. And to a large extent, the government programs, the Fed, Treasury, corporate bond purchase programs, the Main Street lending programs recognize this. They've really been about dealing with credit problems in the corporate sector and Main Street rather really than Wall Street. The second important difference between the present recession and the last recession is that the policy objective last time was really about stimulus. It was about expanding credit supply and stimulating household spending. Whereas this time around, the way we are thinking about policy objective is it's more about insurance. It's about insuring against preventing economic damage and scarring that may occur during this pandemic, so that once the pandemic is passed, a recovery can be quick. So I'm going to start by just taking you through some data to give you a sense of the credit problems in the firm sector. And what my next two slides do is they present some data on corporate bond spreads. You should think of corporate bond spreads as the product of the probability of default of a company on its debt times the risk premium or the market price on default risk. So on the left panel here, I'm tracing through spreads on high yield, that is junk bonds, and investment grade bonds since the beginning of the year. And the spike in spreads right here in March is particularly noticeable. There's considerable evidence that in March, asset markets were dislocated, there were illiquidity problems, reductions in risk-bearing capacity that were really pushing up spreads in this period. And so when you think particularly about the March period, you should think of some of the spread behavior there as not just a rise in the probability of default, but also importantly, a large rise in the risk premium of default risk. That played out quite significantly in this period. Now, the Fed has done a very effective job in restoring market function. That is, the Fed's policy moves in March and April, which really drew from the 2008 playbook of lending facilities and asset purchase programs, have restored market function and brought risk prices, the risk premium and default risk, down to normal levels really by mid to late April. And we say a bit more about that in the paper, and I know Ben is going to talk more about that in his discussion, but I'm not going to focus on that in my limited time here. What I do want to emphasize is that by now, in June, spreads are elevated relative to the start of the year, and you should understand these elevated spreads as largely a reflection of the probability of default. Risk prices now on default risk are relatively normalized, so this is really about probability of default. Okay. Why are spreads high? Well, it's really two things. One is, as I mentioned, firms come into this period with high levels of debt. And second, this recession has had very differential effects across the board in the cross-section of firms across industries. The left panel, which is which is tracking junk and investment grade, give you a sense as to the debt effects, more debt here and less debt here. On the right panel, I'm plotting how spreads have evolved since the beginning of the year across different industries. And you can see that the industries in which our earnings problems are most severe, consumer discretionary energy sectors, are the ones in which spreads have risen the most. The next graph here on the left makes this point in a broader way. So what we're plotting here is spreads, a histogram of spreads across the entire traded corporate bond space. Okay, the blue histogram is the pre-pandemic histogram, and the orange histogram is the change, is the pandemic histogram. Okay, so what you see when comparing blue to orange is pre-pandemic spreads were relatively low and relatively tight. There wasn't much dispersion in spreads, whereas in the pandemic, what's happened is the level of spreads have shifted out, but just as significantly, if not more significantly, there's a lot more dispersion in spreads. There's just a lot more mass here on the right tail. And what that's indicating is there's just a lot more firms that are much closer to financial distress as we've gone through this. On the right panel, I'm plotting here bankruptcy rates. This is a monthly count of large corporate bankruptcies. And as you would expect, as we've gone through this and as more and more firms have fallen into distress, bankruptcy counts have risen. Now, this bankruptcy count is as of earlier this month. I would fully expect, given the spread behavior, that these bankruptcy counts are going to continue to rise, and noticeably they're going to rise probably as high, if not higher, than where they were in the global financial crisis. The data I've just taken you through is data from large firms. It's likely that these issues are present and more severe in the SME sector. And for the rest of the analysis, I'm just going to go through, assuming that that is true. So this paper, as I said, is really about credit policy. It's trying to understand credit policy. And if you want to understand credit policy, what you need to understand is corporate finance. So we need to understand how existing debt affects corporate finance. If you were in a world in which debt is lower, if you're thinking about a company, say an investment grade company for which debt is very low, subsidizing credit really doesn't have much of an effect because, roughly speaking, this firm will comply to Moody-Glaney-Miller, and really only the path of the policy rate will matter for economic outcomes. So if you want to understand how credit policy will affect firms in a beneficial way, you need to take a stand on how debt is interacting with corporate finance. And there's really two salient dimensions here that we need to pay attention to. One is the nature of bankruptcy costs. So debt may lead to bankruptcy and liquidation, which can cause scarring. How severe is this concern? Which sectors is it most apparent? Second, a high debt can be a drag on firm operations. And so we need to, again, think through corporate finance to understand what is the nature of this drag. And that's what we're going to try to do in the next couple of slides. So the policy question, which we're going to evaluate, is I'm going to just think about a hypothetical policy in which we can drop $1 into a firm. And then we're going to ask the question, where should the subsidy go in order to maximize macro benefits? And I'm going to take you through two cases. One is a case of a large corporate run by management in the interest of outside equity holders. This could be a large publicly traded company. It could be a large private equity-backed company. Both would comply according to my assumptions here. The issue for this firm, as I will explain, is one of solvency and debt overhang. And in distress, this firm is going to file for a Chapter 11 reorganization. The second case is of a small owner-run firm. As I'll make clear, the issue for this case will be one of liquidity constraints in the firm sector. And in distress, this firm is going to file for Chapter 7 liquidation. So what I want to do is just take you through an analysis of both of these cases. And I'm going to start by taking you through the SME liquidity constraint case in reverse order, because I think it's fairly easy and will be familiar for most of you to understand. So think of a small firm where the owner has pledged his personal assets as well as any collateral from the business for a bank loan. We hit the recession, earnings falls, and now this firm has debt service problems. The owner has no more personal funds to contribute, so he's put in all of his personal assets already. So liquidity is a problem. That's the scarcity in this case. So what the owner will do is prioritize his earnings, his cash, towards debt service, and in the process cut expenditures on labor and capital. So this means that there's a flow drag from debt. The liquidity constraint is causing the owner to prioritize his liquidity towards debt service rather than maintaining enterprise value. And then over time, what will happen is that the enterprise value will erode in this process. If this goes on for long enough, in the end, the firm will fail, it'll be liquidated. And there's a scarring concern that enters with liquidation, which is that the owner's net worth will probably take a hit. So in many cases, if a Chapter 7 bankruptcy is filed and the owner has pledged his personal assets here, he'll file a personal bankruptcy as well. So the owner will exit the bankruptcy with low capital. And so even if the pandemic is passed, in order to scale up the operation to the level as it was pre-pandemic is going to be very hard because the owner is going to have low capital. So the policy solution is really to provide liquidity to alleviate the liquidity constraint. And there's a close analogy here for this SME sector to the high MPC households of the 2008 recession. And a lot of the loan design ideas follow on ideas in the last recession in household debt. So payment relief is really the key, longer repayment terms, loan subsidies. The second case that I want to talk about is the case of a large corporate. Okay, and this case is more nuanced than the first case. So think of a large corporate with high debt, which is facing a solvency problem. So the high debt will distort an investment decision. And the reason for this is the Myers debt overhang problem. The reason for this is if I have a high level of debt and the firm makes an expenditure, the return on that expenditure partly goes towards the debt holders. So if the firm is being run in the interests of deep-pocketed outside equity holders, what the firm will do is it will underinvest. It won't take expenditures that maintain enterprise value. So it will not maintain a labor force or capex or maintenance because that ends up just improving value that in part goes to debt holders. So the underinvestment problem is also an erosion problem. Over time, the underinvestment erodes firm value. Now, again, if this goes on for long enough, if the solvency problem is severe enough, what can happen is the firm might file for a Chapter 11. And an important distinction between a Chapter 11 filing for a large corporate and a Chapter 7 filing for a small firm is that the Chapter 11 filing really can eliminate the debt overhang problem, right? So in a Chapter 11 filing, there's an automatic stay that comes into effect on payments to debt holders. That's quite useful in a situation of low earnings. Second, control is shifted from equity holders to the creditors, and the creditors can restructure the firms, and they will in a renegotiation in a manner that preserves firm viability. So they'll restructure their debts to get out of the debt overhang problem. Okay. Now, bankruptcy does have costs. It has direct costs such as legal and financial costs, and indirect costs which are spillovers to other stakeholders. I'm going to come back to those costs. let me talk about the corporate decision to file. So as I've just talked you through, the Chapter 11 process is a way in which a large corporate can get over the drag from high debt. So let's just think through how a firm might file for Chapter 11. And for the sake of argument, I'm going to take a case where there are no direct or indirect costs of bankruptcy. Okay. Now, the key point to note here is the decision to file for a Chapter 11 bankruptcy is in the hands of the equity holder. And for a deep-pocketed equity owner, you can understand the filing decision using option intuition. So the equity holder has a call option and the enterprise, and you can think of the way the equity holder is running the business as, in order to retain the call option, the equity holder must make the debt service payment. So you make the debt service payment in order to retain the call option. And what that suggests is, as long as the option is sufficiently valuable, the equity holder is going to retain the option and make the payment. So how will that happen? Well, if volatility is high and if the option is not too far to the money, then the equity holder will continue to service debt and not declare a Chapter 11. Now, the key point to notice from my logic here is that this decision to file is based on option valuation logic and not bankruptcy cost considerations. Whereas from a social perspective, it's all about bankruptcy costs. That means that in this case, with zero bankruptcy costs, generically what will happen is the firm will file too late. It'll let the firm value erode, the debt overhang problem. And basically, it's a classic zombie firm problem. So take that now, and let's think about the problem of a credit subsidy to a large corporate. If the pandemic is expected to last a long period, or if bankruptcy costs are low, then optimal policy doesn't subsidize credit. Really, such a policy is misguided because it simply prolongs the problem and enables zombie firms. On the other hand, if the recession is short or bankruptcy costs are high, then policy can beneficially subsidize credit. So the issue for the large firm is more nuanced than the issue for the small firm. So currently, the Fed's assessment is of a long road to recovery, and I'm inferring this in part because the Fed's decision to keep interest rates low for the next 2 years, which they have made clear in multiple announcements, is a statement that we're expecting low levels of activity for considerable periods. And if that's the case, then what seems like the relevant scenario is the first scenario of a long pandemic. And in that case, the right policy is really not to subsidize credit to large companies. What that means is that the corporate bond program that the Fed has doesn't really need to be turned on. Now, the Fed is currently scaling this up. It's still not very big. Our analysis suggests that the right thing to do is to just keep it on standby and really to just leave it in the event of a market dislocation like the March 2020 period. Okay. Let me just turn to bankruptcy costs. So I have made the argument for large firms that it's not clear whether or not to subsidize credit to firms. On the other hand, policies that reduce bankruptcy costs are unambiguously beneficial. And moreover, they actually interact with the credit subsidy program, because if you are able to reduce bankruptcy costs, that means that you can provide less of a credit subsidy to a large corporate. So in the paper, we outline a plan to offer subsidized debtor in possession financing to firms that file for Chapter 11. And that's useful really for two reasons. One is it reduces the direct financial cost of a bankruptcy and therefore subsidizes debt restructuring. And the second reason is because, as I said, by doing so, you're reducing bankruptcy costs, and so you need provide a smaller subsidy to a distressed firm to keep it alive. The second aspect of bankruptcy costs are spillover costs. And perhaps the most worrisome on this front is spillovers to the financial sector. So distressed bankruptcy losses will eventually hit bank capital. We don't have a 2008 style financial crisis now, but that is a scenario that needs to be considered. It seems to us to make sense for the Fed to proactively basically shore up bank balance sheets, for example, by triggering the countercyclical capital buffer, have banks issue equity now. Risk premium, market prices of risk are quite low now. Markets seem to be operating smoothly. This seems like a good place to also act to insure. So I'm going to conclude here just to reiterate the main conclusions from our analysis. For financially distressed SMEs, the corporate finance problem is really one of liquidity constraints. The situation is very similar to the high MPC underwater households of the last recession, and policy should provide liquidity to these firms. For financially distressed large corporates, the situation is one of solvency and debt overhang. In our read of the data, we don't think a credit subsidy is warranted. The corporate bond program, which the Fed seems to be legging into currently, in our opinion, is best left on standby. And for the Fed to explicitly clarify to the market that it is a standby program to deal with something like a March 2020 dislocation. On the other hand, a targeted policy of reducing bankruptcy costs is unambiguously beneficial, and shoring up bank balance sheets to reduce indirect bankruptcy costs also seems wise at this point. I'm going to stop there. Thank you very much.
Thank you, Arvind. The discussant is Ben Bernanke.
Hi. Okay, we got this picture up. So very interesting and insightful paper. I'm going to discuss it, but in the broader context of the Fed's recent financial market interventions outside of monetary policy. I'm not going to be talking about monetary policy. So building on the legacy of the 2008 crisis, the Fed has gone beyond classic lender of last resort actions to take new types of stabilizing actions. I want to be clear that I think that these actions are justified and appropriate given the state of the economy. And I also want to commend the Fed on its proactive and rapid response. But there's an awful lot to learn about these new types of interventions and how they're going to change the Fed's capacity and the Fed's role, and how other central banks also will be using these types of tools. So let me talk again about Fed financial interventions other than monetary policy. Next slide. So there are three types of interventions that the Fed's engaged in. The second one is the one you're all familiar with, the classic lender of last resort, lend freely at a penalty rate to financial institutions to avoid loss of liquidity. That's Walter Bagehot from the 19th century. That's the classic financial intervention. But there's two others worth mentioning now. The first I call the market maker of last resort. I'll explain what that means. And the third is backstopping credit markets. Next slide. So a market maker of last resort is the buyer of last resort when limits on capital or risk tolerance in the private sector inhibit normal market making or arbitrage by private actors. And a couple of examples from recent period are the repo market spikes in September of 2019, when shortages of capital, balance sheet space, et cetera, led to these failures of arbitrage in the repo market. The Fed has been putting large amounts of cash in the system to try to offset that with a good bit of success. The other example I'll come back to, which Arvind mentioned, is the spike in March 2020 in the Treasury market, again, related to failures of arbitrage or failures of market making, dealers with inadequate capital to absorb the sales of treasuries by leverage-constrained investors. Next slide. The second type of intervention is the classic Bagehot type intervention, lending freely against collateral to financial institutions. The examples are familiar ones. Two of them require 13.3. The biggest one by far is the currency swaps, where the Fed is putting dollars into the global system. That a number of foreign banking organizations, which do lend in the United States, but also elsewhere in dollars, have been short dollars because of loss of deposits, and also because of firms, their borrowers taking down large amounts of their credit lines. So these currency swaps, which have been heavily utilized, have been providing that kind of last resort type of support. Next slide. The third and relatively novel intervention is backstopping credit markets, where the difference between this and traditional lender of last resort is that the central bank stands ready to lend directly to ultimate borrowers, to corporations. And the authors talk about this kind of as like, if it's like a form of QE that lowers cost of borrowing. I don't think of it that way. I think that the backstop that's being offered by central banks, the idea is basically to cut off the left tail or to eliminate bad equilibria, which makes private lenders comfortable about re-entering, or if they're not willing to re-enter, then provide credit directly. So this can actually work without any actual lending. And the case in point is Draghi's do what it takes, when the associated program, the outright monetary transactions, seem to solve the sovereign debt problem without ever actually buying a dollar. So basically, the promise, the commitment to eliminate the bad equilibrium can make credit markets work better. Why is the Fed doing this instead of the Treasury? Well, some of it is just congressional CBO accounting, but there are elements of Fed expertise, connection to banks and markets, and its nonpartisan status that make it a good candidate for managing these emergency credit markets. And here are the examples, the facilities that you're all familiar with at the bottom. Next page. So I just wanted to give you a quick sense of the size, the magnitudes of these different activities. This page has the changes in the Fed's balance sheet over the last year, which are not associated with Treasury backstops. The next page we'll get to in a minute has the Treasury backstop programs. The first three of these programs, Treasury securities, MBS, repurchase agreements, are what I call the market maker of last resort. That's $2.5 trillion. That is where the money, that's real money. That's where the real money is. The remaining four items, most importantly, the liquidity swaps, are the lender of last resort activities. That's about $0.5 trillion. Next page, please. Here are the Treasury-backed programs. I count the money market facility as a lender of last resort activity because it helped prevent a run on money markets. So the entire lending on Treasury-backed special programs is at this point only about $12 billion. So it's actually very small at this point. For corporate credit facilities, that's probably okay. I agree with, in a way, I agree with Arvind and Marcus that this doesn't need to be big as long as it's there. And that will be, it has succeeded in making the corporate bond market work pretty normally. Main Street facility as of a week ago was at zero, and that is a concern both politically and also in terms of getting liquidity to the firms that need it. Next slide. So what's the assessment? Market maker of last resort, as Arvind and Marcus point out, that there was a financial crisis in March, with the Fed successfully calmed down. Next slide. Here's a picture. They look at stock market risk premia. This was really more about a bond. This was more a bond issue than a stock issue. So here's a couple of alternative indicators. One of them is the Gilchrist-Zatracek excess bond premium, which is a default adjusted measure of the premium that investors charge to hold corporate bonds. You can see the big shock in 2008 and a moderate shock in 2020, which is partly reversed. And then there's also the St. Louis Fed Financial Stress Index, which uses a lot of bond indicators as well. So there really was a financial shock. The Fed successfully intervened by standing ready to buy treasuries, MBS, CMBS, and doing repo operations in large scale. And this is an innovation, much bigger scale than we did in 2008. Next slide. The classic lender of last resort activity has not been as big a deal this time as it was in 2008, but it has been successful where used. It did relieve some stress on money market mutual funds and provided dollars globally to try to, again, reduce the stress on foreign banks that rely on dollar credit. Next slide. Now let me turn now to what Arvind was mostly talking about, which is the credit backstops for large and small firms, and starting with large firms. So as I've mentioned, the announcement effects have restored the investment grade corporate market to pretty normal conditions. And so then the question is this enough is this all we have to do? Are large firms now okay? And can we just leave the situation as it is? So I agree with their analysis, but I have a somewhat different view of the empirical elements. For reasons that are listed there, I won't get into. I think bankruptcy costs are actually fairly large. Won't get into it, but there are substantial both direct and indirect costs of a big firm going into bankruptcy. It's true that the recession is expected to last a long time, but The pandemic element itself and the economic implications are very uncertain. It could be that in 6 months we have a vaccine and we're back to flying and going to movies and doing all those things again. It could be that those things will never come back. So given that there's a lot of option value, given that bankruptcies, I think, are expensive, I guess I'm less comfortable than the authors are at forcing early bankruptcies among large firms. I think that it would incur costs before there's the clarity we need to know whether or not firms can stay in the current configuration. Next slide. So, are there alternative strategies, to deal with large firms? And I'll just mention a couple which I think are interesting. One, which has been presented by Jeremy Stein and some co-authors, argues that instead of just lending and being a senior creditor, the government should be a venture capitalist of last resort, as Jeremy puts it, that the government should take a more subordinated position, for example, preferred stock plus warrants. That puts less cash flow pressure on companies in the short term, giving them a chance to determine their viability in exchange for some taxpayer upside. And that may be a better solution to the uncertainty that we face in the current situation. Andrew Metrick of Yale has another interesting idea. He notes that the pandemic risk is a pretty much undiversifiable exogenous risk to the system. He suggests that the government staple subsidized business interruption insurance to loans, which would be invoked if there's a shutdown or if there's biomedical indicators suggest that there's a second wave, then the government would pay the interest and principal on the loan. Otherwise, you would have normal lending relationships. And the benefit of that is it separates ordinary business risk from this undiversifiable pandemic risk. It may be a very efficient way to how to get firms through this period. Next slide. Now, the difficult case, and here I'm very much in line with the authors, the difficult case is for small and medium-sized entities. The bankruptcy costs are very high. Bankruptcy would often involve complete loss of the option value and of the franchise value of the firm. They mention scarring. I don't think in their paper they mention aggregate demand externalities, but that's an additional reason to worry about shutdowns of firms and layoffs of workers. So what we need here is a compromise where we assist short-term survival of small firms, while at the same time not creating zombie firms, allowing longer-term redeployment of resources. How do we do that? Now, it's not clear that the Main Street program, which is basically trying to normalize bank lending, is going to be enough to help those borrowers that are hard hit in the pandemic but have significant option value. So there might be some alternatives there. Let me give you a couple suggestions on the next slide. So how else could we lend to SMEs? An interesting alternative is what the ECB and the Bank of England and other central banks do, is what's called subsidized funding for lending. The ECB pays banks a percentage point to lend to qualified borrowers, and which is a little odd in a way, because you would think that Europe would have the greater shortage of bank capital, a shortage of bank balance sheet, and yet this seems to be, there's a lot of take-up of this. So this is a very different approach than what we have here in the States, in that the ECB is just giving out money very cheaply if you lend to SMEs. It's not trying to do a dual underwriting the way the Main Street program is. A second possibility is just to make the Main Street program more generous. You could give banks an upfront fee to allow them to cover their underwriting costs. You could lower the cost to borrowers. That would be, of course, more expensive, but it might give the liquidity support to small businesses that they really need. This has been proposed by Bill English and Nellie Lang in a recent paper. And then finally, we, as economists, we generally think that lump sum transfers are the most efficient way to address these kinds of ex post risks. So the Paycheck Protection Program, tax credits for grants, would also be an alternative, which would be the fiscal authority could apply to keep SMEs alive. So I just want to agree that the toughest of the three areas and the least familiar to the Fed is the credit backstopping. And the problems are quite different depending on whether you're looking at firms that can borrow in public markets and firms which are bank dependent or otherwise not able to access public markets. So let me turn to the next slide, which is the conclusions. I think people have not as fully recognized how much the Fed, and this does start in my regime in 2008, how far it's gone beyond classic Bagehot. I think this is justified by the circumstances. Again, I'm not being critical, but we will need new doctrines and new thinking about how the central bank operates. And we'll have to ask the question whether or not these extra tools might help, for example, with the zero lower bound on interest rates and monetary policy as well. In terms of its application in this particular episode, the Fed has so far succeeded, both as market maker and financial lender of last resort. It's also provided the backstop that has normalized investment grade corporate bond markets. I still think there's some, and I think I agree with the authors, that there's still some tough questions about what's optimal in terms of preserving the continuation value of both large and small firms. My assessment, without much evidence, is that forcing large firm bankruptcies too quickly could be inefficient until there's at least somewhat more clarity about the course of the virus, whether a vaccine occurs, what the new economy is going to look like. I'm very much in agreement with them that SMEs need more help. Fiscal grants or concessional finance for a time to maintain their option value seems like the right strategy. Again, really interesting paper, and I'm glad to see such good economists working on what are some really tough problems of policy. Thanks.
Thank you, Ben. So we're going to open it up for discussion now. I think somebody has their mic open. And we have a hand up from Nellie Lang, and we'll take a few minutes of questions and go back to the authors. So Nellie, you are up first. Let me unmute you. There you go.
Okay, thank you. Arvin and Marcus, this was really an interesting paper, and the discussion of the costs of SME failures is so helpful and raises an awareness of why it is important to try to help those. The discussion, though, so I had a question about that. It felt like the SME issue is not so much size, but whether the firm is owned by somebody who's pledged all their personal assets, et cetera. In the Main Street program, they try to, I think about that in terms of firms with less debt. And I'm just wondering, like, and the Treasury puts it out there as like firm size by number of employees is the way to measure SMEs. But the economics of your program isn't really about the number of employees. So I was just wondering if you had an idea for better indicators of these firms for which some additional credit would be especially helpful.
Okay. The next question will be from Wendy Edelberg and then Raghu Rajan.
So, hi there. So Marcus and Arvind, when I read your paper, I interpreted, and maybe this was just through my own filter, but I interpreted thinking about the difference between bankruptcy with the large corporations versus the small corporations as who was taking the losses. So that with the large corporations, the equity holders and the debt holders could absorb the losses. I mean, this is all to say, I should back up and say, there are losses that will have to be taken. And there's a question as who's going to take them. So with the large corporations, you had you were putting forward an idea that the equity holders and the debt holders could take the losses. With the small and medium-sized corporations, I was a little surprised that, at least to the way I interpreted your idea, is that there were no losses that would be absorbed by those debt and equity holders. Like the owners of those businesses would not absorb the losses. And I was wondering if I interpreted that right and why you thought they couldn't absorb any of them.
Okay. Raghu?
First, very nice paper. On the issue of large corporations, we sort of seem to think that the costs of bankruptcy will remain what they were. But of course, we're in different circumstances, right? We have a lot of viable enterprises which may be saddled with a lot of debt over the next few months because they're closed. But it makes sense for the current liability holders to restructure quite quickly. So I was wondering why you don't think that out-of-court restructurings or even the bankruptcy process will operate a little more efficiently than in the past and reduce the imputed costs of bankruptcy. In other words, won't the market adjust also? And if it doesn't, shouldn't that be where we put a lot more effort on making it easier to restructure, do out-of-court restructurings, which are blessed quickly?
Okay. The next question is from Shebnam.
Hi, it's a great paper, Arvind and Marcus. I would like to ask about SMEs. So it is true that we don't know that much about SME financing in the US, but we do know a lot in Europe. And the larger form of financing is going to be bank loans. The debt is going to be less in terms of corporate bonds. They have less of that. So that makes it no-brainer that you just close the liquidity shortfall and save all of them. It's just that how long you would do this, right? For example, we don't know exactly the number in terms of loans and debt in US, but we know the entire wage bill of SMEs in the United States is 13% of US GDP. So would it be viable policy say, well, we cannot separate who is liquid, who is insolvent, so we'll just save all of them, or it has to go through some sort of program that tries to separate those. So I just want to get your views on the SMEs, or SMEs should be just a blanket check. Thank you.
And next question from Annette Vissing-Jurgensen.
I actually had not asked a question. I don't know how it showed up as I had.
Okay. We'll put your hand back down again. So then let's go back to the authors. And when you probably, I don't know if you would frame it this way, but it was interesting the parallels between this discussion and the one earlier about reallocation of labor and zombie firms, and how is it a short run shock or a long run shock, and how much flexibility you can build in. And in particular, maybe you want to respond to Ben's points about alternative programs to the DIP financing proposal that you put forward.
Thanks a lot. Thanks a lot, Ben, for a great discussion, for outlining, classifying the various Fed policies in market maker of last resort. We totally agree with you that the Fed made a big difference in March 2020 to solve the market liquidity problems. And we also think the backstop is really about tail risk insurance and taking out multiple equilibrium problems. I think, as Janet pointed out, there is two future uncertainties. One is, how will the post-COVID world look like? And the social planner has some option value, so there's some value to keeping firms alive to some extent. That because we don't know how the future world looks like. The other uncertainty is about the length of the pandemic, and there's a big difference between the equity owners and the planners, because the equity owners, they would like to avoid the bankruptcy cost, and they want to keep the option value of the equity, which is like a call option. They want to keep it alive. And that leads to some distortions in their investment behavior and about they fire too much worker just to be focused on paying off the debt rather than restructuring. And I think the main message, or one of the main message of the paper is essentially there's two classes of firms. One are SMEs, where restructuring is very, very costly. And we have to do everything to bridge it over. But there are other group of firms where essentially the management is divorced from the equity holders to some extent. And Chapter 11 just means to replace one set of equity owners with another set of equity owners. And the distortions from the wrong investments are much bigger than the actual legal bankruptcy costs. I think that's the big thing. So coming to Jeremy's proposal and other proposals, I think that these are very interesting thoughts to keep the flexibility to the extent we don't know how the future will look like. And there's an option value the social planner want to keep, not just the equity owner, but we want to have the social planner on this other dimension. And one way to perhaps to implement it, the challenge is you have to price the warrant. So with this proposal comes, you have to price the warrant. That's very, very challenging. We don't know how to price this at this stage. And one way is to actually tax the firms later on with higher tax claims. Essentially, that's, you give them some grants today, but then there will be a higher tax burden on the firms later on. And this way, essentially, the government is an equity owner, because if they're do well, the firms, they have more profits and the tax burden will be higher too. So implicitly, the government is an equity owner in these firms, and that would be an easy way to implement, to keep the flexibility, and at the same time, you have essentially an equity stake. Just jumping briefly to the questions from Nelly, I think she very much said, the size is essentially just a proxy to what bucket of firms you fall into, whether it's easy restructuring or not easy restructuring or not. What matters a lot is whether the personal owner or the equity owners have a lot of other wealth. And if you have an SME and there's huge bankruptcy cost, there would have an incentive anyway to inject new equity. So that would be fair in this circumstances. So the problems would be less. So it's the big problem is if the equity owners who run the firms, entrepreneurs who run their firms, they don't have the wealth to inject equity. That's, I think, the bigger problem. Perhaps one way to classify, look in the data, it would be another way would be to say how much additional resources, financial resources, do the main equity owners have in order to inject additional equity. Concerning Wendy's, Edelberg's questions, who takes the losses? I think that's a big question as well. Here, again, I come to this chapter 11, and we have this example in the paper where saying there's an old oil firm, and you just restructure essentially the liability side of the firm, and it just gets a new name, and nothing is actually changing in the firm. The management is the same, just the equity holders are wiped out, or there's some debt restructuring going on. And all what you want to do essentially is always to reduce the cost of the restructuring. So what we find, whatever you do, the cheapest way or the more efficiency you get, but just reducing the debt restructuring cost. And I agree with Sepnem, you can learn from Europe. And that's also going back to one of Ben's point, and where the ECB introduced this LTRO, targeted LTRO system, where essentially banks can borrow at a very, very low negative interest rates, below the policy rate, if they are actually pass this funding on to the banks. And Arvin and I, we have made an earlier proposal, it's also part of this paper, where we argue that the Fed should do the same thing, to just help the SMEs to get funding and to give the banks an incentive for this. Of course, you want to complement this with banks who have a lot of equity in their banks, so the countercyclical buffer would help at the same time. So you can go even negative, essentially, if banks pass on the funding, but make sure that the equity stake is big enough. And that's why you want to switch on the countercyclical buffer now, where it's actually very easy to issue equity. The equity prices are very high. Let's make use of this possibility at the moment. And I leave Raghu's question, I think, Arvind.
Just to respond to Raghu's comment, I think, from our analysis, some issues about subsidizing credit, the answers are ambiguous, and it has to do with the reallocation point. We don't know how things are going to evolve. So credit subsidies are, the answer is ambiguous. On the other hand, subsidizing and reducing bankruptcy costs is unambiguously beneficial. If you had to decide where you want to drop a dollar, that's the place in which the marginal value is highest. And I think that, Raghu, as you say, it's working well. Maybe it can work even better. And if you want to spend, that's the place we would suggest you spend. So I'm going to stop there. Thank you for your comments, and thank you, Ben, for your discussion.
Okay. And thank all of the authors. This brings us to the end of the program. I'm going to thank all the writers of the papers and the discussants and everyone who participated in the discussion. There was also a large number of people whose faces never appeared on the screen who were crucial to the success of the conference. So Brookings supported adding a special edition at our request, and we're very grateful for that. And all of the people on the Brookings staff who have worked to bring this conference to fruition. It clearly would not have happened without them, and we're really grateful for all of their work. As was noted at the beginning of the day, this is only the beginning of a conversation on these issues. We have a long way to go, and there's much more to be said. Some of that will be said in September at our normal fall conference, which will be on September 24th, and we hope to see you there. So thanks for participating, and be well and stay safe. Hope to see you soon.